Good morning. It is 9 a.m. on Wednesday, February 2nd. This is Yahoo Finance Live. I'm Julie Hyman. Ryan Sazzi, his shot looking a little different. He's not in his kitchen today. He's at the Nasdaq market site, coming to us hot here on this Wednesday morning. Let's take a look at what's going on in futures this morning because we are seeing a little bit of a lift here, particularly in Nasdaq futures up 1.1% and not hurting matters this morning. The fact that got an ADP unemployment report that came in far below estimates, but that actually seems to be better than estimated in terms of what it could imply for Fed hawkishness versus dovishness. Perhaps business payrolls falling by 301,000 last month. Economists on average are looking for an increase of 180,000, so a far cry from estimate. In the meantime, in the broader market, it's tech to the rescue. The Nasdaq looks to not. It's a great session of gains. Of earnings from Alphabet and Advanced Micro Devices. The tech-heavy index now up more than 4% in that period, the last three sessions, that is, but it's still down more than 8%. Paying more for your skim double mocha latte, Starbucks raising prices. That did salvage earnings last quarter. The stock down. And oil nearing $90 a barrel in terms of WTI. That says OPEC strikes a production agreement. We're going to dig more into action when it comes to oil prices. But first this morning, do you want to just dig into those ADP numbers a little bit more here? That 301,000 decline in payrolls. Now, Saz, we always talk about that there's not necessarily a one-to-one relationship between ADP and the government figures that we're going to get on Friday. It's more just directionally it can tell us what's going to happen. We've been getting warnings left and right from the White House, from economists, that the numbers on Friday is going to be ugly because of Omicron absenteeism. But this really just kind of puts a fine point on it, doesn't it?
Well, yeah, this is, I think, Julie, the last print or the last number you want to hear if you are nervous about the markets. This is a much worse than expected headline print here for the ADP employment report. You really get the sense that Omicron is still weighing on the U.S. economy. And keep in mind, coming into this report, not every Wall Street firm was looking for a decline on non-farm payrolls on Friday. Really, one of the only estimates I've seen out there, I believe, was Ethan Harris, who came on with us last week, looking for 150,000 decline on headline non-farm payrolls here. So not a good number. Clearly, the economy lost momentum coming out of the fourth quarter into the first quarter here because of the variant. But again, not a good headline here and not a good way to start the session.
Yeah, and just to give some more details on this, service provider employment down by 274,000. According to this number, it's the biggest drop since April of 2020. It was led by leisure and hospitality, which is perhaps not surprising, right? We saw a lot of establishments actually close down for several weeks in some cases because folks were sick and were not able to come to work or on concerns that there would be the spread of Omicron if those businesses remained open. It wasn't just Ethan Harris, by the way. There's a number of, I think about a dozen of the economists surveyed by Bloomberg have negative forecasts for Friday's number. The deepest drop, by the way, is being predicted by PNC's Gus Fauché, if I remember correctly, a 400,000 drop. So we'll have to see how it actually shakes out. By the way, we're going to speak to Jared Bernstein, from the White House Council of Economic Advisors. That's coming up at 10 a.m., so we'll get his take on perhaps how bad these numbers could be on Friday. But numbers that were not bad, really at all, were numbers from Alphabet. That company coming in and beating on a number of different fronts. Just to run through some of the highlights quickly here. You see the sales ex traffic acquisition costs, that's basically payments made to partners, $61.9 billion. That's a 33% increase. For this company, the size of Alphabet, to see a 33% increase in sales is relatively remarkable here. Ad sales, by the way, showing real strength. Those two up by 33%, and net income overall coming in ahead of estimates. You see there the various areas of the business and those various revenue breakdowns from the company. It looks like the cloud unit came in ahead of estimates as well. YouTube, a little bit shy of estimates, but it was a gain of 25% in revenue for that. And then the company basically coming out on all of those fronts and beating, and also announcing a 20-for-1 stock split, or 22-1 stock split, I should say, Saz. So a lot to come over in these Apple in these Alphabet numbers?
Well, here's another big cap tech company after that Apple report last week, stepping up here and really sending a strong signal to the market. Hey, Mr. Market, we are okay. Our business is not only just doing well, in many cases, our business is accelerating. And here's a fun fact for you. I have to give our producer Val a shout out to this one. YouTube, $8.6 billion in sales, more than Netflix sales in the most recent quarter. Absolutely fascinating strength there over the past year and a half, 2 years for YouTube, as we all remain generally stuck at home because of the pandemic. Operating margins up 100 basis points year over year. That was good. And we were just talking about the disappointing ADP employment reporting. News hiring, Julie. It's Alphabet. 156,800 employees right now. It's up about 20,000 year over year. Just an absolute aggressive beast of a company that is hiring. Now, I could spend another 20 minutes looking at these earnings results, but Julie, I think one of the fascinating stories, too, is this 20-for-1 stock split. Here is a big tech company. We have not seen this in a while, I believe, since Tesla split its stock. I think sending a signal to the market also that we want more retail investors. We want those average investors that have come into the market the past year and a half, 2 years of the pandemic, to have a piece of our growth story. Now, I will remind folks that are new to investing out there, just because a company splits its stock and the stock price itself is cheaper, the company itself is not cheaper. It's just the stock price. But still, this is a very good quarter. And if you are interested in perhaps getting involved in Google here, now you have another compelling reason to do so with a cheaper stock price.
I mean, one thing we were talking about in our meeting this morning is people could have gotten into Google at whatever price they wanted because of fractional shares. But fractional shares just haven't caught on, even though, as we were talking about, you can buy a fraction of a Bitcoin, and most people do, who are sort of retail investors. They're not buying a whole Bitcoin. They buy a piece of a Bitcoin. It hasn't necessarily seemed to have caught on in the same way when it comes to equities. So that's one reason why this could be compelling. To your point, Ruth Porat, the CFO over at Alphabet, said flat out the reason for the split is to make the shares more accessible. And so that is definitely one of the stated goals here. To your point, splits have not been very common over the last couple of years. We had Tesla do it, as you said, we had Apple do it as well back in 2020, but only 2 companies did it in 2019. That compares with 47 companies in the S&P 500 that did it back in 2006 and 2007. So it's sort of fallen out of favor here. One other reason, perhaps, besides the stated one of accessibility that's been talked about a lot this morning, Saz, it could put Alphabet into the Dow, could make it eligible for the Dow, since the Dow is a price-weighted index versus the S&P 500, which is market cap weighted. There's some attention paid to not having stocks that are too pricey on an individual share basis in that index.
Can you just imagine, Julie, we are now at that point where Google might be added to the Dow. I mean, the Dow used to be this sleepy index, and now you have this potential tech beast potentially joining another growth company inside the Dow, and that's Salesforce. But really, just a very strong quarter by Google here. Now the pressure, I would say, Amazon. It's time for Amazon to step up here if they're not going to announce it this week. When? And split its own stock.
Yes, that is definitely now the next big question. One final brief note on Alphabet. Watch other companies that are dependent on ad revenue and those that are dependent on and perhaps vulnerable to Apple's shift in how it is favoring certain apps, right? Because this may be reassuring to those other companies. So if you look at a Facebook or Snap this morning, for example, we have been seeing increases in those stocks as we see this sort of halo effect. And we're going to hear from Facebook as well in terms of its earnings. So we'll see if we do get confirmation of that. Another company that's maybe having a little halo effect this morning is Advanced Micro Devices. 2021 record revenue for the company. The shares are up 11.5%. This is after fourth quarter net income beat estimates. Sales up 49% for the company. So another big company seeing big increases. And also gross margin's going to be about 51% this year. What's interesting is how much AMD has been gaining on Intel. So that 51% forecast for gross margin this year compares to a forecast of 51% to 53% for Intel. That's just one way that we have seen AMD gain on the company. It's been gaining in market share. The stock performance has been better, even though AMD's revenue is still a lot smaller than Intel, but it is gaining, Saz.
Yeah, I love how really over the past year, you've seen so many analysts, I think, try to poke holes in this AMD growth story. And again, they continue to have egg in their face. Look what AMD put up here in this quarter here. 6 straight years of operating of gross margin expansion. Check, done for AMD. 6 straight quarters of 45% or more revenue growth. And now the company's coming out here and they're issuing guidance for revenue that was $100 million above most estimates for the first quarter. This is a growth company. Now look, Deutsche Bank coming out here this morning saying they are getting a little bit concerned about valuation and the cost or inflation outlook for an AMD as it gets its chips, I believe, from a Taiwan semiconductor, but still another strong quarter for AMD. And plus, keep in mind, we're probably nearing the time when that AMD deal for Xilinx will be closing. That is seen as another catalyst to this company.
Yeah, I want to, again, talk about this ripple effect here, because you have sort of the AMD-Intel rivalry on the one hand, but AMD, of course, is competing with a lot of other chip makers. And its stock going up today, rather than being seen perhaps as bad news for them, it actually seems to be giving a lift to some of the other chip makers. So if you take a look inside the Wi-Fi Interactive today and the movement that we're seeing in many of these stocks, here you have the gains here, and I've taken away the market cap weighting. These are equal weighting. But you see AMD in your upper left up 11% this morning. Xilinx, which it's in the process of acquiring and says that deal should close in the first quarter, is also up 11%. NVIDIA on the top, there's up 5%. Marvel, you can see up 3%. Qualcomm trading higher as well. It's about to report its numbers. Intel, in contrast, by the way, on the lower right, is down 1.8% or 1.1%, excuse me. But something else that we have to look at in context here as we look at all of these chip makers, look at this year-to-date performance. Taiwan Semi is the only of these stocks that is higher on the year-to-date. So when you look at AMD and the reaction in the chip complex that we're seeing today, it's the strength of the AMD numbers, and it's also relief about the AMD numbers, right, Saz? I mean, just because of how bad things have been.
This is another this is just continuing our thread on what we were just saying about Google, another large cap tech company stepping up here with a very strong quarter, and not just a quarter, because if they just came out here, AMD, with a very strong quarter, you would see the market say, well, that was the end of the year, we knew that, et cetera. But another tech company coming out with a strong growth outlook to the first quarter, saying growth was strong in the fourth quarter. It has continued momentum into the first quarter. And you know what, guys? It might just continue for the balance of the year. I heard nothing on that AMD earnings call last night with Dr. Lisa Su, the CEO of the company, that would suggest to me there is some form of major growth slowdown coming at this company over the next 12 months.
So I guess the real question going forward becomes, Saz, are those fundamentals going to be enough to continue to push the stock higher, or will it once again be overwhelmed by concerns over higher rates and the effects it's going to have on the multiples, which is going to grow more quickly, both in reality, but also in investors' perceptions? And I think that's going to be a really important question going forward. We're going to take a quick break. When we come back, we're going to talk more about the ADP number, the jobs report, the implications for the market, the implications for the Fed. As you can see, we have yields moving very, very slightly higher this morning. We'll be right back. futures are looking a little bit more shaky, perhaps, this morning as we go along. But especially Dow futures, we did get an ADP number that came in well below estimates, showing a decline, which is causing a lot of investors to brace for Friday's jobs report from the government. Krishna Guha is with us now. He's vice chairman of Evercore ISI. Krishna, as we look at the number this morning, as we hear a lot of the caution being expressed ahead of Friday, does Friday's number matter? Can we kind of discount it because of Omicron and sort of look for things to normalize more in February? What do you think?
So that seems like a reasonable baseline expectation going in, right? I mean, ADP was noticeably weak, obviously, substantial negative job gains in the ADP number today. My hunch is that we could easily get negative payroll print on Friday, but does it mean very much? Well, what it means is that we would be confirming that we had an Omicron soft patch in employment in January. I think there's a lot of noise there. I don't think it's telling us a lot about where the labor market is going forward. So I think to a large extent, we could look through it, but there are just a couple of caveats, right? When something weakens, you can never be exactly sure precisely why it's weakening. Is it possible, for instance, that the reduction in fiscal support is having more impact on the economy and therefore demand for workers than we anticipated? Could this slowdown be more protracted than we anticipated? I think the odds are no, we're just fine, but we still have to move forward in time and just verify that.
Krishna, is this the worst possible jobs print that we could get, or the Federal Reserve could get on Friday? I mean, the ADP wasn't good, but still, if they've already signaled they're hiking rates into potential first quarter slowdown in jobs. I mean, what a tremendous spot the Fed is in right now.
So I'm not so sure it's all that bad for the Fed. Now, of course, they prefer to have a normal number, a clean read, so they can get a sense of where the economy's going. But I think it's fine for them to hike in March, one-time quarter-point hike on the basis of what we already know about the economy, the growth, the inflation, the low level of unemployment up to this point. I think if the payroll number is terrible, then you'll see the Fed emphasize that it's very data dependent still going forward. So we shouldn't assume that that next hike, which I think is penciled in for the following meeting in May, is set in stone. If necessary, they can even deliver the so-called dovish hike in March, right, where they hike, but they sort of indicate that they're going to be careful about taking that next step. So I think they're covered in a pretty broad range of eventualities, starting from where we are now, zero rates, 9 trillion balance sheet. I don't think anyone would really begrudge them a 25 basis point hike. And I think the odds are strong that then by the time they get to that next meeting in May, the labor market data will be strong again, we'll be exiting that soft patch, and the Fed will confirm from the data that they should be carrying on with regular rate hikes at every meeting going forward, at least up until the point where they start to kick in the QT or balance sheet roll-off.
So it sounds like, Krishna, you think that 6 or 7 hikes this year would then be a reasonable assumption?
So my base case is 5 plus QT. So them taking tightening actions at 6 meetings, right? But a QT standing in for a rate hike at one of those meetings, possibly the July meeting. So hike, QT hike, and then maybe skip November if inflation is cooling on schedule, and then hike again in December. But I'd certainly agree that the bias is more to 6 or 7 than 3 or 4 at this juncture. I think the right way to think about it is that at every meeting, given the starting point, which is a hot economy, rates at 0, balance sheet at 9 trillion, the bias is to tighten unless the data gives you cause for pause. The only reason why I'm not at 6 hikes plus QT in the baseline is just that this pandemic has thrown up so many curveballs. You think that the odds are that at some point this year, something will come up that'll cause the Fed to say, you know what, I'll just slow down for a minute, skip a meeting, and just confirm that everything is still on track.
But even still, Krishna, I think it's pretty clear we're going to get some number of rate hikes this year. What do you think the cumulative impact of those rate hikes will be on the economy later this year and into next year?
Well, we certainly would expect that the economy will be slowing. It's not just the impact of the Fed rate hikes. It's also the fact that you're getting less fiscal stimulus this year than the bumper fiscal stimulus that we got last year. It's also that you're getting a bit of drag from the negative real income effects, right? People's pay is going up, but not as much as inflation. So in real terms, they're actually taking a pay cut right now, most workers. So all of those things would tend to act to slow inflation, but the underlying momentum in the US economy still feels very strong. And we still have $2.5 trillion of extra savings sitting on people's balance sheets that can be deployed, this year and next to support activity to essentially, cover for some of those price increases and the hit to incomes. So I think we've got to expect that growth this year will still be significantly above the kind of trend run rate that the US economy would normally be able to sustain, and probably a bit above next year as well. The point is, of course, that the Fed does need to slow the economy over time back to a sustainable rate. So moving rates higher this year is part of that effort to make sure that we secure a soft landing out the other side.
And Krishna, I want to circle back around to this Friday's jobs report and kind of tie it in with what you're saying in terms of wages, because we've been talking so much about the change in non-farm payrolls. We haven't talked as much about the wage growth, right, which is also supposed to be substantial. But will there also be distortions there because of absenteeism, et cetera?
So again, you're spot on that, first of all, the wage number is very important. But secondly, like the headline number of jobs gained or lost, it's going to be very noisy. It's going to be messed around by the Omicron wave in January. So the wage data in general right now is super important. Why? Because if you're worried about inflation 2-3 years out, the odds are that the things that are driving excess inflation today, with the exception of housing costs, are not really going to be driving inflation 2-3 years forward. So figure used car prices, shortages of chips, durable goods prices in general. If we have an excess inflation problem out 2-3 years, it's because the baton passed from the things that are causing the excess inflation today to excess wage growth on a sustained basis that then forces the wide range of companies operating in the services sectors to move their prices up by more than is consistent with 2% inflation overall. So wages couldn't be more central to this whole equation right now. But of course, we're going to get a distorted number. So why do we say that? Because the odds are that absenteeism and people falling off payrolls is going to be, at least in the statistics, more concentrated among lower paid workers, right? If a business executive is off even for a couple of weeks with COVID, they're probably not going to be taken off the payrolls. But if someone, say, working in McDonald's isn't able to show up for work, isn't getting paid for 2-3 weeks, 4 weeks, then that person is quite possibly going to be logged as not in employment. So if the data essentially has the low income people with COVID dropping out, but doesn't have the high income people with COVID dropping out, then you can easily see how it would bias the overall wage number higher.
Yeah, so that should be something that we should consider as well as we look at that report. Really helpful conversation. Thank you so much, Krishna. Krishna Guha is Vice Chairman at Evercore ISI. Appreciate your time this morning. We're going to take a quick break. When we come back, got to keep track of those shares of PayPal. They are down 19% after the company's disappointing outlook. We'll be right back. A lot more movers to talk about this morning, and not all of them are positive, like Alphabet and AMD. PayPal is down by 20%. And that's after the company said that growth continues to be somewhat lackluster. We saw in the fourth quarter, total payments volume was higher. It was higher by 23%, but it was the smallest increase in 2 years. It was also short of estimates. As you see there, the company's earnings per share in particular also short of estimates. And part of this has to do with eBay continuing to migrate away from PayPal. Part of it has to do with the pandemic bump that they got kind of fading away, Saz. But anyway, you slice it here, it's a pretty negative outlook.
Yeah, let me just Venmo you my comments on this one, Julie. Two things I think why you're seeing the shares is absolutely slaughtered. One, slowing growth. That has been a theme over at PayPal the past few quarters. Next up, their outlook for this year. PayPal only expecting 15 to 20 million net account adds. Well, the street was looking for 55 to 60 million. Whether that's a company just coming up on large numbers versus last year, more competitive environment, doesn't matter in the mind of the markets. And there you have the opening bell.
Yep, indeed. There you have the opening bell. But what else were you talking about when it comes to PayPal, Saz?
Yeah, well, I was just going to say, Julie, the market doesn't necessarily care why these things are happening per se. The fact is that they are in fact happening. Slowing growth over here at PayPal. Disappointing outlook. The stock is still trading at a rich price to earnings multiple. It was just toiling around on Yahoo Finance Plus a little bit, 30 times forward earnings for PayPal. So still an expensive stock, a stock that is priced for strong growth, and you're just not going to get it this year.
No, you're definitely not. I mean, a couple of the other things that the company said in terms of its outlook, it had been targeting a total of 750 million active accounts by 2025. And the company's been spending more to try and get people in. But now PayPal's saying it's not going to make that number. In part, take a look at this. It uncovered 4.5 million accounts it says were illegitimately created. So that's a setback. And now it says it's going to add 15 to 20 million net new active accounts this year. Mm-hmm. It added 49 million in 2021. So in terms of that new customer and new account acquisition, that's another area of disappointment.
Julie, let me just hop in real quick. Just to underscore, this is a shocking decline in PayPal, over 20%. This is not what you normally have seen historically by PayPal on its earnings days. You zoom out a little bit here, PayPal shares are up 355%, or about 355% over the past 5 years. So it has been a consistently strong performer, consistently strong grower, a lot of quarters of coming out here and beating on sales, beating on revenues, but this is a market signaling that the next 12 to 24 months will be a lot different for PayPal in terms of growth compared to the past 2 years.
Yeah, and we've gotten some hints of that, but this is the most fully fledged situation that we've gotten, realization that we've gotten of that. Starbucks, here's another one for you, Saz. This company coming out with fiscal first quarter numbers that missed estimates on the bottom line, operating margin also missing. This even as the number of transactions and the average check size were higher in North America. The company raised prices. It's going to keep raising prices, but it cut its full year earnings per share growth forecast. Now it says earnings per share for the year will be down 4 to 6%. It previously had predicted just a 4% drop, cut its operating margin forecast also. So I know you wrote a little bit about the price situation at Starbucks. It's not enough to help it, though.
You're just tossing me this red meat this morning, Julie, with these worse than expected reports. You're just giving me the meat to just devour like a bear. But nonetheless, disappointing quarter from Starbucks. They raised prices on October 1st. They revealed in the earnings call. They raised prices on January 1st. You know what? None of it matters. The company is seeing a structural increase in hourly wages. And our very own Brooke DePalma has a deeper dive on Starbucks earnings now on Yahoo Finance, just looking at the higher wages that Starbucks is in fact paying here. This is a major problem for Starbucks and a lot of other restaurant players here. Now, Starbucks have come out here and continue to raise prices like they signaled on the earnings call last night. The market still is worried if that will be enough to help improve their operating margin. Starbucks on their conference call warned on sales. They warned on earnings here, and you're seeing the market here reset a little bit. And I'm surprised, Julie. I'm surprised we're not seeing a bigger drop here in Starbucks, just given the tone of the call and the company's outlook. And to your point, yes, I also have a story on Yahoo Finance looking right now at how much prices could be going up at Starbucks very, very soon.
Well, I've got a 3 for you, Brian Sozzi.
Now my coffee's going to cost about $10. You know, I can't take it anymore. I'm going to start making my own stuff at home.
Yeah, well, brace yourself, because obviously gas prices have been going up too. Let's talk General Motors for a moment, shall we? The company coming out also missing estimates on the top line in this case, earnings per share beating estimates, and the company says its production is going to go up 25% in the first quarter, should be around 30% for the full year, but that's coming as they are sort of shifting the production mix. So General Motors, like a lot of the other car makers, has been trying to shift to higher margin vehicles. As it's had trouble getting chips, it's prioritized producing those higher margin vehicles. It sounds like that is going to change to some extent in 2022. The shift is going to go back towards perhaps those lower margin vehicles. And the company says this year's earnings per share are going to be roughly in line with 2021. All of that said, the shares are not changing much this morning.
There's something here with GM, Julie, that I can't put my fingers on. There's just a lack of sizzle. A week ago, they said they are going to invest $7 billion more to build out EV capacity. Great. On the call yesterday, GM's CEO Mary Barra said, hey, we have 110,000 reservations for a new Chevy electric pickup truck. Really a bit of a snooze here. Look at this market reaction. Look at this compared to what we have seen from Ford. Every time Ford has come out, teased new electric vehicles, teased new electric vehicle capacity. Ford CEO Jim Farley told us last week, hey, Brian, we have over 200,000 reservations for our F-150 Lightning electric vehicle. The market just embraces or is embracing Ford more now compared to what General Motors is. Now, it was a good quarter from General Motors. I like what they said on the supply chain, perhaps those bottlenecks easing this year, but still, this is a market that likes Ford over General Motors. And if you're a General Motors, I'm not so sure what else you could do here to regain that narrative versus your crosstown rival.
That one-year chart really tells the story with the two stocks that we just put up. And Ford, of course, also there was a report yesterday that they're going to spend another $20 billion on electric vehicles this year.
Look at that. The stock is flatlined, Julie. Look at General Motors right there. I mean, that is a stock that is barely alive. Where's the pulse? Let's get the defibrillator on it. General Motors is doing nothing there.
Yeah, and it's interesting because the analyst commentary and reaction to the numbers, fairly positive. There were some areas of strength. International was relatively strong. GM Financial was relatively strong, but maybe it's that lack of sizzle that you were referring to. Let's take a look at what's going on. What are you giggling about over there, Brian Sozzi? Let's take a look at what's going on in the broader markets. For that, I'm going to take you back inside the Wi-Fi Interactive. We've got the Dow up just about 0.1% this morning, the S&P 500 up 0.5%, and it's the Nasdaq that is continuing to lead here. So now it looks like, as I mentioned, today could mark 4 straight sessions for the Nasdaq to gain. That's an 8.5% gain in the past 4 sessions, even though year to date, the Nasdaq's still pretty deeply in the red here, but it has bounced back from the lows after it had that correction in the Nasdaq. And as we've been talking about, all of this has to do with some of these largest movers. So take a look at the Nasdaq 100 here. Look at this gain in Google. I mean, come on, it's up 9% today. And you can see over the past 4 days, it's up 16%. So it's not as though it's been falling straight into this report. It's actually been climbing with the broader tech complex into this report today, and now is rising even more. Although, again, Alphabet has not been immune to the dip, but it's now positive year to date. Look at that. Alphabet now up 3.5% year to date. Oh, by the way, lest I forget, Alphabet's trading at a record today. Let's not forget that one. Let's look at the max chart just to put a fine point on it. There it is.
There we go.
Up a cool 4,500% since it came public. And you can see today it is trading at a record. So we've got that going for us when we are looking at large cap tech today. Yes, PayPal's down a lot, but AMD's up. Oh, there's the max chart for AMD. That one's a nice one too, although not quite as exciting as the chart from Alphabet. But Advanced Micro Devices also up handily over the past 4 days. It's up 25%, and then putting a nice little cherry on top, another almost 10% in today's session as a result of its better than expected numbers, and in particular, its better than expected margins. It is still down, however, for the year to date. So really today, PayPal notwithstanding, it's about large cap tech. We're going to hear from Facebook, which is up 2.25%. We're going to hear from Amazon, which is up 1.4%. But really, I think even though, yes, we got that ADP disappointment today, and there's a lot of talk about the Friday jobs report, today is all about tech, and it's all about really, yes, AMD's great, but I think in investors' minds, a lot of it has to do with Alphabet. Speaking of Alphabet, we're going to talk more about it next with an analyst from Morningstar, Ali Mogharabi, is going to be joining us to talk about his outlook for the company after this quarter and this outlook that's sending the stock higher. We'll be right back. Alphabet is ruling the market today. The share's up 9% right now after the company came out with numbers that beat estimates. And, you know, Alphabet now does a lot of stuff, right? It does cloud, it does YouTube, but search is really where it is king. And that's where it got the biggest chunk of its revenue from. Search really seeming to be firing on all cylinders here. Let's bring in Ali Mogharabi. He's Morningstar Senior Equity Analyst, and he covers stock. How did search still, I mean, listen, we all know how much, right? But in terms of advertising, how did Google still manage to do so well in that area?
Yeah, that's a good question. I think a couple of things. One is what we would consider the return of brand advertising, and that's what search has been historically about. And then the second thing is actually the strengthening and resurgence on the retail side. So there are a lot of retailers that are now looking to search to initiate that what we call in advertising, that conversion, that transaction, and search has actually suddenly become a pretty good platform for that. So those are in my opinion, those are the two main reasons why we're seeing some strength in search.
Ali, do you see these margin gains that Alphabet continues to put up? Are they sustainable?
I would say for this year, probably not, because they continue to invest aggressively, especially on the cloud side of the business. That's, of course, growing very well. But I would say that next year, given the recurring revenues from the cloud side of the business, continues to increase. I mean, you guys saw the backlog of, I think it was over $50 billion. So with that recurring revenue continuing to increase, that's going to help expand margins overall a little bit. So again, for this year, we expect slight pressure on margins, but from 2023 through 2026, we've modeled actually margin expansion for these guys.
I want to talk about YouTube a little bit, Ali, because the revenue came in short of, it looks like the consensus estimate perhaps for it, but not by much, right? And its shorts feature that it's rolled out, which is its competitor TikTok, seems to be doing well. So what kind of growth are you expecting from YouTube? It's kind of like the sneaky streamer in terms of how well it does versus some of the others.
Yeah, for YouTube specifically, I mean, it's basically two parts, right? There's YouTube advertising, and there's, of course, the subscription side of YouTube, where you've got YouTube Premium and you've got YouTube TV. On the ad front, we're actually thinking that they're going to be growing the revenue or the top line by around 20 to 25%. The next 5 years. And that's mainly because of a couple of reasons. One is that, of course, they've got a lot of viewers, billions and billions of viewers continue to use that platform. They have the ability, the flexibility, I should say, to actually expand ad inventory on that. Of course, they want to keep the users very satisfied. So at any time, they can actually increase ad inventory with so much viewership. And then the second thing is, similar to search, YouTube is actually attracting more what we refer to as direct response type of advertising. Historically, it's been attracting the brand side of advertising, but now there are a lot of small, medium-sized businesses that would like to have their video ads on YouTube in anticipation of a conversion or of initiating a transaction or a click. So we think those two things are going to help drive the YouTube advertising top line, to at least 20-25% in the next few years.
Ali, the 20-for-1 stock split by Alphabet, do you think that will be that we'll see a retail infusion of retail capital into Google shares because of the split?
That remains to be seen. I mean, certainly it's not going to have an impact on the overall valuation, but for retail investors, the stock could appear to be a little bit more affordable. But that remains to be seen, Brian. Can't really necessarily point to anything on that front.
Well, if I was to wake up today and I had $500 and now I see this Google stock split story, would you put that money on a Google, or is there a better play in big cap tech here?
Well, under my coverage list, the best big cap tech is actually Google and has been for a while. So, my valuation on that is $3,600 a share. So there's still some pretty good upside even after today's positive reaction to the good earnings report. So yes, I would still go with Alphabet or Google.
Thanks, Ali. Ali Mogharabi is Morningstar senior equity analyst, covers Alphabet, of course, as we've been talking about. Thanks, appreciate it. All right, when we come back, the big OPEC Plus meeting is underway. Oh, we got a stat of the day. There is the stat of the day. S&P 500 apparently was lower in January. The final 11 months a year, up 62% of the time. So much for the January effect. I believe this is in more recent years. Now let's talk about Apple. After the break, we're going to talk about it and the effect on oil prices. Stay with us. We are watching oil prices once again today that are pushing towards $90 a barrel. There is an OPEC Plus meeting going on today, and they agreed to a relatively small output increase. The question, as always, is whether they stick to their output increases. But in any case, we've got a lot of forecasts for oil to continue to rise this year. Let's talk more about this with Bob Iacchino. He's Path Trading Partners co-founder and chief market strategist and stock think tank portfolio manager. You got a lot of titles now, Bob. I like it. So talk to us about what's going on with the oil prices this morning and how OPEC plays into it. Although I see, it seems like the outlook notes that we have seen for oil prices this year, OPEC, I wouldn't call them irrelevant, but the sort of existing supply-demand dynamic seems to be more important right now.
It's a strange dynamic, and I'm glad you mentioned it. It's sort of like the dynamic between analyst estimate and earnings, except OPEC is the estimator as well as the one who produces the earnings. OPEC's production targets are simply that, they're targets. Other than Saudi Arabia, and I'm including Russia in this with OPEC Plus, you really have most of the excess capacity being used. And just in December alone, OPEC missed their target by about 180,000 barrels. In January, it's looking like, we don't have the final numbers yet, but it's looking like about 190,000 barrels missed versus their production target. So this 400,000 barrel increase, you see, it's not really affecting the price of Brent or WTI at this point. The last time I spoke on Yahoo, I was speaking to Andrew, our target for a long that we put on at about $78 and WTI was 95. We're still in that trade. I don't plan on exiting it till we get somewhere in the range of $93 to $95.
Bob, what has been fascinating to see from the earnings results out of the oil majors, Chevron last week, Exxon yesterday, is this pullback in CapEx or investment as these companies plow back money into buybacks, dividend raises, you name it. What do you think the longer term impact of that is?
Well, I think that's going to slow. I still think energy is a good sector to invest, but I don't think it's going to outperform to the level that it has outperformed. When you look at Exxon, for example, they took a hit when prices just absolutely collapsed. So some cases to levels we can't speak about because they were negative. And then you saw them pull back on CapEx, get more efficient, especially some of the smaller oil names. And then you saw this price rise that happened not only it happened quickly, I guess is what I want to say. And that is just an absolute formula for energy outperformance when you're talking about, especially the majors. So I think energy, you saw the XLE yesterday had a pretty big spike. I think that's likely to calm down. I think if you were looking for outperformance of the indices, you probably want to shy away from energy at this point, look for a better place to get into it.
Very interesting, Bob, because we've had a lot of people who like energy, but maybe they already got into it, right? What about the forecast that we've been hearing about for 100, even 110 perhaps this year in WTI? Do you think that those are reasonable?
I think it's possible. I wouldn't call it reasonable. Most of those calls are for an average price for 2022 of $100 to $105. I find that a bit of a stretch, honestly, because even though we have restrictions and we don't have sort of the drill baby drill mentality that we had in the last administration, there is still production increases in the U.S. We're not quite to the pre-pandemic level of production in the U.S. We're not even to the pre-pandemic level of demand, and that's part of the issue. We definitely have the potential for price spikes to $100, $105, possibly even $115. I just don't think the average price for 2022 is likely to be above $100 a barrel. I think you'll see a lot of pressure both on the administration and both on OPEC Plus, especially given the inflation scenario, which the Fed can't control the energy part of that inflation equation at all. That is simply supply and demand and OPEC's whims. And I think that's one of the issues for oil prices, adding to not just the core inflation, which is X energy. It obviously doesn't add to that. As a matter of fact, you can argue that it takes away. If you take energy out of the equation, people have less money to buy other things, and now that's fewer dollars and brings the price of those other components down. But overall, energy is what affects the average everyday person, whether they can drive to work, whether they can drive to the store, whether they can drive to a distant soccer game. It does affect people. So I think that's part of the problem with this $105 average. I don't think that's sustainable.
Yeah, and that's a really good point about the Fed as well, and its impact or lack thereof on that part of the inflation complex. Bob Iaccino, it's always great to see you. I hope you're well. Path Trading Partners co-founder and chief market strategist. Thanks for being with us this morning. We're going to take a quick break. On the other side, going to be talking gaming stocks, another slew of headlines in the gaming space. EA up, actually turning around from where it was trading after its earnings. We'll be right back. Shares of Electronic Arts EA are higher this morning. What's interesting, the company's forecast for revenue and earnings in this current quarter were below what analysts had been predicting. The company's Apex Legends franchise has been doing well, but Battlefield was a big flop. So I have to admit, Saz, I'm a little surprised to see the stock recover here.
Surprised, but maybe not so surprised, just given the action, this deal activity we've seen in the gaming space. Of course, Microsoft coming out here for Activision Blizzard. There's a lot of other deals. You have Take-Two for Zynga. A lot of things going on in this space, perhaps to keep a bid under shares of Electronic Arts after a disappointing quarter. Just look, their bookings grew 7% year over year. The street was looking for about 10%. Company also guided down for the fourth quarter here. Battlefield 2042, a game I've never played before, but of course the street is tracking it. Looks to be some delays there, disappointing performance with that as well. But the big question here, Julie, is where is the buyout for Electronic Arts? The stock is up 25% over the past 2 years. The S&P 500 up about 45%, the Nasdaq up over 50%. If you're the team at Electronic Arts, what are you doing here? And secondarily, how is that stock underperforming considering the installed user base of these consoles? They have a hit on their hands, of course, a longtime hit in Madden football. All this deal activity, at what point does Electronic Arts step up here and get some form of deal done?
I don't have the answer to that, Saz.
Neither do I, and I'm not sure they do either, Julie.
One more thing I just wanted to mention is that Sony is again cutting its forecast for how many PlayStations PlayStation 5 specifically, it can ship because it's not getting enough chips to power those consoles. The company said that it shipped 3.3 million units, but the total is 17.3 million. But that's below where the PS4 was at this point, same point in the cycle. So we're going to keep watching that as well. But we're going to take a break right now. Much more ahead on this busy Groundhog Day. Remember that? It's Groundhog Day. We're going to have 6 more weeks of winter, sorry. But coming up next, we're going to talk to Jared Bernstein of the White House Council of Economic Advisors as we all brace ourselves for what looks to be a perhaps not so great Friday jobs report. We'll be right back. This is Yahoo Finance Live. It's 10 a.m. and we have been seeing markets go higher today. I'm Julie Hyman, along with Brian Sozzi, who'll be along in a moment. It's about 30 minutes into the trading session here, and we've got the Nasdaq extending its gains into a fourth session, although it's moderating them from where we have seen them in recent gains. The Dow just barely hanging on to a gain, and the S&P 500 higher by about 0.5%. We've got a warning on the labor market ahead of Jobs Friday. The ADP report showing private payrolls unexpectedly fell by 301,000 jobs last month. White House Council of Economic Advisors member Jared Bernstein will be along in just a moment as the administration tries to lower expectations going into Friday's report. This ADP number does that as well. And Sozzi's coming to us from the Nasdaq this morning. We'll be speaking with the exchange's president, Nelson Griggs. We'll get his take on the IPO slowdown and why he thinks markets will bounce back next quarter. Plus, a bombshell lawsuit that's rocking the NFL. Former Miami Dolphins head coach Brian Flores alleging racism in the league's hiring practices. We will have the latest developments as we also got confirmation that the Washington team has a new name. Not a very well-kept secret, but it's Commanders, folks. All right, let's get a check on what's going on right now in the markets. Our Jared Blickery is watching all of the action. What's going on, Jared? No, we don't have Jared. Excuse me. Oh, well, I'm very confused now at the moment. Okay, Jared Bernstein is who we are going to bring in now, a member of the White House Council of Economic
The wrong
Advisors.
Jared, huh?
Whew, I've gotten my wires crossed today, apparently. Okay, sorry about that, Jared. So
Okay.
obviously we have that ADP number this morning that was disappointing. We've got some estimates, not all of them certainly, but some estimates that the number on Friday is going to be -1 as well. What do you think? Should we be bracing ourselves for a negative read in January?
Well, a couple of points here. First of all, the correlation between the ADP and the BLS payroll numbers has been uniquely low. I actually looked at it this morning. It's about 0. But that said, one of the most important thing we know about Friday, without knowing the number yet, of course, is that the survey was taken at the very same time. The payroll survey for the BLS was taken at the very same time that Omicron caseloads were peaking. We also, so that's point one. Point two is that if you're absent from work because of illness and you're not paid, so you're on unpaid leave, in the payroll survey, you're counted as not being on the payroll, which is accurate because you're not being paid, and therefore you're not in the job count for Friday. Now, that doesn't mean you lost your job. It means you're home on unpaid leave. So if you're back in February, you're counted again there. So the important point is that this month is likely to be distorted by the fact that lots of people, probably hundreds of thousands, given where the caseloads were, could be on unpaid leave and therefore not counted in the BLS payroll count.
And so what should we take away from the numbers? How should we read the numbers that we get on Friday?
That's the important question. One of the things we've tried to do at the White House has been very careful, even on a month when we get a big upside surprise, to look not just at 1 month, but to look at the underlying trend. The underlying trend in the labor market is extremely strong. Unemployment fell faster than any year on record, with data back to 1948 last year. Employment was up by over 6 million, another historical record. We have almost 11 million job openings. That is near an historical record as well. So there is absolutely no question that not just is this a tight labor market, but it is a historically and a uniquely tight labor market. At the same time, as you know, and you've reported, because I think we talked about it, GDP grew at a breakneck pace last year, 5.7%. So look, unless there's a strong, lasting shock, economies don't go from that kind of speed down to 0 in a month or a few weeks. This is very much, if this job report comes in low or negative, it's going to be very much a function of this measurement issue around absentees not counted in payrolls. The underlying trend still very strong.
Jared, the hottest topic on Wall Street right now is where we might be going in terms of interest rates. Interest rates are likely headed higher. How concerned are you that that causes a stall in the economic recovery here in the country?
Well, look, as recoveries proceed, and especially recoveries that are quite strong, historically, we tend to see interest rates rise. Interest rates, especially real interest rates, which of course is the nominal minus inflation, remain quite low. And so there is still, I mean, this is an interesting point that's somewhat underappreciated. If you look at the Fed's plans to raise interest rates this year, and you throw in whatever number of rate hikes you like, you still see quite an accommodative monetary policy, and you still see at least projections for, say, the 10-year Treasury yield to be historically quite accommodative as well. So I think you have to distinguish between the direction and the level. We expect interest rates to pick up when you have an economy posting the kinds of figures that I just cited, both in terms of labor market and GDP, as a recovery gets underway. And look, I'm a veteran of this, so I've been around for a lot of recoveries that were jobless, that were wageless, that were, where GDP was growing, but at a pretty pathetically slow pace. We have, in those variables that I cited, we have much more of a V than is usually the case.
Well, you have been around, Jared. We've talked to you a good number of times through the years, and now there's some folks on the street calling for 7 rate hikes this year. That is a very aggressive potential path of Fed policy. How concerned are you that that would stall out the economy if we get 7 hikes instead of 4?
I think there's a borderline which I used to not face, where as a White House economist, I'm not going to lean into Fed policy the way I used to. What I can do is tell you what the president said. He said, and if I'm not quoting, I'm close to it, that it's appropriate for the Fed to take the steps they've outlined to recalibrate the support that is now necessary for the economy. You heard Chair Powell himself say, as I cited just a minute ago, the labor market is very, very strong. We have a strong above trend underlying GDP growth. So the Fed's pivot makes sense to me on macroeconomic grounds. I'm certainly not going to get into calling numbers of hikes.
Jared, I want to turn to the matter of stimulus and what that has done to the gross national debt, which we just got the latest update on yesterday, $30 trillion. Part of the sort of partly Democratic, mostly Republican intransigence on passing another stimulus bill has to do with talking about the debt, at least, and pointing the finger at the debt. What do you think? I mean, are you concerned about that number, and how do you sort of overcome that obstacle?
Yeah, I mean, it's something I think about a lot, and no question that the president has continuously leaned into the importance of paying for our longer-term measures and has elaborated very, I think, granular plans to do exactly that. But there's 3 points I want to bring to this. First of all, it's one thing to cite the level of the debt. The way public finance economists do it, for a reason, is to look at it relative to some other stock or flow. And in this case, the debt to GDP is, of course, a very common reference point. And if you look at that, you'll actually see that's coming down, in part because GDP, and in this case, we're talking nominal GDP, has been growing so quickly. So again, this backdrop of a very strong economy isn't something we can put to the side when we discuss these other variables. Secondly, low real interest rates, something I said in my second comment. That means servicing this debt is historically quite low. And that's something that we actually highlighted in our last budget and will be in our next one as well. Third point, I guess it's my most important one. I think it is a really substantive mistake to talk about the debt in this disembodied form that says that pays no reference to what we got for it. By investing in getting to the other side of this crisis, by getting shots in arms, by getting checks in pockets, by preserving the balance sheet of families, by helping businesses get over this chasm of COVID-19, some of that debt accumulation was essential to get us to where we are, with the strongest GDP growth in 40 years, with a labor market that's stronger than it's been in generations. To talk about the debt and not talk about what we got for it. Lower child poverty, better household balance sheets, families that are much more intact in terms of both their health and their balance sheet. I actually think that's a very substantive mistake that we should all try to avoid.
Gerald, let's stay on those household balance sheets. Before you came on, we were talking about a company like Starbucks out here again, raising prices here on consumers because of high levels of inflation. And Starbucks is not alone. There's just company after company raising prices here because of inflation. What type of damage is this doing to middle-income America and low-income America?
The president has answered that question every time he's asked, and he's talked about this as a very serious, very pressing challenge for American households who haven't seen these levels of inflation in many decades. And that is why he has dispatched his team and his supply side disruption task force, of which I am a card-carrying member, to do everything we can to help ameliorate supply side pressures. And I am here to tell you that those actions are having results. We have to, now the bottom line is the inflation rate. So we're going to continue to track that carefully. And I'm not at all disowning my earlier comments of how much of that challenge is. But we have to look at how our actions on the supply chains, on the ports, on the trucks, on ship to shelf are going. Let's talk about inventory in Q4. One data point. So again, I don't want to overemphasize it. We saw very strong inventory buildup. We saw very strong imports and exports. We saw some of our PMI indicators of the supply constraints somewhat loosening. All of these are not enough to make a trend yet. So I'm going to continue to be careful and not over rely on one data point, but there is some easing there. Certainly, dwell times of containers on the ports are down 60% 2% over the past few months. So there are things we can point to that suggest some of that unsnarling efforts that we in the private sector are engaged in are helping. But bottom line is it's going to have to show up in the price index before we say we're really making the kind of progress the president wants to see.
Well, and Jared, this progress that is slowly being made is not necessarily being appreciated by consumers, and I would say more broadly the electorate, right? The people that the White House wants to reach. It seems as though this message is not necessarily getting out there. Consumer confidence slipped a little bit in January. It's still relatively strong, but people are worried about these higher prices.
All true. And as I said in my last comment, that worry is something that the president reflects every time he speaks about this. And I think it's because I worked for Joe Biden for a long time. Sorry, President Biden for a long time. And he has always had this kind of a personal touch, personal connection with the middle class. And so when he talks about this, he's not talking about it like I am, like a macroeconomist. He's talking about precisely what you're referring to. And I think the thing that everyone who's sharing those concerns, and I agree with you, they're very widely shared right now, needs to hear this message, which is that we are doing everything we can to help unsnarl supply chains, ease these inflationary pressures, increase more competition, pass legislation that lowers pressures on family budgets through lower drug prices, lower prices of childcare, elder care, lower costs of education. The forecasts tell us that by the end of this year, inflation should be growing about half as fast as it was last year. Now, those forecasts could be wrong. Therefore, we are not sitting in our hands, crossing our fingers, hoping they're right. We're doing everything we can to ensure they're right. So while I understand and even personally share the concerns that you're reflecting, what I can assure you is that we are doing everything we can and will continue to relentlessly do everything we can until these pressures ease.
Jared, it's always great to get your perspective. Appreciate the message you're trying to put out there, and we'll talk to you again soon as maybe we see some of these pressures start to alleviate. We shall see. Jared Bernstein at the White House Council of Economic Advisors. We're going to take a quick break. When we come back, we'll have more on today's top stories. And if you take a look at today's trending tickers, it really offers a snapshot of those top stories as we see PayPal shares tumbling, for example, after earnings, and Alphabet and AMD surging. We'll be right back. An out-of-control fire at the Winston Weaver fertilizer plant in North Carolina has forced thousands of people to evacuate their homes. That fire poses a danger of a large explosion that could lead to chemical exposure. The fire started on Monday, and as of yesterday, there have been no reported deaths or injuries, but crews and experts watching the fire said that it has the potential to cause, quote, the largest explosion in U.S. history. So we'll continue to monitor that. The Eurozone inflation rate rose to a record high of 5.1% in January due to a fresh surge in energy prices. This comes as an unwelcome surprise for policymakers at the European Central Bank, who have said they don't expect to raise their key interest rate this year. They meet tomorrow, by the way. Widespread expectations were for Eurozone inflation to decline to 4.3% at the start of this year. Political action groups for Goldman Sachs and Comcast have begun donating money to Republican lawmakers again, according to new filings. The committees had paused giving money to lawmakers who voted to object to the certification of President Biden's election after the January 6th riot. The two companies were among dozens who halted political donations and now join companies like Aflac and American Airlines, who resumed political donations back in June. Well, speaking of money flowing to and from the government, we want to focus in on the PPP money that happened amidst the pandemic, in the depths of the pandemic, and where that money went. Our Rick Newman has been looking at this issue, and it seems some of it went to people who didn't necessarily need it, Rick.
Right. To refresh everybody's memory, the Paycheck Protection Program was about $800 billion. That's a lot of money. That was part of the CARES Act that Congress passed in 2020 when President Trump was still in office. And there's some new research on where that money went. So this is by David Otter he's an MIT economist and some other researchers. And they found that that program did help. It protected about 3 million jobs. It helped keep about 3 million people on the payroll throughout 2020. But they also found that about 40% of that money, something around $360 billion, actually did not go to workers as was the intent, but it basically went to business owners and shareholders. So part of the reason for that is this was a ton of money that Congress pushed out the door extremely fast. It was essentially untargeted. Just about every business with fewer than 500 workers qualified, and most of those businesses took the money. But in some cases, that money just did not end up going to workers. It basically went to the top 10% or the top 20% of the income stratum in the United States. So this helps us understand what kind of stimulus, gives us the most bang for the buck. And it probably is not this type of program. So we may not see this the next time there's a recession and businesses need help.
Interesting if that's the lesson, that's the takeaway. Maybe we'll just see direct stimulus payments instead. We got to leave it there, Rick. Thank you so much. Appreciate it. Coming up next, we're taking a look at stocks that are mixed right now. We'll talk next about what you should be doing in this market with BlackRock's Chief Investment Officer of the U.S. Fundamental Equities and Portfolio. Stay with us.
All right, welcome back to Yahoo Finance Live. Let's get back on the markets here and bring in BlackRock's CIO of U.S. Fundamental Active Equity, Tony DeSpirito. Tony, thanks for taking some time this morning. We were just talking a little bit in the break, this calm that has returned to markets. What's causing this calm after really what was a tough week last week, and do you think the calm is here to stay?
So, Brian, I think we're in the middle of a regime shift, right? We're shifting from the pandemic regime to the post-pandemic regime. And of course, the pandemic regime was characterized by lots of fiscal stimulus and monetary stimulus, with a Fed that was promising low rates for a long period of time. We're now moving beyond that, right? We're seeing a very sharp recovery. We're seeing strong GDP growth, good wages, good employment numbers, and inflation. And so that means the Fed is now moving from low for longer to a period of rising rates. That, by definition, creates a degree of uncertainty. And I think that means we're going to see some volatility. It's certainly calmed down the last couple of days, but our expectation is for there to be a fair amount of volatility this year. That doesn't mean investors should panic. We think the market is actually very attractively priced, particularly relative to bonds. So investors should still stay invested, but just expect a bumpier ride.
Tony, you think we have now arrived at that point where the market is comfortable with rate hikes that might number 5 to 7 this year?
Yeah, in some ways, we might be at peak hawkishness in terms of market expectations. And so you certainly saw that in January and late last year, a change in tone from the Fed. Now the market has reset expectations. And so now the market is expecting these rate hikes and starting to price them in. Of course, there is a little bit of a threading the needle going on, right? Raise too little and inflation continues to increase. Raise too much and the economy could slow. And so the Fed is going to be very sensitive to that. And that's why we're going to see this kind of steady increase throughout the year in rates.
Tony, it's Julie here. I'm watching the market today roll over a little bit. This despite those blockbuster numbers from Alphabet, for example, from AMD also. If even in the face of good corporate news, stocks can't manage to get a lot, much traction, what do investors kind of do in this market? Do they just hang on to those individual stocks that they think are going to perform well?
Yeah, we've really been recommending a barbell policy, right? On one hand, you still want to own those deep cyclicals, energy and financials. They did very well last year, but they should continue to do well in this inflationary rising rate environment. Banks are one of the few areas of the economy that actually benefit directly from rising rates, so that's positive. And then, of course, energy has really benefited from restricted supply. The fact that there's been very little investment in incremental supply really since 2014. And so that's propelling those forward. So that's on one hand. On the other hand, you also want to protect yourself from in case the Fed overdoes it. And that's where you want to own some of the high quality compounders, companies like technology stocks. I think if a lot of those stocks have come down in their multiples as of late. I think there are a lot of high quality companies where the baby has been thrown out with the bathwater. So that's an individual stock selection issue. Similarly, I think healthcare is really interesting. It's a very steady sector, good growth because we're aging as a society and healthcare benefits from aging demographics. We all consume more healthcare as we age, and yet the valuations are very attractive there. And so that's what we're recommending is to take this barbell approach.
Tony, is this the tech stock sell-off? Has it just been overdone? Microsoft, good earnings. AMD, good earnings. Google blew it out of the water. Many others, too, in the tech space have been reporting very strong results. And I get, the market has to look forward, and they don't like higher interest rates. But fundamentally, tech companies are doing pretty darn well.
So you're right. The fundamentals are absolutely fantastic. It's really a question of duration. I mean, if you think about growth stocks versus value stocks, you can think in terms of duration, that growth stocks have the cash flow weighted towards farther in the future and value stocks nearer term. And so when interest rates rise, it's natural to expect PE multiples to come down in the tech sector. And so that's broadly what's happened. And then as stock pickers, what we're doing is going through and sorting through that list of companies that's come down, look for those companies that are really, truly fantastic franchises, and yet they've overcorrected. That's not true of the broad of high growth multiples broadly, but it is true of certain companies, and that's what we're doing.
You know, Tony, you and many of the investors we speak to sound relatively calm about this environment right now, right? That things are not perhaps as dire. Maybe, as you say, we've reached peak hawkishness. I'm curious what your clients sound like. Are they similarly calm here, or do you get a lot of sort of more pessimistic calls that you have to kind of talk people down in this environment?
Well, without a doubt, whenever there's volatility, we want to get in front of our clients and make sure they're comfortable. And what we've heard is they are. And we've been saying for a long time to clients, look, when you're in equities, you're not buying them for the next month or next week or next quarter even. You're buying them for the next 3 to 5 years. And when you take that 3 to 5 year outlook, which is exactly what you should be doing, fundamentals continue to be look strong. Valuations, particularly when you look on an equity risk premium basis, in other words, the earnings yield on stocks as compared to the yield on long-term bonds, stocks are the best place to be. And so investors actually, as I talk to investors, they're still very comfortable.
Really appreciate you taking some time. BlackRock's CIO of U.S. Fundamental Active Equity, Tony DeSpirito, good to see you. We'll talk to you soon. All right, coming up, it has been a busy week for NFL fans. Tom Brady retirement, a new name for the Washington football team, now the Washington Commanders. We'll be right back with a roundup of this with our very own Josh Schaefer. Stick around. All right, it's been a busy few days for all things NFL and has nothing to do with the Super Bowl, believe it or not. Let's bring in Yahoo Finance's Josh Schaefer, who has a lot on his chalkboard of plays. Josh, what are you looking at?
Yeah, Brian, I'd say the biggest thing this morning is the lawsuit against the NFL filed by former Miami Dolphins head coach Brian Flores. So it's a class action lawsuit, and it's against the NFL, the New York Giants, the Denver Broncos, and the Dolphins specifically. And so he was a coach for the last 3 years for the Dolphins. We should note that for the last 2 seasons, He actually had winning seasons, which in the NFL, I mean, you want to make the playoffs, you want to win the Super Bowl, but winning seasons aren't necessarily considered bad either. But he was fired at the end of this year. And so he's now suing the team that fired him and a few other teams for the hiring practices, specifically the hiring practices and how he was treated when he was a coach. So he's claiming that the NFL has been biased in this process, and this is not the first time we've heard this. And so part of his lawsuit reads that the NFL remains rife with racism, particularly when it comes to the hiring and retention of Black coaches, coordinators, and general managers. So I think you can see on your screen here, there are a lot more white coordinators, white head coaches, white general managers than there are Black head coaches in the NFL. And so right now there's currently only one Black head coach in the NFL, and that's in a league that has about 70% of the players that are Black. So there's a big discrepancy there between the representation we're seeing for coaches and players. And what Flores is really harping down on here is what happens during the hiring process. So we know the NFL has had this rule called the Rooney Rule in place for about 2 decades now, and it's been updated a couple times. It requires NFL teams to interview diverse candidates. They have to interview at least 2 diverse candidates in their hiring process. And what Flores does in this lawsuit is kind of peel the onion back a little bit and show us that those hiring practices, while they're interviewing him, they might just be interviewing him to check a box. Kind of the key example here, which accuses the New York Giants of already knowing last week that they were going to hire the former Bills offensive coordinator Brian Daboll as their new head coach. Bill Belichick, Brian Flores presents texts that are allegedly from Bill Belichick that say that congratulate Brian on getting the job. And it turns out, according to these text messages that Flores presented, Bill Belichick was texting the wrong Brian. He texted Brian Flores before he had ever interviewed with the New York Giants and congratulated him on the job because the Giants had already decided to hire Brian Daboll, who is white. So that's going to be one of the key pieces of evidence in this lawsuit. We'll be looking at it kind of all day here on Yahoo Finance. We have some sports law experts coming on later to discuss that with us. And we should also note Flores is technically still interviewing with 2 teams, the Saints and the Texans, but it'll be interesting to see kind of how this case carries out against the NFL and maybe overshadows some of Super Bowl week coming up.
Yeah, and speaking of overshadowing, I mean, as you say, this is a really important case and it's important allegations that he's making. At the same time that there are some other important stories going on within the NFL. There was Tom Brady yesterday, there's the Super Bowl, and there's also a new name for the Washington football team. It's not just known as the Washington football team anymore. Some people are calling this sort of the worst kept secret in football, but it's the Commanders.
Yeah, Julie. So the Washington football team, after 2 years, for 2 years, they went without a name, essentially. They were the Washington football team all the way back to July of 2020. They announced this morning, you can see the video here of the new jerseys with a white, a red, and a black alternate jersey. They're now going to be the Washington Commanders. They're talking a lot about Washington, D.C.'s history, and this will be the 90th season for the Washington football team. So kind of a reference back to all of that is the plan here. This, of course, was a move by the Washington football team to also erase some racial inequities that they had sort of perpetuated over the years with their old mascot, and then changed the Washington football team to try and figure out what to do. Took them 2 full years to come up with this big plan. Now we get to see how consumers and fans react. Just from looking around on the internet this morning, it's been a little mixed. I don't know how you guys feel about them. I think the jerseys are kind of cool. I know some folks here, I was talking to some of the producers beforehand, don't love the black jerseys, the alternates, but I think they might sell well. And in the NFL, that's really a lot of what they care about, right, is selling those jerseys and making sure people like the name.
I mean, listen, the bar was low with the other name and what they were trying to correct, right? So I think, the Commanders, even though they took their time in coming up with a better name, so you would think that it would be one that would be like perfect, but oh well. I don't know how I feel about it. Sazi,
Julia,
do you like it?
You're flexing with this football knowledge. It's very, very, very impressive. We'll take this offline. Josh Schaefer, busy day for you.
Again,
we'll
the
check
bar
back
is low for me, Saz.
The bar, it's all good. I'll take anything I can get. All good. Josh, see you later. Julie, stick with me. All right, coming up on the other side of the break, we'll speak with Nasdaq's president, Nelson Griggs, about all things deals, IPOs, you name it. We'll be right back.
2021 was a hot year for IPOs broadly, market debuts really of all kinds. It seems like things are slowing down a little bit here thus far in 2022, just like we've seen market slow down a little bit in general. Let's talk more about the outlook for debuts. We're joined by Nelson Griggs. He's president at Nasdaq, and our Brian Sozzi, by the way, is at Nasdaq today, although as you can see, they're not in the same place. But in any case, Nelson,
not a TV trick.
Thanks for being here. So let's talk about the outlook for IPOs, because globally this year we have seen a pretty dramatic drop in the number of announcements of IPOs that have priced. What do you think the year is going to look like? I mean, I guess it would be tough to live up to last year.
Well, yeah, I'd be surprised if we live up to last year anytime soon. But even before that, 2020 was real strong. So was 19. So we're obviously off to a slower start this year, with really the backdrop being a very challenging overall market. I think any IPO is going to be looking at their public comps. There's a key indicator called the VIX, the volatility index. Anytime most IPOs, 90%. Go public when that's below 20. It's been ranging the 25, 30 handle for the first month of the year. So yeah, just a lot of factors that say that there is investor sentiment that is not really ready to digest more public offerings. There is an ample pipeline. We have more companies today on file to go public. We did it this time last year. At the same time, I think we need to get the buy side to get more excited about new offerings.
When do you see things thawing out, Nelson? Is it a second quarter thing, or is it later in the year?
Yeah, we are, again, there's a great pipeline. So trying to predict that time is pretty tough, Brian. But I think you look at right now what investors are focused on. Their portfolios obviously got hit pretty hard in January. We're in peak earnings season now. So the buy side is very focused on digesting earnings calls and earnings reports to see how the overall market looks. And then you look at a key date is actually February 14th, where Q3 21 financials go stale for companies. So then they have to, again, update their financials. So that takes us to the April timeframe. We do anticipate, if we could get some stability in the markets, that April, May, June could be fairly robust. Not saying we're going to match last year's, but there is a number of companies that we talk to regularly that are ready to go, assuming the conditions hold up. So I looked a little bit more towards April, although we'll certainly see a few deals, come out before then.
Hey, Nelson, I'm curious about the whole China market as well, in terms of Chinese listings here in the U.S. Obviously, there have been some political crosswinds that have made it more difficult for Chinese companies to list. Do you think that spigot is off? Or do you think we could see a trickle here?
Yeah, I think the spigot is fairly off at the moment. You do need to, there's a lot of work being done at the governmental level. This would involve, our government, our regulator, the SEC, the Chinese regulator, the CSRC, and really what they're discussing is access to companies and their financial reporting. And I think there's, again, very, very senior level discussions going on there. We're hopeful. Our job is to list high quality companies that are, driving the future. That's always been our mandate at Nasdaq. We do think that on a global basis, we want to be as competitive as we can with other markets. But again, that's something that I would say, Julie, have a little bit of time for that to work its way through the system as the governments do their work.
And Nelson, if we're not going to get these buzzy IPOs coming from China, or at least at the frequency they had been, you have a global view. Where else might we see some upstart companies come to market? What other country?
Yeah, that's a great question, Brian. I think we are seeing, I don't think it's going to make up the full breadth of what was coming out of China, but we are seeing more companies come out of other parts of Southeast Asia, Singapore. We're seeing some certainly out of Australia in the healthcare space, as well as technology. And then for a long time, we've been very focused on, will there be an India pipeline to the US? A lot of those companies do tend to stay domestically, although I'd say at this point, we're very optimistic that this could be I wouldn't call it a flood of companies, but I think we are at the precipice of seeing more companies out of India. So I think you have pockets across the world, and I'd be remiss if I didn't mention, India and Canada. Last year was a big year for Canadian companies to list in the U.S. And again, we have a pretty steady flow out of Europe.
What does the buy side want to see? A lot of the companies that came public last year, Nelson, they've been underperforming in the marketplace. Those days of companies coming to market with large losses and no timeline on profits, are those done?
Well, I think saying anything's done would be a pretty bold statement. I think we tend to see an over rotation on both sides, and there probably was a bit of an over rotation in terms of some of the valuations that were assigned to companies and their sales and long-term growth projections. And then, you could see no rotation back the other way where investors do change their mind and focus much more on the earnings and short-term predictability. So I think we always have seen that. I've been with Nasdaq for 20 years, and we have seen many, many times where there's, again, an over-rotation on one side or the other. I would say that the solid companies that are attacking new markets with a really growth projections that the buy side can appreciate and digest, are going to do just fine. So I think we're in a little bit of that period where everyone's trying to figure it out, and we know the buy side changes their mind and moves their goalposts regularly. And that's just a time where I think you have to look at the private markets and say, what do private companies do? Do they extend their life cycle and stay private longer? What are those funding potentials on the private side? So I think that's a lot of the questions everyone's looking at right now and how long it takes to settle out.
Yeah, it's a tricky calculus for sure. Nelson, good to see you. Be well. Nelson Griggs, Nasdaq president. We're going to take a quick break. When we come back, we'll be talking about what's going on with stocks. Back in the green, all three major averages, although pretty modest gains for the Nasdaq, which was earlier up much more. As for movers in the Dow today, we've got some big ones dragging things down. JP Morgan, Salesforce, Boeing among them. We'll be right back.
Welcome back to Yahoo Finance Live. And Julie, it has been a very busy morning for earnings season analysis. Google/Alphabet, AMD, a lot of moving stocks on the Yahoo Finance trending ticker pages.
Yes, most definitely. And as we noted a minute ago, the Nasdaq is definitely not up as much as it was out of the gate here this morning. Nonetheless, it still looks like it's going to have that 4-session gain if it does hang on. Oh, wow, now it's barely in the green. So we've seen it bouncing around a little bit here today. So what's going on? Take a look inside the Wi-Fi Interactive. PayPal, part of the thing that's dragging it down here this morning. We talked about it earlier. PayPal coming out with a pretty dismal outlook after the company's numbers not looking great, in part because eBay is sort of pivoting away, in part because consumers' spending habits are changing to some extent. And it looks like some of that pessimism is outweighing even the huge, overwhelming gain that we're seeing in Alphabet, up 6%. Even it has come down off the highs of the session. Advanced Micro Devices is still up by 6% too. And Meta is trending as well on our trending ticker page. It's up 0.6%. Earlier, it too, though, was up more because of the sort of optimism that it looks like Alphabet has engendered. But I also want to look at the heat maps here this morning because there's some that are sticking out to me. Look at this, Saz, the ARK Innovation ETF. Everything's, do you see any green on that screen? I'm not seeing any green on that screen.
It ain't 2021 anymore. This ARK Innovation ETF continues to be really under a lot of pressure here, Julie, over the past 6 months, certainly year to date, in large part because of that change in interest rates, I would argue, or upcoming change.
Yeah, well, and then there are some specific situations here. I mean, look at Block right here, aka Square. It's down by nearly 10% because of that result from PayPal. And, you know, this is a stock that basically, since it's renamed itself, has just not done well. The stock is down 58% over the past 6 months. So you can see that this group has just not performed well here, Saz, and a lot of other sort of buzzy names that have just given things up. And they're down again today, which again helps to explain why we've got the Nasdaq also giving up some of its gains. Here's a look at the broader Nasdaq 100.
It is an old tech environment, Julie. Look at Apple there in the green. Strong quarter last week. AMD, strong quarter. Right now, the market wants to buy these large cap tech companies. Of course, Google and Alphabet fundamentals are very strong, generating a ton of cash. I believe Alphabet ended the fourth quarter with close to $170 billion in cash. A lot of those other loss-making companies like Robinhood, Coinbase, you name it, they cannot boast of those financials.
Yeah, definitely not. All right, so we're going to continue to watch this and perhaps see this kind of bouncing around in the session, considering that's kind of what we've gotten a little bit more used to, Saz, is you can't assume anything when you come in the morning that that's the way the day is going to end, even with Alphabet, although that seems to be solid, but who knows in this environment, especially after we got that ADP number that was way below estimates. We're looking ahead to those Friday numbers and the jobs report as well. That does it for Brian and I on this Wednesday morning. Brian Chung and Akiko Fujita are going to take you through the next 2 hours of trading. We'll be back here tomorrow.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brian Chung. We are seeing stocks rising for a fourth straight day with big tech providing a big lift. All three majors in the green right now. The S&P 500 leading the gains right now, up about half a percentage point. The Nasdaq up about 29 points and the Dow trading pretty flat. Alphabet, a big driver in the session. The stock popping in a big way on better than expected results in the fourth quarter. We're going to be diving into that in just a bit. Labor disruption. Private payrolls in January declined for the first time in more than a year as the White House warns of a strange jobs report later this week. We look ahead to Friday on the outlook for the labor market. And allegations of discrimination in the NFL. A former head coach files a class action lawsuit accusing the league of racism in its hiring practices. We're going to get to that story later this hour, but let's kick things off with a look at the market action. Brian, the Dow just dipping into the red right now, but a big focus this morning, of course, the labor market with those ADP numbers coming out, private payrolls falling by about 301,000 for the month. Let's bring in Jared Blickery for a look at the latest market action. Jared.
That's right. That ADP print was quite the surprise, coming in at negative 301,000. The street was expecting 180,000. And this is ahead of that big jobs report that we're getting this Friday, where the median estimate is 150,000. But I counted yesterday, there are 15 analysts who think it could be a negative print, with the low estimate at negative 400,000. So that's kind of what we're gearing up for right now. Everybody's quick to say there's not a huge correlation between ADP and Friday's number, but nonetheless, it looks like the markets have come to anticipate a negative print. Most of the analyst commentary is saying that this is just going to be transitory, not in the inflation sense of the word, but in the true sense of the word, I guess. Well, here you're seeing the Dow down just 2 basis points. We're going to call that break even. Nasdaq up just a few basis points, and the S&P 500 up about 0.33%. And let's just dive into some of our heat maps here. Pretty interesting sector action. Big standout is Google, Alphabet. That stock is up 6.5% to a record high. Let's just take a 1-year view of what the king of search has done. Now, this is a pretty interesting setup here. We have communication services getting a boost because Alphabet is part of that group. But you look at the sector leadership today, and after that, it's a little bit defensive. You can see real estate is in the top spot. That's up 1.5%. Also taking a look at utilities and staples and healthcare. So top row here, all the outperformers except for communication services looking a little bit defensive. And this is coming off of a pretty nice 3-day rally that we've had in a lot of those growth names that had been taking a back seat this year. Here's our travel page, and you can see a lot of red here, not too much dark red. That's centered in Southwest Airlines. They're down 3%, and then Airbnb down about 3% as well. Chinese stocks not doing well. I'm going to flip through a couple of heat maps pretty quickly here. We also have ARC Innovation Components. Those are flagging today after a nice 3-day rally. Semiconductors, not too bad. We do have the yield curve shifting lower just a bit. That's helping out some of these growth names here, but not all of them. AMD after earnings up 5%. Qualcomm also up 4%. And then Xilinx, which is being taken over by AMD this month, that stock is up about 5% as well. Let's take a look at the software space. We see more red than green here. Shopify getting a downgrade by, I believe it was Barclays. That stock is down 10%. It's had a rough go since December. Let's take a look at the 2-month price action. You can see that stock down about 0.4%. And then let's go to the pharmaceutical stage. You'll remember that healthcare was one of the outperformers today. Here we're seeing CVS up over 1%. The virus stock or the vaccine stocks like mRNA, that is down about 4%. Novavax down 9%. Going to kick it to you guys. Again, that ADP print causing a little bit of consternation, but it's all about the payroll report Friday.
Yeah, you get the sense that the White House is a little nervous about how those numbers could be interpreted on Friday. We're going to look ahead in just a bit. But Brian, I was going to start off the discussion by saying that big tech's giving a big lift to the Nasdaq, but we've seen it dip into the red, trading pretty flat right now. Alphabet certainly has been a big driver, at least early on in the session, coming on the back of better than expected results in Q4. The company beat on earnings and revenue and announced a 20-for-1 stock split. Revenue growth from its ad business as well as cloud, a big standout in the quarter, with cloud seeing a 45% growth. But ad revenue, Brian, on YouTube side, coming in a little below expectations.
Yeah, I mean, I think the street's reaction is positive just because of that large percentage growth that they had seen in their cloud business. And I think that's really where the growth story is going to come from. We know that the ad story has been part of Google's history for basically its entire company's existence. But I think that $5.5 billion quarter revenue just from its web services business is going to be really important because they still are dwarfed by Amazon's web services business when you consider that, again, Amazon hasn't reported yet. So if you take a look at the quarter four 2020 comps, for example, AWS was about 3 times the size on a revenue basis as Google's web services business. So they still have a lot of catching up to do. And really, this is just a sales business. But Google, I think, is also emphasizing in their earnings call that the story is not just advertising and then cloud for at least their current longer term vision. They also want to look at other types of innovations, which could include blockchain and even Web3. Take a listen to what the CEO said on the earnings call yesterday.
There's several areas of interest. AR is a big one at the computing layer. We've been investing there for a long time and will continue to play a role. And it's something both not just at the computing layer, the services layer, be it Maps, YouTube, Google Meet, etc. I think will contribute a lot. On Web3, we are definitely looking at blockchain and such an interesting and powerful technology with broad applications. So much broader, again, than any one application. So as a company, we are looking at how we might contribute to the ecosystem and add value.
Now, of course, on the surface, people might be wondering, why is looking at blockchain significant? Isn't every company, isn't every person looking at blockchain? Well, I think for Sundar Pichai over at Google, you do wonder, if they're teasing some sort of other big business that they could be launching. We know their approach towards Moonshot, throwing everything at the wall to see what sticks. And maybe that's a big story why there's some optimism on the street over their ability to continue to grow in the decades to come, Akiko.
Yeah, and why they break out the big bets in their earnings results. Should note, by the way, YouTube, 15 billion views daily. If you look at the sales numbers from last year, $28.8 billion. That is, by the way, 850 million short of Netflix. So continuing to sort of, chip away at the lead that Netflix has had. But let's talk about another stock, Brian, that is going in the opposite direction, and we're putting that lightly here. Let's take a look at shares of PayPal. PayPal just plummeting in the session here. The results were mixed for the company, but this is really about the guidance, the outlook coming in weaker than expected, and the company partly blaming this on inflation.
Yeah, what is interesting, though, is that it's not because necessarily inflation is too high. I would argue that it's actually because maybe they see inflation coming down in the future. So I want to kind of walk you through this because this is really, really interesting from my perspective. Obviously, when you take a look at their revenue and their bottom line numbers, pretty much everything was in line. But higher payments volume is good for PayPal, right? And that means that when inflation is happening and people are paying higher prices, that's really good for the business. That's a larger transaction fee that they get to rake in. Now, what's interesting is PayPal said on their earnings call that there's a suggestion that the demand curve, which is just kind of the economic term for that inflection point where prices are so high that consumers start to say, okay, you know what, I can't feed this beast anymore. I don't really need this, especially at the high price point that it's at. I'm just simply not going to buy this. Well, that's starting to happen. And that means that payments volume could start to decline here, which of course will be bad for PayPal. Now, whether or not that warrants the massive decline that we've seen in the stock this morning is one question. But on the other hand, on a macro scale, again, I'm kind of the macro guy, this could be a good thing because it's showing signs as of the end of last year. This isn't even January data, right? This is the last 3 months of 2021, showing that maybe consumers are no longer wanting to feed this demand to higher price increase beast, which could suggest from an anecdotal standpoint of perhaps a peaking in inflation. Of course, we'll see if other quarters kind of bear out the same, Akiko.
Yeah, and as we see PayPal falling more than 25% in this session, we're also looking at Block, of course, formerly known as Square, as well as Buy Now, Pay Later, Affirm, both down on that news. So something to be watching. One other stock that's a big mover in the session today is AMD, getting a big lift on strong guidance. The chip maker now saying it expects sales to hit $21.5 billion this year. That would mark a 31% jump from numbers from last year. The company's computing and graphics segments continuing to be the big driver in the quarter, with revenue growth up about 32%. The company also making some big gains in chips for cloud services as well as game consoles.
Yeah, we've got a pair of great analysts later on in the show to talk about this, but I think what is interesting is, of course, just the commentary on the supply chain easing, because that was the story through 2020 and 2021 as well. It's just the inability to get the chips out there. Whether or not that's been alleviated has been a lingering question for the last 4 or 5 business quarters, but Lisa Su over at AMD saying on the earnings call yesterday that they feel very good about their progress and, quote, our goal is frankly to have enough supply to satisfy the demand out there. So the story not quite done. But Akiko, I know you watch the chip space very closely. Very much still kind of refs are out there and the court's still out there on whether or not the supply chain nightmare is truly over just yet.
Yeah, one other name we're watching alongside AMD today is Xilinx, because we did just get that news of the approval coming from Chinese regulators of this AMD acquisition of Xilinx. We've seen that stock move higher as well, and that acquisition now expected to be completed in March. So certainly good news for AMD on that front. Let's bring in our first guest for the hour. We've got Scott Kessler, Third Bridge Global Sector Lead for Technology Media and Telecom. Scott, we just kind of walked through the numbers on Alphabet. What stood out to you?
Well, thanks a lot for having me. Look, this is a company that generated $250 billion in revenue and saw an increase of well over 30%. That's largely organic revenue. Obviously, I think some of the comparisons benefited from what we saw in the prior year in 2020. But I think it's fair to say that this is a very strong and healthy business. Obviously, I think a lot of people were focusing in, as you were talking about, regarding Google Cloud and Google Cloud Platform, indications of mid 40% growth. Again, healthy to strong. However, I'd point out that Microsoft talked about Azure revenue growth that was very comparable. And not only is AWS, as was referenced earlier, much bigger than Google Cloud Platform, but actually you have Azure much bigger as well. And so the fact that they're growing at comparable rates means that they're really not gaining share against Azure, a much bigger competitor.
Hey, it's Brian Chung here. So on that point, Scott, I mean, have we reached already a maturity in the market where we shouldn't expect to see Google kind of very largely gain any more market share here? I mean, it seems to me at this point that the cloud services business is really all about how aggressive your sales team is.
Yeah, and actually it's a good point, Brian, right? So I think Alphabet made the point of indicating that they've tripled their sales force since 2019. Obviously, look, we're talking about a lot of people who are committed to trying to unearth revenue opportunities, whether it's new or existing business opportunities, especially with respect to Google Cloud and Google Cloud Platform. Look, I mean, they have single-digit market share in this category. And even though I think a lot of people understandably are applauding Alphabet's results, I think they need to consider structurally kind of going forward how they get that market share significantly higher, because it doesn't seem like AWS or Azure, the parent companies, obviously talking about Amazon and Microsoft, they're not taking their feet off the pedals, so to speak. And so really, it's going to be interesting to see how the market share kind of shifts just among those companies. There's no question that, when you look at Google Cloud and Google Cloud Platform, they're gaining share overall, but not necessarily significantly from the two big players ahead of them in this marketplace.
You know, Scott, this comes at a time when we've seen a big sell-off in tech names. It felt like Apple's results last week kind of calmed the waters a bit. You've got good numbers from Google coming out, Meta reporting after the bell today. Have we seen that the worst of those declines? And yes, I'm kind of asking you to call the bottom here, but in other words, is the narrative from the earnings calls or just the results starting to take shape again, as opposed to these jitters around what these interest rate hikes are likely to mean for these high growth companies?
Yeah, I mean, look, it's the question everyone's thinking about. And going back to Azure, I think folks started to kind of become maybe reasonably more optimistic when last week Microsoft indicated that they were expecting acceleration in Azure growth on a sequential basis. Suddenly, then people started to feel more comfortable. You mentioned, I think, some other companies. Apple, obviously, increasing revenues at a double-digit rate, I think was encouraging. You look at a company like ServiceNow, I think as a cloud-focused SaaS company, they delivered results that people perceive very positively. Also, a number of semiconductor companies have offered some positive news over the past week. So I think there are a number of reasons to be optimistic. One thing that I would look out for, though, is we have Meta Platforms and Snap coming up. And those companies, more so than, say, Alphabet, have been affected by Apple's IDFA changes. And so I think some people might be well kind of served by being, a little bit more cautious, because I think there's a little bit more in terms of what's going to go on there from a negative impact to those types of businesses. Alphabet isn't as influenced. Google isn't as influenced by those changes for a variety of different reasons. And the advertising business actually outpaced overall company revenue growth. So that's noteworthy. I guess the one negative I would point out for Alphabet / Google, other than maybe a tepid one when we're talking about kind of cloud performance relative to competitors, is really the legal and regulatory backdrop, where we've talked to experts day in and day out, and they tell us that Google, Alphabet, they're more exposed from a U.S. antitrust perspective to risks and possible changes than maybe any other big tech company. People aren't thinking about that at this moment, but they should keep that in mind.
Well, Scott, we've been talking a lot about the regulatory headwinds with regards to maybe trying to break up these large companies. But I guess something more tangible and maybe a more relevant discussion might be, how does this impact any sort of strategic visions that some of these large tech companies might have with regards to further M&A? Do you see any appetite from the like of Google, Alphabet that might have ambitions to buy another company but simply won't do so right now or wants to sideline themselves because of the regulatory headwinds out of DC?
Yeah, so Brian, short answer is yes. We hear that all the time, frankly, from the industry experts that we speak to. The reality is that these companies make a lot of sense as acquirers for a lot of companies and businesses, especially given the reduction in valuations we've seen over the last couple of weeks and months. But the reality is that there is limited appetite to deal with some of the legal and regulatory issues. Alphabet yesterday touched upon Fitbit and some of the benefits of that acquisition. That was a pretty small deal, and it took a pretty long time to complete. So what I thought was interesting is it seems like Alphabet is, well, maybe not doubling down in a literal sense, but they talked very specifically about the fact that CapEx has been around kind of 20 to 25 billion for the last few years, and they expect a substantial increase in that number in 2022. They went through a number of different areas where they look to invest. So expect more internal type of investment. Last year, they talked about $7 billion being committed to expanding offices and data centers in the US. They're going to be spending a lot of their own money on a lot of initiatives, moonshots or otherwise, to kind of move the company forward.
All right, moonshots remain the key. Scott Kessler, Third Bridge, Global Sector Lead for Technology, Media, and Telecom. Thanks so much for stopping by this morning. Well, we got some breaking news for you in the media world. Jeff Zucker announcing his resignation from CNN. In an email to staff, he said his departure is tied to a revelation of a consensual relationship he had with a colleague that he did not report to the company as he should have. He was asked about the relationship as part of the investigation into Chris Cuomo. Zucker was expected to stay on through the merger of Warner Media with Discovery, which is set to close this year. Well, coming up on the other side of this break, a new grind for Starbucks. The coffee chain giant is hiking prices again, due in part to supply chain woes and rising inflation. We'll have the details on the latest earnings results straight ahead. Well, coffee giant Starbucks reported earnings last night. They missed estimates on the bottom line, but they did record revenue that was slightly higher than the expected number at $8.1 billion. We've got Yahoo Finance's Brooke De Palma here, who had the chance to chat with the CEO, Kevin Johnson, following the earnings call. So, Brooke, tell us about exactly what impacted the quarter, according to Kevin.
Brian, these earnings results were largely based upon the impact of soaring inflation, supply chain, and staffing shortages that hit the restaurant industry at large. But Kevin Johnson did tell me that Omicron really amplified the effects of all those things. With the rise in cases, the COVID benefits that Starbucks offers, including isolation pay for any partner that is exposed to COVID or tested positive, spiked last quarter. Now, take that and combine it with third-party providers that do daily store deliveries, also running into staffing shortages, forcing what Kevin said, the company having to do more, go to, quote, the spot market and pay for transportation delivery to allow the company to meet the higher demand that it saw this recent quarter. In the earnings call,
we anticipate supply chain disruptions will continue for the foreseeable future. We've already taken pricing actions this fiscal year, one in October of 2021 and another in January of 2022. And we have additional pricing actions planned through the balance of this year, which play an important role to mitigate cost pressures, including inflation, as we position our business for the future.
Now, Kevin did tell me that higher price costs is determined by AI analytics and the team who is monitoring to make sure that these higher costs are being well received by customers. But those price hikes will take effect into the back half of the fiscal year. He said notably the spring or the summer for the next action. But I do want to note that we did see a beat on the top line here. Like you said, Brian, customer demand is what Kevin said, very strong. According to Placer.ai, monthly visits were up in October, November, and December. But overseas, it was a bit of a different story. The zero COVID-19 policy in China certainly took a toll on international sales.
Brooke, Kevin Johnson is certainly facing internal pressure right now as well, with employees in nearly 20 states now pushing to unionize. What did he say about that, and specifically how that's likely to weigh on the company?
Akiko, that's a great question. You know, he did emphasize that only 2 company-operated stores are certified unions, and that roughly 50 stores have yet, or rather filed petitions to the NLRB to go through the process to see if partners in those stores want to vote to union. He said, quote, "We're following the NLRB process and we respect that process and we'll continue to do that." But he did mention that they have a few thousand stores in our China licensed partners, like many of the big grocery channels, for example, that have a Starbucks within their grocery store that are unionized. So we've got experience with our licensed partners and how they run unionized stores. And at the end of the day, we always listen to our partners. We always will, whether they're a union store or not. Now, those licensed partners include Kroger, Target, Safeway, Albertsons, among others. And he did mention that $1 billion investment in wages made back in October that brought the average hourly rate to $17 an hour, with hourly wages from $15 to $23. But Akiko, there's a long road ahead of what this unionization efforts may look like. On February 23rd, the count for more than 3 stores in Buffalo is set to take place. So it'll be interesting to see how this plays out for Starbucks as they continue to work with partners, as more look to unionize and more stores potentially make a move to vote. Akiko?
It's certainly a story we'll be watching. Brooke De Palma, thanks so much for bringing us that. Coming up, Build Back Better hits a wall with the latest. We've got the latest developments as Senator Joe Manchin, a key swing vote, says the plan is dead. We'll be right back. Well, President Biden's domestic agenda may be in jeopardy with West Virginia Senator Joe Manchin, who is, of course, a key vote, declaring the roughly $2 trillion social and climate bill, Build Back Better, is dead. Let's bring in Yahoo Finance's Rick Newman. Rick, I feel like we've had this conversation before. What was it, a month ago when the senator said he just can't get there? I mean, what's actually changed? What's different this time around?
A strange sense of deja vu, huh? Right. So Manchin is just reinforcing what we already know. Manchin, at the end of 2021, he said he cannot vote for the so-called Build Back Better legislation because it was just too expensive. It had some budget gimmicks he didn't approve of. So that ended it right there. So the talk for now for 2022 has been, well, can Democrats start over and can they salvage part of this? And basically what Manchin recently said is, we got nothing right now. So I guess that means Democrats are going back to the drawing board on the Build Back Better plan. And there's another interesting wrinkle here, which is Senator Lujan of New Mexico, who just suffered a stroke. He's in the hospital. And until he returns to the Senate floor, that means Democrats don't even have a majority in the Senate right now. So if they had a bill that all Democrats agreed on, they still couldn't even pass it if all Republicans oppose it, because they only have 49 votes right now. So Democrats need the senator from New Mexico back in the Senate in order to pass anything, even with that one vote majority with the vice president breaking a tie. So the Democrats are not looking likely to have anything they're able to pass within the next few weeks.
Now, Rick, I guess the optimism, though, is that they'll be able to kind of carve this thing up like a Thanksgiving turkey and kind of get individual provisions of this along a bipartisan basis, even if you lose that one Senate vote. Climate appears to be one of these things where, at least in the House, there's a number of Democrats that are trying to get something to kind of get passed to reduce emissions. Do you see that getting kind of through, or is this just kind of cherry picking and that, honestly, this is all just kind of a shot in the dark still?
I mean, you highlight one of the problems with the original Build Back Better plan, which is there was just too much stuff in it, a huge variety of stuff, and voters really had no idea what this bill was about. So there was general support for the climate provisions in that bill. So that was over $500 billion in green energy investments and tax credits for wind and solar and electric vehicles and things like that. That could... remember, it's not a question of passing the House. That's the easy part. It's whether they can get every single Democrat in the Senate to vote for this. Joe Manchin did not really object to the climate provisions. It was the social welfare provisions, and in particular, another extension of that child tax credit for another year or 3 years or 5 years, whoever what Democrats wanted to do. That was his main objection. Manchin has not given a blank check to the climate provisions, but that might be easier to get him on board. So if Democrats can get organized and stop chasing legislation that has no chance of passing, as they did recently with this voting reform bill, then maybe they could pull something together on climate. But look, the Democrats look disorganized right now, and I would not give better than even odds that they could even pass a smaller bill with those climate provisions at this point.
Yeah, I mean, $550 billion is the price tag we're seeing for climate provisions in that larger bill. So it's not necessarily a small price tag, but we'll be watching to see if, in fact, they go that route. Rick, thanks so much for bringing us that story. Okay. Well, that is one of many issues that lawmakers are addressing in this session. One of the big ones that has received a lot of bipartisan support here, banning individual stock trading of lawmakers. Our editor-in-chief, Andy Serwer, spoke with New York Congresswoman Alexandria Ocasio-Cortez, who has been supportive of that legislation. Why she says that lawmakers could still face an uphill battle in getting that legislation passed. Take a listen.
It's not really a mystery to me why it's difficult to pass. An enormous amount. I wouldn't be surprised if it was a majority of members of Congress hold and trade individual stock. I don't know the actual numbers, but it is a very large degree. And you know, the key here is that it's not to say that you can't have a retirement fund or a college savings account.
Or a blind trust.
A blind trust, right. a mutual fund, an index fund. These are vehicles of investments that are broad that individual members of Congress don't have direct control over. But even last year, there was at least 75 members of Congress that held individual stock in Johnson & Johnson, Moderna, and Pfizer. And we're talking about in the last 1 to 2 years. And so that is where we should be drawing the line. I am a member of Congress. Members of Congress have access to very sensitive security clearances. We have access to very detailed, tailored briefs. Our job is to try to anticipate and legislate for what we see is coming. And we should not have the ability to both have access to that information and be able to hold and trade individual stock. And that's really what this is about. It's about our ability to direct and hold trades in individual stock with access to the sensitive information that the public has given us.
And you can, of course, catch the full conversation there on our website at yahoofinance.com. Coming up, Tonga goes into COVID lockdown, the latest hurdles for the island nation straight ahead, and much more in our worldview after this break. In our worldview today, the U.S. is sending advanced fighter jets to the United Arab Emirates as Yemen's Houthi rebels threaten to step up attacks against the country. The Pentagon has announced it is also sending the USS Cole to the region while continuing to share early warning intelligence identifying Houthi launch sites. The deployment comes in response to several drone and missile attacks on the UAE last month with the rebels backed by Iran. The country is part of a Saudi-led coalition that has been locked in a 7-year war to remove the Houthis from power. That's resulted in what the United Nations has called the largest humanitarian crisis in Yemen. New COVID infections in Tonga have forced the island nation to go into lockdown after remaining virus-free throughout the pandemic. 2 cases were reported among employees working on the waterfront, where foreign aid has been pouring in following that volcanic eruption and tsunami last month. Officials say there's no reason to believe the cases are connected to incoming aid workers, though an Australian naval ship reported 23 COVID cases on board. The local government is pushed for contactless delivery to minimize infections. More than 80% of the population has been fully vaccinated so far. And Beijing officially kicked off its Olympic torch relay overnight with just 3 days to go until the opening ceremony. Former speed skater Luo Jiwan ran the first leg at the Olympic Foreign Park in downtown Beijing. The event was dramatically scaled back because of concerns of COVID infections. The relay will pass through 3 Olympic zones before it makes its way into the opening ceremony on Friday. Spectators have been banned from all events over the 2-week event. Coming up, crypto regulation back in the crosshairs. We're going to reveal the latest country that is gearing up to tax the digital asset and create a virtual form of its fiat currency. That's up ahead.
The world's second largest country, that's India by population, is announcing a big tax on crypto assets as it looks to launch its own digital currency. And in the world's first largest country by population, that's China, they're making the global unveil of their digital yuan at the Olympics kicking off this week. So here with more on all the global developments is Emily Parker, CoinDesk Global Macro Editor and CoinDesk TV anchor. Emily, give us the breakdown on exactly what's going on overseas.
Thanks, Hugh. Yeah, so India is a really interesting story. So they basically just announced that there will be a 30% tax on income related to crypto transactions. Now, on the surface, this may seem very ominous because 30% is obviously a large number, but some people are taking this as a positive side because they wouldn't tax something that's about to be banned, right? And there have been rumors of an Indian crypto ban floating around for quite some time now. So you could kind of look at this one of two ways. Either this is a high tax or this is an acknowledgement by the Indian government that crypto is here to stay and they're going to try to collect taxes from it. So some people see it as a positive sign that this is India's government saying we are not going to ban crypto outright.
So Emily, we're talking.
Go ahead, Akiko.
We're talking about India, but let's talk about what's playing out in China. As we've been talking about over the last several months, We've got the Olympics opening ceremony kicking off on Friday. This was supposed to be the big international unveil of their digital yuan. It hasn't actually worked out the way they thought, in part because international spectators aren't coming into the country because of COVID rules.
Absolutely. So I'm really curious to see how this plays out. You're right. There have been stories about this for a long time now, that the Beijing Olympics were going to be sort of the international showcase for China's central bank digital currency, being used as a means of payment by athletes or spectators and others. But now, because of COVID, Beijing Olympics, the scope of it has been tightened quite considerably. So we probably will not see a launch at the scale that had been anticipated, but we probably will see something related to China's central bank digital currency, because this has been anticipated for such a long time now.
I want to shift gears to the United States here, because some pretty interesting news this week that Facebook's cryptocurrency project, it was Libra at one point, and then it changed to Diem, and the wallets were all called different things, is apparently no more. Apparently, due to regulatory pressure, Diem, Facebook, will be sold to Silvergate for $200 million. Give us a little bit more about why this happened. Was this all just a massive waste of time for Meta, whatever they're calling it now?
You're right. As you say that, I realize there has been so much rebranding. It was Libra, and then it became Diem. And this isn't accidental. A lot of this rebranding had to do with the fact that Facebook is such a liability, right? I mean, people just don't trust Facebook. Regulators don't trust Facebook. Consumers don't trust Facebook with their data. And so, yes, there's been a lot of rebranding and an attempt to divorce this incredibly ambitious cryptocurrency project from Facebook itself. So first it was Libra, it didn't have Facebook in the name. And then even Libra was too associated with Facebook, so it became Diem, and now Diem is officially dead. And I think some of this has to do with regulatory nervousness about stablecoins, but a lot of it has to do with nervousness about Facebook itself, because Facebook has had so many scandals related to overreach and data protection. Now, was it a massive waste of time? I'd actually argue that it was not a massive waste of time, only in the sense that it's had a ripple effect throughout the world. Even if you look at China right now, the leading central bank digital currency projects, I think that was many ways inspired by Facebook's efforts. They said, oh, if they're doing it, we better do this fast. And then I think a lot of other countries looked at China and said, okay, we should do this as well. So I think in a funny way, even though that initial Diem project failed, it had a ripple effect throughout the world.
Yeah, and even the Federal Reserve noted by name Facebook when they were talking about the idea of perhaps launching their own U.S. digital dollar. But I guess one final short question here is this kind of a warning shot across the bow from regulators here in the United States that could really disincentivize the other big tech companies for wanting to do the same?
Yeah, yes, I think you could say that it is. I mean, look, the one thing that, Libra, that became Diem, the one thing that they did is that they did actually try to work with regulators throughout. They didn't try to do this behind the scenes. They weren't trying to do some shadowy project. They were really pretty above board in working with regulators, and it still got shot down. So yeah, I think that will make some projects nervous. Projects who are thinking, okay, I want to go through the front door, I'm going to go talk to the SEC. You realize that even if you try to work with regulators, it's not necessarily going to work out.
Emily Parker, as always, good to have you stop by, CoinDesk Global Macro Editor and Anchor. Well, coming up, Brian Flores versus the NFL. We are breaking down the legal developments after the former Miami Dolphins head coach filed a lawsuit against the league and 3 teams alleging racial discrimination.
intended to, give minorities an opportunity to sit down in front of ownership. But I think what it's turned into is an instance where guys are just checking the box.
Well, that was Brian Flores, the former head coach of the Miami Dolphins, on CBS this morning discussing an NFL rule that requires teams to interview at least 2 minority candidates for open positions. In a class action lawsuit filed Tuesday, Flores accused the NFL and 3 teams of systemic racism, alleging the league discriminated against him and other Black coaches in its hiring practices. The NFL has responded. Let's take a look at what specifically the NFL has said in response, saying the NFL and our clubs are deeply committed to ensuring equitable employment practices. Diversity is core to everything we do, and there are few issues on which our clubs and our internal leaders team spent more time. We will defend against these claims, which are without merit. Let's bring in Patrick Risch, Washington University in St. Louis Sports Business Program Director. He's also the founder and CEO of Sports Impacts. Patrick, there's a number of allegations here we haven't even mentioned. Specifically, he, as in Brian Flores, talks about a recent interview that he conducted with the New York Giants for the head coaching position, which he says was essentially a sham, so that the team could just tick off the box that they had, in fact, interviewed a minority candidate. Number one, what's your response to these allegations, and what does it tell you about how effective or ineffective the Rooney Rule has been?
There's a lot of directions to go here, Akiko, and thanks for having me on. First of all, we have to give Coach Flores a lot of credit for having the courage to come forward and bring this lawsuit, certainly when he currently is a coaching candidate for a couple of the open coaching positions that are still out there for the NFL. So we give him considerable credit. And my hope, big picture, is that this is going to spur action. Whether or not he wins this lawsuit remains to be seen, but I hope it's going to spur action. As it relates to the Rooney Rule, if we step back, we have to say, look, the intent of the Rooney Rule was well intended. They were trying to create greater opportunities for Black coaches, minority coaches, to be seen, to be heard, and to be in this hiring cycle. They tried to reinforce this Rooney Rule recently by requiring them not to speak with just 1, but 2 Black assistant coaches in the process of hiring a new coach. But I understand the frustrations, and this point that you raise, Akiko, with the New York Giants in particular. Brian Flores' commentary on this is not the first time that a Black coach has been frustrated with what they felt they were just checking the box, as Brian said. And it was just because Bill Belichick made a mistake on a text message that we actually have the evidence. I think the other team that was mentioned in this allegation, the Miami Dolphins, if his claim that the owner of the Dolphins, Stephen Ross, actually essentially tried to bribe him to lose games so that the team would have a better draft position, that has even further reaching consequences that I think would be severely punished by the NFL.
Yeah, Patrick, it's Brian here, and that's pretty substantial because a lot of people were wondering why someone who was able to win 8 of the last 9 games would be dismissed, and that seems to kind of show the tension there between Flores and the owner. But I want to come back to the Rooney Rule because this is just so interesting from a legal standpoint, and I'm no lawyer, but what's interesting is that beyond just the effectiveness of the Rooney Rule and actually improving diversity in the NFL, which everyone says is much needed, I guess would this lawsuit even have any merit if it weren't for the fact that the Rooney Rule existed? Because if anything, that codifies the ability of a person to then bring this to a court and say, look, it's written right here, you have to comply with this, and you might have on paper complied with it, but you're not really doing the spirit of it. Doesn't that actually maybe reinforce the need for further codification and further rulemaking for these types of things?
Well, Brian, I think, first of all, if the NFL wants to enforce the Rooney Rule going forward, they need to swiftly and severely penalize the teams that are just checking the box and not giving some of these minority candidates a real shot. And that penalty could be loss of draft picks, serious fines, or in an extreme case, preventing an owner to be affiliated with the team and their team facilities for a year, as happened a few years ago in a different case with respect to the Indianapolis Colts. So there are ways that the league, if they want to be strong-armed about this, they can do something. But to your question, Brian, I think that if the evidence existed, certainly it helps to have the Rooney Rule there in terms of its impact in the court. But I think if there's discrimination, whether there is a Rooney Rule or not. So, but at any rate, again, what's very fascinating about this whole analysis, and since this went down yesterday, I started looking at the data. So interestingly enough, though there is only currently one Black coach out of the 27 teams that currently have a coach, there's still 5 teams that are looking for a coach. Did you know that if we expand the search to all coaches, assistant coaches, as well as head coaches, the assistant coaches, 36% of those coaches are Black. And on the defensive side of the ball, you actually have 40% of your defensive coordinators are Black and 52% of your defensive assistants. So it isn't so much a pipeline issue on one side of the ball, but this is a league that is now becoming more offensive. The 2 coaches featured in this year's Super Bowl, were kind of marketed as these wonder kids, offensive geniuses, but there are fewer Black coaches on the offensive side of the ball. So that's where the pipeline really needs to improve because of the direction that the sport is going.
Patrick, we're talking about the NFL today, but I wonder if this speaks to something larger, because in terms of the Rooney Rule and the requirements, we've sort of seen something similar in corporate America too, right? Where there are requirements, for example, of diversity on the board. California is one state that has made that a requirement. In many ways, the criticism has been that if you make that a requirement without executives, owners really grasping the problem at hand, it doesn't move the ball in terms of the understanding for the need for diversity. It's just another box that's ticked. Do you see other solutions, other discussions that could come from this specific lawsuit that could maybe actually move the needle in a tangible way?
So there's 2 responses, Akiko, to your question. First of all, is I do think that just simply because of the sheer visibility and popularity of the National Football League, it has become America's national pastime. It is a multi-billion-dollar industry. There's no question that the high-profile nature of this Brian Flores lawsuit is going to be an eye-opener, not just within the NFL, not just within professional sports, but across all of human resource decision-making in America. There are going to be companies and leaders that need to recognize and be aware of this. So that's the first thing. But in terms of an actionable, what else can we do? I think that having rules like this and getting people into the hiring, the interview pipeline, that is, first of all, a necessary step. But as you suggested or alluded to, it isn't necessarily getting us across the finish line to getting a higher representation of Black coaches in football or better minority hiring in the general public. But what is the answer? That is such a difficult question. Are we now going to mandate a certain percentage of people from different ethnicities in certain roles? I don't know where or how you can do that legally. And that's where I, like many, are frustrated with how to move forward.
And lastly here, I want to ask about just kind of the broad NFL here. We know that this season has indeed gotten a lot of viewership towards the end because of those big games during the divisional round. And we know that the numbers have been pretty good compared to past seasons, which have slumped a little bit. Do you think that this controversy, which really extends to multiple fronts here and really extends to a management problem at the highest level for some of these clubs, does this damage the NFL, especially with the Denver Broncos possibly becoming a huge blockbuster sale if there is someone that wants to take that up?
For better or for worse, and I don't know what this says about us as a society, but at the end of the day, while I think most of us will want to see greater equity in hiring, it isn't necessarily going to determine whether we turn that Super Bowl on in 2 weeks. I think most people are still watching the Super Bowl regardless of this particular topic. Again, doesn't mean that many of us and most of us, I hope, would want to see greater equity and diversity in hiring, not just in the NFL, but across the board. But that's not going to stop us necessarily from watching the games on Sunday or certainly the Super Bowl in a few weeks.
All right, Patrick Risch, Washington University in St. Louis, Sports Business Program Director and Sports Impact Founder and CEO. I feel like the story is far from over, so we'll definitely have to have you on as we get more updates. Thanks again.
Thank you.
Coming up on the other side of this break, AMD is soaring after blowout earnings results from the chip maker. 2 analysts will join us to discuss the road ahead for the semiconductor company after delivering a robust sales forecast for 2022. Welcome back to Yahoo Finance. It is just after 12 p.m. here on the East Coast. I am Brian Chung, and that is Akiko Fujita. And we are here to shepherd you through the next hour of trading. But let's take a look first at where markets are as we get deeper into the afternoon trading session. Taking a look at the S&P 500, which is currently up about 0.3%, but the Dow just barely above where it closed yesterday, and the Nasdaq down about 0.15%. So we'll see if the market action revs up in either direction, but it seems like just kind of on the flat line as the 10-year bond down about 5 basis points to 175 basis points. Well, we'll take a deep dive into chips after AMD's blowout earnings report yesterday. The prevailing question, has the worst of the strangled supply chain finally passed, or is Omicron ready to wreak more havoc? We'll have two analysts side by side to help us answer those questions. And yesterday marked the first day of Black History Month. We'll chat with the CEO of Revolt Media, a Black-owned media outlet founded by Diddy, to talk about how hip-hop factors into the cultural push for social justice. First, though, AMD stock ripping higher after reporting earnings last night. $4.8 billion in revenue on the top line for bottom line earnings per share of 92 cents. You could see shares ripping higher today, up about 4.5%. We've got a pair of analysts here to break it down for us here on Yahoo Finance Live. We've got Abhinav Davaluri, Morningstar Technology Equity Strategist, alongside Christopher Rowland, Susquehanna International Group Senior Equity Analyst for Semiconductors. Gentlemen, it's great to have you on the program this afternoon. Christopher, let me get started with you first. Obviously, the earnings numbers coming in above estimates, but the lingering question remains, can the supply keep up with the demand through the rest of 2022?
Yeah, and AMD has been extremely proactive in both working with and financing a lot of their supply chain partners here. So they are in better shape than many of their counterparts. we do think they are ultimately going to be successful in that quest, but we are seeing some pushback, I would say, in the March quarter here, particularly around PC products and then their ongoing console relationships as well.
Abhinav, we heard Christopher in his report say things are pretty much perfect there, but I wonder what you see as the biggest downside risk when you think about, number one, the supply chain issue that Brian just highlighted, but also just the competition. I mean, clearly AMD really, hitting on all cylinders in the quarter, but certainly they've gotten, some headwinds here from competition in the space.
Yeah, competitively, it's a pretty interesting picture. I mean, normally it's Intel that's seen as the main competitor. They've obviously had a lot of manufacturing issues, and those are expected to continue at least for the foreseeable future. But that said, Intel's new CEO, Pat Gelsinger, has a pretty interesting plan put in place, IDM 2.0, to kind of get their internal manufacturing back on track, but also outsourcing some parts to TSMC that obviously makes a lot of parts for AMD. So it could be interesting to see how that battle kind of wages. Both firms have some impressive products in the pipeline coming out later this year that I think will definitely create a pretty intense pricing environment. So that could be some pressure that AMD faces later in this year.
Abhinav, does that pressure threaten the improvement that we've seen in gross margin? Because AMD, this caught my eye, gross margin 50%. That's an increase of more than 5 percentage points year over year. But at the same time, this is coming at a time where across industries, labor costs are going up. So if pricing pressure on the actual top line as well is going to be getting more competitive, might that compress in the quarters to come?
Yeah, I mean, if there was one blemish on AMD's guidance amidst all the strength and the positivity, it's probably that gross margin outlook, which is 51% expected for 2022, juxtaposed with 50% in Q4. So, I mean, we were expecting that margin to improve a little bit higher, especially with the mix shifting more to margin accretive data center products. So what that tells us is exactly your point. Maybe they're seeing higher wafer costs from TSMC. Maybe they're going to expect some, increasing pricing headwinds that pressure margins there as well. So, yeah, I mean, at the same time, management could have just kind of given a more, I guess, achievable target to kind of hit that, they might be able to easily surpass in the coming quarters.
Christopher, we're seeing shares of Xilinx again in the session today as well. The timeline here in terms of the acquisition for Xilinx now expected to be completed in March. Now that we've got the Chinese regulators giving that green light, to what extent does that accelerate revenue growth for AMD?
We think it's an excellent acquisition by AMD, particularly because this COVID supply chain kind of nightmare has hit Xilinx particularly hard. We track lead times very closely, and lead times for Xilinx products are in the 70 or 80 week range. They've just ballooned during COVID. And we think AMD, with some of the investments that we just talked about in the supply chain and their supply chain partners, we think that they will be able to get a better handle on these lead times and ultimately ship more product. So we're at this point quite bullish on this passing regulatory muster. We think we could even see this happen in the next few weeks here. AMD said by the end of the quarter would be their expectation. We think it's going to be ultimately highly accretive, highly strategic, and just a wonderful acquisition for AMD.
Christopher, I want to ask you about another chips company that has yet to report, Qualcomm. Of course, we're looking forward to their earnings report. You expecting to see something similar from AMD, or you expect maybe some of the anecdotal issues that they've been dealing with to weigh on their numbers as well?
Qualcomm also has a very good supply chain. They've worked extremely hard at it. Qualcomm is a company that is in some ways reinventing itself under new leadership under Cristiano Amon, and they are diversifying away from just mobile products. For example, the Oculus headset, which was a big Christmas and holidays seller, is powered by Qualcomm. They're also moving into auto, RF, all these other areas beyond just mobile. So their prospects, in my opinion, are quite bright. The only drawback for their report tonight is basically that most of their revenue comes from mobile, and areas like China have seen perhaps a little bit weaker than expected sales in terms of handsets on that side. And Qualcomm still is first and foremost a mobile company. But overall, the long-term story we think is very, very positive.
And finally, Abhinav, when you look at the chip space broadly, there is an aggressive push from the White House to bring manufacturing back here to the U.S. You mentioned Intel being a big competitor to AMD. They've made some big headlines on the back of factory announcements. They plan to open in Arizona as well as Ohio. Long term, which one of these chip makers do you think is best positioned given this push to bring things back home?
Yeah, I mean, it's interesting. Most of the companies listed there do not have, kind of the manufacturing facilities. I think all of them are going to benefit to some extent from just the broader demand push, whether that's AI, 5G, cloud computing. All of them have some exposure there. But in terms of just benefiting from semiconductors as a whole, and whether that's domestic manufacturing or not, I mean, I think NVIDIA is pretty clearly the one that has probably the rosiest prospects, and I think the market appreciates that. Whether it's its dominance in artificial intelligence or potentially autonomous vehicles or even the metaverse with its kind of omniverse offering. So yeah, I mean, even if the domestic chip making becomes more significant and gets that government funding, we would expect a company like NVIDIA to basically benefit regardless. And having more options to get your chips made, right now NVIDIA gets most of its chips made at TSMC, some made at Samsung. But if they have Intel kind of entering the fray and having a meaningful competitiveness in the foundry space, that certainly helps fabless companies like an NVIDIA, like a Qualcomm, to kind of have multiple options to get their chips made and help from a pricing standpoint.
More options always better. Abhinav Davuluri over at Morningstar and Christopher Rowland over at Susquehanna International Group. Thanks so much for breaking all of that down for us. Well, let's take a look at what markets are doing, because things have actually tilted up a little bit over the last, let's say, 7 or 8 minutes. All of the major indexes now in the green. So let's get an update from the Nasdaq, where we find Yahoo Finance's Inez Ferre, who's got the update on some trending tickers this afternoon. Inez?
Yeah, Brian, and just taking a look at the sectors right now, we are seeing communication services, which is in the green, and then you've got more of the defensive sectors that are in the green. You've got real estate and utilities as well. Let's take a look at our Wi-Fi interactive board so we can show you the Nasdaq 100, because we have been taking a look at big tech. Of course, Alphabet, after its blowout quarter, up more than 8%, and that announcement of a stock split. And taking a look also at another name today, Netflix, down 5%. This has to do with YouTube's performance for last quarter, with its ad revenue coming in at $8.6 billion. That's higher than Netflix's revenue last quarter of $7.7 billion. Something interesting also to note that on the earnings call last night, also management talked about YouTube's revenue growth and testing commerce, that could be a big opportunity going forward. Also taking a look at Meta, which will be reporting its quarterly results today after the close. That's up more than 1%, and Amazon tomorrow will be reporting its results, down 0.7%. Some analysts are saying that Amazon's underperformance, that valuation is a good entry point for Amazon. In fact, there are 59 analysts that cover this stock, and all 59 of them have a buy rating on the stock, and the average price target is $4,100. Year to date, the stock is down more than 9%. I do also want to mention Tesla, which we've been watching also this morning. Tesla down almost 3%. In fact, let me pull up the electric vehicle space, because we are seeing quite a bit of red here in the EV space. You're looking at Lucid, that's down more than 6%. Also, Rivian is lower today as well. I do want to mention a headline from Electric, actually, about QuantumScape, about some progress with its solid-state batteries that can charge in 15 minutes through 400 consecutive cycles. This is where the news came out. So you saw a little bit of an uptick here, but nonetheless, QuantumScape down 4% today as the EV stocks are getting sold off. Brian, Akiko?
Yeah, certainly an ugly start to the year. for some of these EV names, especially those who came to market through SPACs and S4A. Thanks so much for tracking that. Coming up, the U.S. private sector unexpectedly lost 301,000 jobs last month. We're breaking down Omicron's impact on the labor market ahead of that all-important jobs report after the break. Private payrolls declined unexpectedly last month, falling by 301,000 in January. The noted pullback coming ahead of that all-important non-farm payrolls print coming out this Friday. Let's bring in Darren Sharinga, Asymmetric ETF's founder and CEO. Darren, we've been talking about how it sort of feels like the White House is kind of warning of a disappointing number ahead come Friday, especially because of the impact from Omicron in the month. How choppy you think things could get around that number?
I think that most of the information is baked into the market already. The expectations are, since it'll be a weaker number, what we've seen out of ADP this morning was very disappointing. So it's a preliminary look at the jobs number. So I don't imagine a lot of volatility will come from the Friday's job report. Again, baked into it, market's expecting it. And so unless it's a shock to the market, I think it's going to be business as usual.
Hey, Darren, it's Brian Chung here. At the same time, the broad volatility that we've seen in the market, irrespective of the data on the labor market or even inflation, has gotten a lot of people concerned as the Fed messages its intention to tighten this year. How do you think that presents any sort of risk to trading and portfolio building in this year?
I think volatility is here to stay. We have a proprietary measure, which is called price vol, measures realized volatility of the overall market. In this case, we look at the volatility of the S&P 500. And what we witnessed in the first month of the year was that volatility had crested its threshold between bull and bear markets. And to put it in perspective, between the Great Recession and COVID, there were 2 times that price vol crested the number 10, which is the threshold again between bull and bear markets. And we saw a third of January price vol above this threshold. So volatility is here to stay, and that's going to make it more difficult for investors who are looking to trade around it. But if you're a buy and hold investor, stay the course is probably the safest way to go at this stage.
So you're saying the choppiness will continue, but you think that things have kind of bottomed out in January. What's the piece of news here, the data that you think could move the market, push it a leg higher? I mean, is it economic data? Is it earnings? What do you think could be the big driver?
It's removing a negative. So right now, I'd say at this point, the Fed, in what they've telegraphed in terms of inflation being their focus at this stage, unemployment or employment is under control. I think the Fed will look at the unemployment numbers, the headline numbers, and say, we've done a good job there. 1 or 2 data points, we can't make decisions on it. So we're focused on inflation. We're going to raise interest rates. The market's freaked out over that for a while. I think they're calming down now a little bit, feeling more secure that the Fed is going to act rationally in fighting and combating inflation, although it is their major focus. So that has been removed as a fear. What's the Fed going to do? I think the market now anticipates or has a better idea of how the Fed will proceed, or at least believes they have a better idea on how the Fed will proceed. So by removing that, you're taking out some of the uncertainty on the market at this point. So I think removing the Fed, which was one of the greatest headwinds and risks, mainly to fixed income, but to equities, as we've witnessed, gives the markets a little bit more breathing room. And now it's just like, let's wait and see what happens next on a fundamental level.
Darren, I want to talk about your business, asymmetric ETFs. You offer a product that's a hedged ETF. It's supposed to be counter-cyclical, so making money during bear markets. But if you're saying things aren't really all that bad right now, and in fact, some of that uncertainty around the Fed's been removed, have you seen demand kind of lift from some of those types of products? What are you seeing in terms of just your asymmetric product?
Well, we're seeing a couple of things. We're seeing demand for people looking for fixed income substitutes, correct? At this point, what do we do with rising interest rates? 60-40 portfolio has been broken, 40% of your assets in fixed income. You have the prospect of losing more money. Fixed income basically across the board was underwater in 2021. Interest rates continue to rise, fixed income continues to go down. What do advisors, what do retail investors do? They're looking for ways to find alternatives that they can take some of their non-productive fixed income assets, put them into productive assets, but at the same time, not take on more risk. And that's where asymmetric comes in with ASPY, is where we give investors the option to stay invested, have a hedge against inflation because you're invested in equities, and then at the same time, not giving up the buffer that fixed income offers, because we offer hedging. We go net short in a bear market. So our ASPY, again, has the prospect of being able to deliver positive returns in bear markets.
All right, Darren Sharinga, Asymmetric ETF's founder and CEO. Thanks so much for stopping by this afternoon. On the other side of this break, one of the big hurdles for returning to the office is, of course, testing. We'll talk to the CEO of one company that handles testing for some big studio productions like Ozark about the best ways to keep workplaces safe. That's next. Well, folks, it is 2022 and we do remain in a pandemic as a reminder, but we do have tools now to help us minimize the risk, and Bloom Health is one of those companies helping to deploy the tool of testing. Andrew Morton is the CEO of Bloom Health Partners. He joins us from Vancouver live now. Andrew, it's great to have you on the program. Your company not only helps set up testing in schools, but you're also working on some pretty big production projects in Hollywood with the likes of Yellowstone and Ozark. I haven't seen those shows. I'm not a big TV show watcher, but obviously big productions there. What's the demand looking like for your services? I understand that you have your hands pretty full right now.
We certainly do. We have facilities in Atlanta, Georgia, New York, and Dallas, where our primary labs sit. And we are doing testing for some major TV productions, film productions. You mentioned Ozark, which is certainly one of the ones we've worked with, and a number of others as well we're getting ready to announce. The New York base is also quite active. It's really become a requirement in general for, whether it's SAG, Screen Actors Guild, or the unions for regular testing. And in general, the productions want to see this just for a surety for operations.
Andrew, we'll get into the testing pipeline in just a bit, but by nature of the scale of testing that you do, you've got a pretty good pulse on what's happening right now. It feels like we've kind of gone past the peak of the wave with Omicron. But what do things look like from your standpoint in terms of the disruptions that we're still seeing?
A great question. Heading into 2022, 6 months ago, if somebody were to ask me if we'd be testing in this kind of volumes this time of year, I would have said no. I don't think anybody expected Omicron to do what it's done, which is certainly make its way across the country and frankly around the world. What we're expecting now on the go forward is testing will become, unfortunately or fortunately, part of life, I think. We're not necessarily just a testing company. We're an occupational health business that does a number of other things. We have a digital platform that tracks everything from the tests we run for the studios to other kinds of health conditions. And really what we expect is, as part of going to work or part of going to regular events, I think testing will be required to some degree. Hopefully, and touch wood, we don't see more variants, but that's always a possibility. At the very least, if the mechanism is in place, then there's safety. And I think the bigger component to it is if we're running a digital platform that's part of this, where we're using some intelligence, we can start planning around this and then hopefully get it to a place where we can test a little less and do a little more forward thinking around how we're going to operate.
Andrew, what does Bloom offer that kind of workspaces couldn't get by just buying a bunch of tests? I mean, it seems like the availability of it is certainly better now than it was during the peak of Omicron or even during the beginning of the testing availability in 2021. What is it about what you offer that allows for more comprehensive insurance against someone infected being around other people?
The main thing is the innovation. We are doing testing in the labs primarily, although we do help manage self-tests as well. The difference is that we bring intelligence to the model rather than just throwing volume at the problem and just sending out tests. And that's all that people are doing in many cases, because that's been a requirement. We're adding a digital component to this. So for example, in Texas, where we're doing K-12 testing across the state of Texas for schools, we announced this a couple of weeks ago. The state of Texas, many of the schools are getting rapid tests from us, but the bigger component of this is the digital component. So every time a child tests, it's digitally logged, and now there's some planning that can happen within the state level, the government level, not on the individual students themselves, but just in general, what the general numbers are as things are planning for this, and they can actually real time see what the wave is doing. The problem with self-test, if there's nobody recording it, then the test is really only good as that snapshot in time for that individual, but there's no planning involved. And I think with intelligence, organizations can now start to think about who's been tested, how often they've been tested, when the next test should happen, and maybe hopefully get to a place where we can get to a cadence of maybe every other week instead of every week, or something like that. So at least we can start predicting some of this.
What do things look like from a supply standpoint? I mean, I think those of us, a lot of us are still recovering from this last month where we had to wait in very long lines to get tested. In some cases, people had to cancel their trips because they couldn't get the test results in time. Have things improved on that front? I realize part of this is about processing the lab results close to where the testing is actually happening. But in terms of supply, is there enough now in place for the next wave?
That's starting to happen. I think we're getting better at this. I think if we start using data and intelligence to start planning ahead, then we don't have to be here again, where, truly the last couple of weeks, there certainly was a shortage of tests. I think everybody was very aware of that. And you see the images around the world of, people lining up for their tests and all that. I don't think we need to be there if we start planning ahead. If the scientific community starts working more closely with folks like ourselves, which we do, I think there's a way around some of the lineups that we're seeing. Yeah, in terms of supply chains, I think the world has adjusted to this. I think the expectation now is we're going to see another wave. And even if that never happens, at least we're going to be prepared for that. But if we're using data and intelligence for this, you know, as we do for the business, I mean, Bloom is really in the business of helping organizations, so school boards, you know, Fortune 500, film and TV productions. We're helping them plan for at least their testing needs to keep them operating. And we can, you know, can say quite proudly that we kept people like Ozark running throughout their run in some of the darker days of the pandemic. Going forward, if they start planning ahead for when they think they're going to need tests and start gearing up for some of those things, which we can give them the intelligence around, that's the way out of this. You know, just throwing volume will put us back into a supply chain problem. I think the best way is data and planning.
Yeah, and our producers do tell me that apparently Ozarks is a cool show, so I'll have to go check it out. But I did want to ask you, just in instances, for example, where it's not self-testing, right? If there is someone on site that's kind of helping to administer some of these tests, have you seen any sort of labor shortage issues? We know in the nursing industry, for example, a lot of burnout and just a lot of concern has actually had a lot of people leaving the industry, which in some cases has led to a shortage. Is that something that's also extended to testing as well?
There's a ton of fatigue around COVID, I think, among everybody that's a frontline worker. We really worked hard to keep from having staffing problems. You know, we do have staff now across the state of Alabama, across the state of Texas, for the school districts that we test, K-12 in both cases. Of course, for the productions that we do, we really, because there is a pre-production period, luckily in our case, we have the ability to plan ahead for some of this. For the Fortune 500 clients we have, for the occupational health programs where we already have kind of clinicians and those sorts of things that we're bringing on to do other kinds of things. You know, many of them are happy to start looking at things beyond COVID because there's definitely some fatigue around that. But that really back to planning and using data, I think that's the way past this. And the one thing nobody's really talking about right now, of course, is, you know, what about the mental health, you know, ramifications of all of this? So PTSD is a very real thing. I think healthcare workers could benefit from, you know, quite frankly, some kind of mental health programs around some of this. And I think our forward thinking around what we're doing for companies around mental health could probably work for healthcare workers as well, for our own employees.
Andrew Morton, Bloom Health CEO, appreciate you stopping by today. I hope to have you back on the show again soon. Well, coming up, we are kicking off our coverage of Black History Month by highlighting one media company backed by Sean Diddy Combs. The CEO of Revolt Media and TV is going to be joining us after this short break. As Black History Month kicks into high gear, we are spotlighting one media company that has seen explosive growth over recent years. Revolt TV was founded by Sean Diddy Combs back in 2013 with a focus on educating, inspiring, and uplifting the next generation through the power of hip hop. Today, the network reaches 55 million households with exclusive interviews, shows, and news coverage. Let's bring in Datavio Samuels. He is the Revolt Media and TV CEO, joining us from LA. Datavio, it's great to talk to you today. You know, we're coming off of a year where there has been so much attention, a big push to support Black-owned businesses, Black-owned media like yourself. What kind of growth have you seen as a result of that?
Yeah, what I would say is the last year has truly been phenomenal for Revolt. Revolt as a brand is absolutely on fire, and we're winning on every aspect that you could imagine. So if you think about it financially, last year we saw triple-digit growth on our advertising business. You see what's happening in terms of cord cutting with the cable business, yet Revolt had the biggest year in the history of our cable affiliate business. We doubled our EBITDA last year, and while doing all of that, we still managed to triple our investment in content, grow our employee base by almost 50%. So you can just see that the business is working from a financial perspective. It also happened with the culture. So we are getting and we are booking and we are doing shows with the biggest names in the business, the biggest names in hip hop. We've also saw triple-digit growth across all of our viewership metrics when you look at things like YouTube, our website, and social media. And then lastly, the last place for me where I would just want to talk about growing and winning that matters is we're also winning with our reinvestment into the community. So much of the story that we tell is about how you invest in Black media and that money then gets reinvested back into the community. As an example, we did a phenomenal commercial with Frito-Lay last year. We took 100% of the production budget, gave it back to others. We built a team that was 100% creative, Black creatively, and then 91% of that money went to Black-owned businesses. And so we're winning with our P&L, we're winning with the culture, and we're winning with the type of investment back into our community that matters to us.
Hey, Datavio, it's Brian Chung here. Fantastic numbers that you've got there. I'm wondering what type of content are you putting out there that makes Revolt TV Revolt? Because it's a pretty crowded landscape just in the streaming space broadly. I understand that you have a new show that you're working on called Bet on Black. It's a entrepreneurship program. Tell us a little bit more about what that's bringing to the table and kind of how that exemplifies the other types of content that you hope to put out there in the future.
Yeah, Bet on Black is a phenomenal show for us that I'm super excited about. We did it in partnership and in collaboration with Target, who has been a phenomenal partner. One of the things that Revolt is passionate about is trying to put a dent in the world in many of the places where there are inequities in our culture and in our world. One of those places is clearly entrepreneurship, right? Black entrepreneurs struggle and are starved through every aspect of the entrepreneurship process. We come from families who have lower net worth, so it makes raising money in the angel stage more difficult. We're less likely to get loans from banks. Only 1% of VC money flows into Black-owned businesses and companies. And so there's definitely an issue of systemic racism. And so we partnered with Target to shift all of that. And so Bet on Black is simply a Black Shark Tank where we are spotlighting, celebrating, showcasing Black entrepreneurs, giving them mentoring, coaching, and capital without taking any equity, right? That's the type of work that Revolt is super excited about. And so you'll start to see more what we're calling those kind of equity plays roll out throughout the year. The other side of the business and the other way that we think about it is while the rest of the world goes and looks for great shows and then tries to find talent to put in it, Revolt has much more of a music label model. We find the voices in hip hop that need to be amplified and celebrated. We pull them in the lab and then we create shows with them. So we let hip hop talk. If they want to talk about mental illness, technology, fashion, all the things that hip hop touches, we're giving them permission to talk about on Revolt. That's essentially our strategy, and it's working.
Datavio, who's your core audience? I mean, you're clearly highlighting not just success stories in the Black community. You know, you just talked about a new show here. We've also talked about, shows that are focused around hip hop. But I imagine you've got an audience that goes beyond the core community, right? What's the strategy here in terms of expanding beyond that?
Yeah, so I'll talk about our audience in three ways. So when we think about our design target, we think about an audience that is young, gifted, and Black. And so we are designing towards that 22-year-old, 23-year-old, 24-year-old young Black kid that aspires to be the next P. Diddy, wants to be the next media mogul, aspires to be the next musician. That's the audience we designed for. That said, our core audience, and who typically shows up for Revolt, is Gen Y, Gen Z, 50-50 male, female, male and women. And then lastly, when you talk about like how do you extend it, in the way that hip hop, 70% of hip hop is purchased by white consumers. Hip hop is consumed globally by the world. And so Revolt is just mimicking that strategy where we are designing for our community, we're designing with them in mind, but then inviting the rest of the world to the content. That's how we get scale. And that's also how we help to shift the narrative for Black people through the content that we're creating.
I want to talk about the sponsors that you have. As you mentioned, Bet on Black, you're working with Target on that front, but you talk about Frito-Lay being a partner in the past, Comcast, Cadillac, AT&T are all also part of your partners. I want to ask, how do you kind of vet the business opportunities that are out there that isn't just a surface level donation? Because it's one thing to be offering money and helping you finance your operations, but it's another thing to be about the message that I imagine Revolt wants to get out there.
Yeah, I love that. I love the chart of brands you just showed. The one I would add is State Farm, absolutely, who've been phenomenal partners. But when you talk about this idea of how we vet who we work with, Revolt is serious about this thing that we are building. And so we only want to work with serious partners and serious players. And so we are the ones that want to sit eye to eye across from the CEO, eye to eye across from the CMO. We want them to understand who we are, what we're building, our purpose and our values. We want them to understand that we are unwavering in our commitment to our culture and our community, and that we want to talk about big ideas that we can do together that don't just drive, again, dollars for the media company, but how do we shift and change the world? Ultimately, I believe that we are moving into this reality where it is no longer just about the products you make, but about the values that you bring to the table, the purpose that your company exists for. And so Revolt is just trying to find people who have similar purpose, similar dreams, similar values, and then trying to change the world together. And so the people that you showed on that screen are absolutely a part of that journey. And, you know, we're open to more, but we're not going to do it for people who just want to be performative or transactional. That's not the business we're in.
Detavio Samuels, Revolt Media and TV CEO, thanks so much for stopping by. We'll have you on again soon. Coming up on the other side of this break, the U.S. private sector unexpectedly lost 301,000 jobs last month. We're breaking down the latest market action ahead of the January jobs report after the break. got some market updates for you. When we check the markets at the top of the block, numbers were mixed across the board, across the major indexes. But if you take a look right now, some nice green across the board. S&P 500 and the Dow now up. S&P 500 actually up 0.3%. The Nasdaq up about 0.5%. Not everyone winners. The Russell 2000 looks like those small cap stocks down over 1% today. But let's get more of an update on all of the market action as we get deeper into the PM session with Yahoo Finance's Jared Blickery next to a big shiny screen.
Yeah.
Jared, what's up?
In the real world, we call this Wi-Fi interactive. As you noted, Brian, the Russell 2000 down about 1%, but I just want to show you what's going on with the S&P 500. Pretty strong day here. We came down, tested yesterday's low. That's the unchanged line down there, and we are back up to session highs. I want to get a little bit of a longer term view. This is going to be a candlestick chart going back 2 months, and I've been talking for a couple of days now that this area right in here, so right in here is a critical area for the bulls to get through. You got to get to 4,600 or above, and that's kind of the all clear to get to record highs. But until then, we could still see the short sellers come in, and that's something I'm keeping an eye on, but it hasn't happened yet. So let's take a look at the sector action. You can thank Alphabet for communication services being the top performer today. That is up over 2%, as you can see, but the rest of the leaders here looking a little bit defensive. Real estate, utilities, healthcare, staples, all of those defensive. So actually a little bit of a reversal from the last 3 days. And want to show you what's going on with our leaders here. SOX, that is the chip index, that is up 1.7% and is our leader. SPLV is a low volatility ETF, not going to get into the weeds there, but those are the only two outperformers. And you can see down here, ARK Innovation, the biggest laggard, that's down 4%. IPOs, China looking weak, retail looking weak, cannabis looking weak, and the list goes on. So as I said, a little bit of a reversal from the last 3 days. And let's just take a look at what's going on inside ARK. And we can see Shopify down 10%, I believe, on an analyst downgrade. And you can see retail here, a lot of these retail names, which actually a lot of these were in the red earlier and not off too much right now. So Wayfair's down 7%, Macy's down 4%, but we do have some winners here. Home Depot up 1%, Costco, that staple, is up 2%. Also want to take a look at those Chinese shares because those are flagging today. Alibaba down 3%, it looks like NIO's down 4%. And speaking of the EV space, we're seeing a lot of red here too. GM coming off a nice run is down 3%, Rivian down 5%. So I think the bottom line for today is we got to actually we have to get back to the period that we were in the last 3 days. Also want to check out the clean energy space. This is another kind of leader sentiment area that I like to look at, and we can see a lot of red in this space as well. And finally, I do want to check out the price of Bitcoin. Bitcoin down 3.5% over the trailing 24 hours. Just pull up a chart of the last 5 days so we can see what's going on. And we are getting back down to those lows that we got just a few days ago. So it's going to be interesting to see how this shakes out. Guys?
Thanks so much, Jared Blickery. Coming up, what's in a name? We'll reveal what the NFL team in Washington is now calling themselves after the break.
Washington has announced the new name for its NFL team after spending 2 seasons as the Washington football team, unveiling its new logo in uniform today as the Commanders. After 18 months of speculation here, team president Jason Wright saying on the Today Show earlier today that the name embodies the values of service and leadership that defines the community. Brian, we're talking about burgundy and gold still remaining the colors for the team. The new uniforms, as we're looking right now, apparently incorporates parts of the DC flag. I mean, I say anything is better than the previous name. I don't know if Commanders was the fan favorite, but the team is moving on.
Well, the previous name certainly had to go, but I don't see what the problem was in keeping it as football team. I mean, it was generic, it was kind of fun, and their uniforms looked good. It was almost like Alabama. It just had, I think it was just numbers on the sides of the helmet, and it just said, I mean, the merch that just said football across the chest, I thought was pretty fire. I don't know, that's just me.
I don't know if it's a good thing to look like Alabama. We'll set that discussion aside. By the way, they're still looking for a new mascot and a new fight song. So if you've got ideas, I don't know what would go along with the Commanders. I think I'm going to have to think on that one a bit.
Maybe their mascot should just be like someone working on Capitol Hill, just like in a regular baggy Joseph A. Banks suit. I mean, look, at the end of the day, I think people will be forced to go with it. I think the colors being the same maybe allows people to have some familiarity with the history of this team. But I think we have to acknowledge that people wondering why it took so long to get to Commanders. I mean, rebranding is not easy. You'll recall the other team that had to rebrand in the MLB, the Cleveland Indians, now the Cleveland Guardians, when they landed on the Guardians, it was actually pretty controversial because apparently there is a roller derby team in Cleveland also called the Guardians. And let me tell you, they are angry, and you don't want to get the roller derby people upset. So there's a lot of kind of moving parts and a lot of political moving around to make sure you're not stepping on anyone else's toes when you rebrand.
I mean, name changes and rebranding in any professional sports or in any college sports is always very polarizing, but we eventually kind of move on, right? And really, that's kind of what this franchise needs to do. Number one, the name, where it took so many years to actually acknowledge that, yes, in fact, it is racist and should be changed. But also, I mean, this is a franchise that's facing sexual harassment allegations right now, needs to change the workplace culture. So, I mean, I would argue that the name change is probably the least of the problems for this team right now.
Yeah, it certainly is. But I think that when we just talk about the bigger story here, right, it's not just the name. A big reason for why this has been as controversial as it was is because of management at the top. And that bleeds through other things, too, like the sexual harassment allegations with the cheerleaders on this team, which Congress now wants to take a look at, right? Dan Snyder is the owner of this team. He was vehemently opposed to changing the name at a point in time. But you saw what the kind of grassroots calls for a change here and acknowledging that the name was and is racist has done. So I think that that type of pressure, whether or not that extends to other parts of management beyond just a name, I think is going to be very important within the sports world.
Yeah, and the fact that, Brian, that you're saying we could have just kept it to the Washington football team shows that people kind of get used to it. Remember when they changed it to that 2 years ago? That was a huge issue. This idea that we would just call it the football team. So I say 2 years from now, the Commanders will seem seamless. I think the fans will be happy, and the colors are still the same. So you don't necessarily have to change anything.
And they'll still be bad.
Says the Jets fan. Let's end it on that note, Brian. I got the last word on that one. All right, final check of the markets right now. We see all three major indices in the green. The Nasdaq leading the gains here, up about 64 points, and the S&P 500 also up as well. Much more to come here on Yahoo Finance Live. We'll be right back. Labor market in focus. A dismal ADP print shows 301,000 jobs were lost in January. The White House already warning of an ugly report for non-farm payrolls this Friday. Still, tech starting off the month on the right foot. Investors buying the dip. Washington's NFL team finally has a new name after 2 years of being dubbed the Washington Football Team and nearly 9 decades of being called the Redskins. But are all the controversies now behind the newly minted Commanders? Plus, a look at one way to help narrow the racial wealth divide gap through baby bonds. Welcome, everyone. I am Karina Mitchell, along with Alexis Christophers. Thank you so much for stopping by this afternoon to spend some time with us. Alexis, investors are weighing that great earnings result from Alphabet, along with the dismal ADP numbers that we got for January.
I feel like a broken record, Karina, but once again, a choppy day of trading. At the moment, we've got all three major indexes higher. And you're right, those strong tech earnings from Google's parent company, Alphabet, also chip giant AMD, helping to offset that ugly private payrolls report, which really showed how the quick spreading Omicron variant really socked it to the job market last month. It certainly does not bode well for the monthly unemployment report due out on Friday. The Dow now up by triple digits after being in the red earlier today. We've got the S&P 500 up by 34 and the tech-heavy Nasdaq up 73 ahead of earnings after the bell from Meta, that is the company formerly known as Facebook. Also Spotify, which is in the midst of a big controversy right now with that Joe Rogan podcast. They're out with earnings after the bell as well. Taking a look at some of the sectors helping to drive this advance right now, we've got most of the sectors in the S&P 500 higher: communication services, real estate, and utilities among the big winners. Actually, I only saw a couple of sectors on the downside today. That was consumer discretionary and energy, taking a little bit of a pullback after its torrid run recently. And let's get a quick check of the bond market before we toss it over to Inez Ferre live at the Nasdaq for us. We've got the yields a little bit lower here today. The yield on the 10-year at 1.75, the yield on the 30-year at 2.07%. As promised, Inez Ferre live for us at the Nasdaq. What do you have your eye on there today? Because Nasdaq, a big mover in today's session.
It sure is a big mover, and it's been hugging the flat line for part of the session throughout the day. But it's worth hitting that ADP report that you guys were just mentioning. Private payrolls for the month of January unexpectedly falling by 301,000 jobs, and the estimate was for it to rise by 180,000 jobs. This is the biggest drop since COVID, much worse than expected print. And as you were just saying, this could be a warning about what's to come on this Friday's jobs report, also suggesting that the Omicron variant has really had an impact on businesses and jobs. I want to take a look at the Nasdaq 100 because we have been watching the big tech names. You mentioned Alphabet, Google up more than 8% today. That's a 2-day chart. Take a look at today's chart. You can see here it's just soaring after a blowout quarter. In fact, year to date, out of the big tech, Alphabet is set to close in the green, up 3% year to date. If you compare it to the rest of the big tech names, the only one really set to close in the green today. Taking a look also at Amazon, that's relatively flat today. Amazon will be reporting its quarterly results tomorrow after the close. Meta more than 1%. It will be reporting today after the close. And I do want to mention Netflix down 5%. This actually has to do with YouTube's ad revenue last quarter, which came in at $8.6 billion. That's higher than Netflix's revenue for the quarter, for last quarter of $7.7 billion. So Alphabet's YouTube ad revenue coming in higher than Netflix's revenue. That may be impacting the stock today. And then I just want to mention what's happening with PayPal. Absolutely tanking today, down 26%. This is after the company said it saw slowing growth in spending in the fourth quarter. Low-income customers are spending less with rising inflation. Also, the company slashing its long-term target for new accounts. In fact, 27 analysts have now cut their price target on PayPal. Alexis, Karina?
Yeah, PayPal taking a bath, definitely, for sure. Okay, Inez Ferre, thank you so much reporting there from the Nasdaq. We're going to stay on the markets and bring in our next guest, Jim Smeagol, SEI Chief Investment Officer. Jim, thanks so much for being with us today. Just want to get your reaction to that really dismal print that we got
on ADP. Some of the 301,000 jobs lost in January. Some of the other numbers, small biz lost about 144,000. Construction lost 10,000, and the service sector took the brunt of it with 274,000 jobs lost. What do you make of it, and how does it set up for what we see come Friday with the non-farm payrolls report? ADP doesn't necessarily predict what's going to happen with those non-farm payroll reports, but the White House is warning that it could be ugly.
Sure, definitely a dismal report. You called it correct. It was a big miss. It was a big miss directionally as well. Expectations, as you saw, up close to 200, down 300 was the actual print itself. And your other point, very broad base. So this isn't just a travel and leisure thing, just not just a service sector, but weakness really everywhere. Almost every single subsector of that payroll report showed a decline for the month. Yeah, I think the takeaway for investors, this is probably a temporary blip on an otherwise strong recovery that we're seeing in the employment markets. It's probably not surprised everyone that Omicron surged during this time. A lot of people gave each other Omicron over the holidays, so not too surprising that we're seeing a bit of weakness. You are also correct in that all eyes now point to Friday and the NFP report. I agree that the market does tend to look to ADP as some sort of a predictor. I caution everyone, quite frankly, it's a very poor predictor. It's random at best, and recently actually been a bit of a contrarian indicator. So this Friday will be interesting. The volatility from the Omicron is shown in the expectations across the market. I think we have Goldman on the high side looking for, or low side rather, looking for minus 250. I think we have Morgan Stanley on the high side looking for plus 225. That's a huge spread in expectations. So we'll see what happens on Friday, but expect it to be volatile, and there'll be just as many people who got this one wrong as got this one right.
Yeah, the spreads have been so big for these last few reports. I'm very curious to see where they land up on Friday. But listen, January actually ended up much better than it could have. It was a dismal month, and everyone's happy to say goodbye to it. February is here, though. Nasdaq is having a nice little rebound. I'm wondering, is the worst behind us now, and is it time to sort of think about maybe taking a dip, particularly into the tech sector, which has been beaten up so badly?
You can't argue with the earnings. Earnings are incredibly strong. Obviously Google's in the headlines today. These moat type companies are just showing just amazing earnings prints. I mean, for companies of that size to be showing 30% or such increases in earnings is quite amazing. We still look for this rotation actually to continue. So while we're not shying away necessarily from the big tech names, we do like those that have earnings momentum behind them. We tend to still like the kind of the value-oriented parts of the market, so the financials and the energy names, ones that have actually done relatively well during January. So January was certainly not a great month for the headline for the big techs or for the FANGs, but going beneath the surface, there are certain sectors that did quite well in January, and we expect that to be the longer-term story. This kind of reflation theme to continue to play out throughout 2022. So not expecting the double-digit kind of returns out of the broader markets that we may have been used to in 2021, but plenty of money to be made in this rotation as that begins to kind of solidify itself into 2022.
And then, so amid all of this slowing growth and volatility, we know these rate hikes are coming. The range is quite big, anywhere from 3 to 7, I've seen. But so then where else are you looking to recalibrate the portfolio and make sure that you are in a good position? What about things like, emerging markets, for example?
We do like emerging markets. We do like small cap earners, if you will. So something closer to the S&P 6 rather than the Russell 2. We think there's some value to be found in those areas of the market. Something that we have been harping on for a while is this notion of inflation sensitivity. It's something that we do think is underallocated to in general amongst investor portfolios. Plenty of very easy ways to access things like just broad commodities. We think it's still a good time to have that in your portfolio. Your classic 60-40, it's always good to remind the end investor, the classic 60-40 is taking a bet on inflation, but it's really taking a bet on deflation. So it's taking a bet that inflation is falling, given the nominal bonds and the tendency of equities to do poorly as inflation continues to rise. So we do continue to recommend an allocation to commodities and investor portfolios as well.
As earnings season continues to roll on, as you say, Alphabet delivered a really good beat, Meta reporting after the bell. But I'm wondering, how much do people now look at earnings as being something that will help stabilize the markets at this point?
For sure, earnings is what it's all about. That's what we're trying to do. We're buying that future set of cash flows, discounting them back. There are a lot of valuations out there that need these strong earnings to back them up, and Google delivered on that. And it remains to be seen if the rest of the big players in this space can do just that. We've seen strong earnings. We've seen it from some of these sectors that I've mentioned before. Financials doing relatively well, energy doing relatively well. And now it's the turn of the big boys, and we'll see if they can deliver. But absolutely a strong earnings season here, which we think it is shaping up to be fairly broadly, can do an awful lot to buoy investors, particularly at a time when they're feeling relatively unstable, wondering what the Fed is going to do, when they're going to do it, and how quickly they're going to tighten policy.
Okay, we will see how it ends. Definitely probably a little weaker than the last few quarters as far as earnings, but we'll leave it there. Jim Smeagol, SEI Chief Investment Officer, thanks so much for your time today. And you can step up your own investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and much more in a sleek ad-light experience. Just check it out today at yahoofinance.com/plus. Alexis, I'll send it over to you.
All right, thanks a lot, Karina. Coming up next, more than 50 Starbucks stores are making a big push to unionize. We've got that story next. Oh, it's actually coming back quite a bit. You don't have to. Welcome back, everybody. Starbucks reported its fiscal first quarter results after yesterday's closing bell. The coffee chain missed estimates on the bottom line. Revenue, though, came in slightly higher than expected at $8.1 billion. You see the stock under a little bit of pressure here, off its worst levels, but down nearly 0.75%. Yahoo Finance's Brooke DePalma had the chance to chat with CEO Kevin Johnson following their earnings call. She joins us now with more. So, Brooke, what did Johnson have to say about those recent results?
Alexis, the earnings results were largely based upon the impact of soaring inflation, supply chain, and staffing shortages that's hitting the restaurant industry at large. But Kevin Johnson did tell me in particular that the Omicron variant really amplified the effects on all those things. With rise in cases, the COVID benefits that Starbucks offers for its employees, that including isolation pay for any partner that is exposed to COVID-19 or tested positive, spiked in the recent quarter. Now, Alexis, take that and combine it with third-party providers also seeing similar staffing shortages, forcing the company to go to what Kevin called the spot market and pay for transportation or delivery to allow the company to meet a higher demand at a higher cost. In the earnings call, Kevin acknowledged the future impact of these pressures on the customer.
We anticipate supply chain disruptions will continue for the foreseeable future. We've already taken pricing actions this fiscal year, one in October of 2021 and another in January of 2022. And we have additional pricing actions planned through the balance of this year, which play an important role to mitigate cost pressures, including inflation, as we position our business for the future.
And now higher prices are determined by what Kevin said is AI, analytics, as well as the team who is monitoring to make sure that these higher costs are well received by customers. But those price hikes will take effect in the back half of the year. Kevin did tell me more specifically that it'll probably be spring or summer for when the next action happens. But I do want to note that we did see that beat on the top line. The customer demand is still very high. Here in the U.S., we saw sales up 18%. And taking a closer look at the monthly visits in October, they were up 7%. November, they were up 13.2%. And then in December, up a whopping 9.8%. That's according to data analytics company Placer.ai. But overseas, it was a bit of a different story. International sales were down 3%, much lower than the estimated based upon Bloomberg consensus of up 1.27%, largely in part due to the zero COVID-19 policy in China. There, Alexis, same-store sales decreased by a whopping 14%.
And Brooke, also just to switch gears a little bit, the company also seeing more stores in the push to unionize 54 locations across 19 states. What did the CEO have to say about that?
You know, Karina, he did acknowledge that these labor unionization efforts are happening, but he emphasized that only 2 company-operated stores are currently certified union, that there's roughly 50 that have filed to the National Labor Relations Board to go through the process to see if those partners even want to take a vote for a union. He said more specifically, quote, "We're following the National Labor Relations Board process, and we respect that process and will continue to do that." But I would also mention that we have a few thousand stores in our channel licensed partners, like many of the big grocery channels, for example, that have a Starbucks in their grocery store that are unionized. So we've got experience with our licensed partners and how they run unionized stores. At the end of the day, we always listen to our partners. We always will, whether they're a union store or not. Now, those licensed stores include stores like based here in the U.S., like Kroger, Target, Safeway, and Albertsons. And he did mention that $1 billion investment that the company made in wages back in October. That brought the average hourly wage to $17 an hour, with an hourly wage ranging from $15 to $23. But you cannot ignore the union labor relations that is happening across the U.S. On February 23rd. The count for 3 more stores in Buffalo is set to take place. And it'll be interesting to see how Starbucks continues to work with its partners as more look to unionize and more stores potentially look to make that vote.
Yeah, between the unionization push and higher inflation and those labor costs, there are definitely some challenges ahead for Starbucks. All right, Brooke DePalma, thanks for breaking that down for us. Karina?
Okay, and we are going to take a quick break, but much more Yahoo Finance Live straight ahead. Stay with us.
Welcome back. Another tech giant is gearing up to post earnings after today's closing bell. Facebook's parent company, Meta, is set to report. And here with what we can expect is Christine Short, VP of Research at Wall Street Horizon. Christine, welcome to the show, and thanks for being with us. I know that some on the street are looking for Meta to report its first earnings decline in years. What are you looking for?
Right now, expectations look about flat on the bottom line, maybe slightly negative depending on which analysts you're looking at. Top line growth about 20%, but you have to keep in mind that it's really not just top and bottom line that investors are interested in. A lot of times, social media names end up trading on things like user engagement. So that's what we're looking for. We're looking for monthly active users, daily active users. And that's where I'm a little bit worried on MAUs. They're expected to post 4% growth month over month. That would be the lowest growth rate since they IPO'd in 2012. The other number, of course, we're looking into is ad revenue. And they have already warned that that is going to be somewhat suppressed because of the changes made on Apple iOS 14 with people being able to opt out of app tracking on their phone. So those are two main areas that we're looking into in addition, of course, to EPS and revenues.
How much of what you just said, though, is or should be baked into the stock price? Because we know even from their previous earnings report that this pandemic-induced boost to growth was already, beginning to fade. So how much of a surprise do you think lower, active monthly users numbers and lower advertising revenue is really going to be for the street?
Yeah, it's a great point. I mean, they've been very transparent. They've been transparent about user engagement. They've been transparent about how Apple iOS is going to affect ad revenues. So a lot of that should be baked in. You also have to keep in mind, like you said, the year-over-year comparisons. So difficult comparisons from a year ago when they were just growing like crazy. And so we've seen that with a lot of the tech stocks, although many have reported well throughout this season. 2021 comparisons to 2020, well, those were very easy comparisons. Now we're entering a time of difficult comparisons because of the very high growth last year. And so I think some of this will be baked in, but again, we're noticing this season, if you even miss by a penny on EPS, if you slightly miss on MAUs, I think that investors will punish the stock for sure.
As you know, with these earnings reports, it's also just as much about what the company has to say about the profit outlook. And I'm curious what you are expecting to hear from CEO Mark Zuckerberg, because he's obviously spending a lot of money and time and energy on what he calls the metaverse. And maybe he'll go into a little bit on the earnings call as to what he means when he says metaverse. But I guess it's sort of the next phase of the internet. What do you expect Facebook or Meta to sort of lay out with regards to future quarters?
Yeah, it's all about guidance, right? So Q4 backwards looking, of course, it affects how investors trade the stock, but really we want to hear what are the expectations for 2022? This is the first quarter we're actually going to see two financial reporting segments broken out. So the family of apps, everything you've come to know from Facebook for. So Facebook, Instagram, WhatsApp, and now Reality Labs, which includes their AR and VR investments. So we'll see what the guidance is for both of those segments. Right now, they are expecting expenses to go up, mainly because of that Reality Labs segment, about 33% year over year. So that's, something that you're going to see impact the bottom line because they are investing it. Of course, investors want to see that they are putting money into it because we need to support growth where family of apps is right now not growing very much. So perhaps Reality Labs can give a boost there. But if you look at the first and second quarter, EPS expected to be down about 7-8% in the first half of the year. Revenues tick down slightly, but still double-digit growth is expected about 14-15%. But certainly guidance going forward will set the tone for the next 4 quarters.
Okay, I want to get your thoughts on another big tech giant, and that is Google's parent, Alphabet. They're announcing a 20-for-1 stock split. You don't hear that very often. Your response to that, and is that maybe a good entry point opportunity for investors who've been looking to get a piece of Alphabet?
For sure. I think it's a great move, following in the footsteps, of course, of other tech companies like Apple. Tesla did something similar last summer to make the stock more affordable. I mean, Alphabet closed at over $2,700 a share last night. So not affordable for many people. They want to take advantage of the retail money that's come into the market. If you take last night's close and you do the 20-for-1 split, that puts per share at about 135, 137 per share, certainly makes it a lot more affordable. You can get different types of investors in there. Investors can diversify differently. Sure, a lot of brokerages offer fractional shares now, but there are benefits to owning whole shares. And one of the drawbacks of owning fractional shares is there's liquidity issues. You can't always sell fractional shares on every different brokerage. Dividends, you won't get the full dividend. Shareholder rights, you may not get the same shareholder voting rights as someone that owns whole shares. So I think that was a great move for them to get new and different types of investor in their stock.
And what did you think in terms of their revenue? I mean, it was pretty blowout, right? 32%, I believe, jump year over year. They even had better revenue from YouTube than I believe Netflix did. Do you see that being able to continue in the coming quarters?
Yeah, pretty much every metric across the board. I think with the exception of YouTube ad revs was off just a little bit from estimates, but every other metric certainly, benefiting from cloud revenue, which we expected heading into it because we saw the same from IBM, from Microsoft with this high adoption of the cloud. So those are a couple of areas that Google certainly benefited from. I think ad revenues were up 33% year over year. And when you think about ad revenues and you see the numbers that are expected for Facebook, Google was really able to take advantage specifically from retail. Cloud revenue, I think, was up 45% year over year. So certainly blowout numbers. And I think you're going to start to see analysts go in and tweak their estimates for the first half of the year based on that report and based on some of the guidance given. Right now, EPS for Q1 was expected to come in at about flat, but I think you see that change based on some of the comments they made yesterday.
For sure. All right. And Christine, finally, Amazon going to come up to bat on actually tomorrow, February 3rd. What are your expectations there?
Yeah, so right now, year over year, they're actually expected to be down. Again, difficult comparisons a year ago. Revenue is expected to be quite good, however. Same thing, AWS expected to be main driver. Prime, we're going to listen up to see if they're changing prices on Prime subscriptions. But overall, they had a very strong holiday season. Prime continues to be very strong. Cloud revenue and AWS should support that name going forward.
All right, Christine Short, VP of Research there at Wall Street Horizon. Thanks for talking big tech with us. All right, in this week's episode of Influencers, Yahoo Finance's editor-in-chief Andy Serwer sat down with New York Congresswoman Alexandria Ocasio-Cortez to discuss whether lawmakers should be allowed to trade individual stocks.
It's not really a mystery to me why it's difficult to pass. An enormous amount. I wouldn't be surprised if it was a majority of members of Congress hold and trade individual stock. I don't know the actual numbers, but it is a very large degree. And the key here is that it's not to say that you can't have a retirement fund or a college savings account.
Or a blind trust.
A blind trust, right. a mutual fund, an index fund. These are vehicles of investments that are broad that individual members of Congress don't have direct control over. But even last year, there was at least 75 members of Congress that held individual stock in Johnson & Johnson, Moderna, and Pfizer. We're talking about in the last 1 to 2 years. And so that is where we should be drawing the line. I am a member of Congress. Members of Congress have access to very sensitive security clearances. We have access to very detailed, tailored briefs. Our job is to try to anticipate and legislate for what we see is coming. And we should not have the ability to both have access to that information and be able to hold and trade individual stock. And that's really what this is about. It's about our ability to direct and hold trades in individual stock with access to the sensitive information that the public has given us.
Andy had a full and far-reaching conversation with the Congresswoman. You can catch it all tomorrow at 4:30 p.m. Eastern on Yahoo Finance as part of our Influencers series. Karina?
Okay, and coming up, a long-anticipated name change to a team in the NFL. Details ahead. And welcome back to Yahoo Finance. Well, the Washington football team has renamed itself to the Commanders, dropping its longtime moniker criticized as being derogatory to Native Americans. But it's been a long road to the new name. To explain how we got here, let's bring in Dave Briggs, a sports analyst. Dave, thanks so much for being here with us. It's taken about 18 months to get here.
Yeah, it's been a bumpy ride. It's been a long road for Washington, and that kind of fits the whole last 5 or 6 years for that franchise, formerly known as the Redskins. Anything Dan Snyder has touched in the last several years has not gone according to plan. They have taken a lot of time to make sure they get this right, to make sure that they're clear of any copyright infringement, which they did have some issues with, and to make sure they weren't offending anyone. I think they did finally come with the right name, which is the Washington Commanders, a nice, sleek, cool, marketable logo. And look, this is 2022. Americans can't agree the sky is blue right now. So team names, team uniforms, when they're changed, are never met with universal gratitude. But this one has been pretty well accepted. The only issue was they had a bumpy ride just getting it out. It was leaked in several instances. Joe Theismann, who was part of the announcement today, leaked it accidentally on a radio interview. Yesterday, news choppers were flying above the stadium and captured it already painted on the stadium's field. So it wasn't so smooth, but all this 6 months, a year down the line will be a non-issue. And I think this name will go over very well and will be accepted by the entire Washington football team, now Commanders community. I think they did a good job. Unfortunately for them, they will end this week in the nation's capital, not talking football. They're going to be dragged before Congress to talk about the Dan Snyder team owner's sexual harassment scandal. Carolyn Maloney wants to talk to the Redskins about how that was handled. So this is a tough week for the Redskins to roll this out, in particular, given the Flores news of a class action lawsuit that really got buried.
Yeah, right. It did. I want to ask you more about that lawsuit from Flores in a moment, but back to the Commanders. We have to get used to saying that. It really has been the world's worst kept secret. At least they're keeping the same colors. I guess now all they have to do is win, right? Because they posted 5 consecutive losing seasons. They haven't, I think, won a playoff game since 2005. What do their prospects look like?
Yeah, and you know what's really the tough thing to swallow for fans of that team is they've seen all their former coaches go on to so much success in other markets. Sean McVay, who's coaching in the Super Bowl for the Rams, he's a former coach. Kyle Shanahan is a former Redskins coach. They are all over the league finding success in half a dozen markets while the Redskins continue to burn through coaches and quarterback. So that's really the issue for any team struggling. 1, do you have a quarterback, which they have not in several years? And 2, do you have the right man leading your program, which they have not for quite some time now? Ron Rivera's done a nice job so far, the former Carolina Panthers head coach, one of the minority hires in the league. But you have to have both. And right now, it's not certain if they have either. Yes, once you win, no one cares what your team name is. They would happily accept Washington football team if that team were in the playoffs. But this name will go well. They're just going to have to really clean up the culture that starts with Dan Snyder, then get themselves a quarterback, which is not an easy task in the NFL right now.
That it is not. All right, want to get to that lawsuit now from the former Miami Dolphins head coach Brian Flores. So he's bringing this suit that I believe he wants it to be a class action lawsuit. I don't know if anybody else has jumped on board here, but he's alleging that the NFL still discriminates against Black candidates. And I know the burden of proof here is really on Flores. He was a head coach. So I'm wondering what sort of evidence he's going to be able to bring that shows that, you know, he was never really a legitimate candidate for other jobs or that he was discriminated against.
Yeah, I think this is tough. I called several attorneys about this morning. All of them universally agreed, a half dozen, said the legal bar here is just far too high unless there's some smoking gun out there that they're unaware of, because it would be impossible to prove racism and discriminatory practices unless there are emails, unless in the discovery process of this, what he hopes to be a class action lawsuit, you never know what's turned up in discovery. Let's turn back to that Dan Snyder investigation. There are hundreds of thousands of pages of emails that the commissioner could release Would he release them? I don't know. Could the court compel him to release emails from all of the league's 32 owners? If he does that, the discovery process could get very ugly. And that's what's interesting for Flores. Many people feel he was going to get one of the open jobs in the NFL, which there are still 5, including Miami. I think he would have nailed one of those jobs because he did a great job with Miami. He's universally respected. The players love him. He won 7 straight games after losing 7 straight games, but he acknowledged this morning, I may not get a job. It's a big risk. This is bigger than football. I have to take this on. Now, there is no doubt the Rooney Rule has been a failure. It is a joke. The text exchange that was released with Bill Belichick is really harmful for the New York Giants. It shows they were going to interview Brian Flores, and it didn't matter that they had already made their decision as to who they hired before even interviewing Flores, which was part of the Rooney Rule to satisfy that requirement, as it says you have to interview a minority candidate for a GM or head coach job. I'm just going to float a theory here that I frankly believe, and I've heard from NFL insiders. Did Bill Belichick do that on purpose? That's the smartest guy in professional sports today, with all due respect to the rest. I've covered him personally. I know him personally. He never makes a sloppy mistake like that. He had a bit of an axe to grind with the Giants because they just fired his friend and former coach, Joe Judge. How would he text the wrong Brian some news that no one in the league at that point had? How would he get that news? And how would he really text the wrong Brian? Did Belichick want to get at the Giants? And maybe he wanted to bring up this discussion. The Rooney Rule has been a failure. There is one black head coach among 32 teams in a league that is 70% players of color. It's been a big problem for decades.
Yep, a big problem and definitely some unanswered questions still there. All right, we will leave it there. Dave Briggs, sports analyst, thank you so much for your time. We've got a lot more coming up. We're going to take a quick break, and after that, we take a look inside a new report on baby bonds. Stay with us. The wealth divide in the U.S. is growing. As of the end of 2020, the wealthiest 10% of households possess just under 70% of the nation's total wealth. One way to help ensure children of lower income families get off to a sound start is through the Baby Bonds program. Here with more on that is Shira Markov, Prosperity Now Policy Fellow. Shira, thanks so much for being here. A lot of lawmakers are pushing for this initiative. Cory Booker supported it from New Jersey. I'm wondering if you can explain what are baby bonds, how do they work?
Yeah, so baby bonds are a policy idea that were initially created by Derek Hamilton, who is a professor at the New School. And basically the idea is that the government would set aside funds for children and early in life, and then those funds grow over time. And then when children reach adulthood, they're able to use those funds to buy assets that are going to help them to become more financially secure and to build wealth over their lifetime, like a home or a small business, or putting money aside for retirement or for post-secondary education. And so the idea is that we're helping to level the playing field so that children from lower wealth households who are disproportionately Black, Latinx, and Indigenous have the opportunity to build wealth that some of their wealthier counterparts might have.
And then what are some of the essential elements of a baby bond policy that actually has a strong impact?
Yeah, so I think the first really key piece is that there be a substantial amount of money put into the accounts. So we want to ensure that by the time the children reach adulthood, that they have enough money in there to make one of those purchases that I mentioned, a home or a small business or post-secondary education. And so there needs to be a significant amount of money put into the account. That amount does differ depending on the local context and the local market, but it needs to be kind of in the thousands to tens of thousands of dollars to be put in that account, with the most money going towards kids from households with the least resources. And some of the other kind of key elements are that there should be automatic enrollment so that no children get left out. So basically, if you're kind of born in the US or you're born in a particular state and you're eligible, you're automatically enrolled. Another piece is making sure that the program doesn't affect families' eligibility for the benefits that they use right now, so SNAP or Medicaid or cash assistance. So we want to make sure that these funds don't count towards their eligibility for these benefits. And then the last piece is really about sustainable funding. So this is a long-term investment in children. And we want to make sure that, this money doesn't disappear if financial kind of budgetary pressures change or political winds change. So having kind of a dedicated source of funding that ensures that the program continues for generations to come is really important.
And then, Shira, at the federal level, what's being done for baby bonds? What is the status of the proposals being done there?
Yeah, so there was a proposal reintroduced in February 2021 by Senator Cory Booker and Representative Ayanna Pressley, the American Opportunity Accounts Act, which would create a national baby bonds program. It had 15 co-sponsors in the Senate from across the Democratic spectrum, so from Bernie Sanders to Amy Klobuchar and Senator Chuck Schumer. Unfortunately, it's kind of caught in the same situation with the closely divided government that we see elsewhere in DC, on other programs in DC, and so we don't really expect it to pass in the short run. But what we have seen in the last 2 years is a growing interest in passing programs at the state level, with states saying, we don't need to wait for the federal government to act. This is something we can do. And so last year, Connecticut passed legislation and DC passed legislation. And so this is something that we feel is really going to be helpful in kind of building momentum towards eventual passage in Congress.
And then, Shira, how do baby bonds fit with other areas trying to sort of help shore up financial stability for young kids? How does it compare, for example, with extending child tax care credits permanently, for example?
Yeah, so, the baby bonds program is really trying to address a very specific issue, which is the racial wealth divide. But we know that really income is also important. It's basically a foundation for people to then be able to build financial security and wealth. And so we want to make sure that we're also addressing that at the same time. So we don't see baby bonds as a standalone program. We see it as kind of part of a suite of services that addresses financial security. And so the child tax credit, we at Prosperity Now are big advocates of permanent expansion of the child tax credit, which is providing money each month to, or had been providing money each month to families with children. And so these really go hand in hand because you have baby bonds setting money aside for kids' future while the child tax credit is helping families to become more financially stable and financially secure in the kind of shorter term.
Okay, we will leave it there. Thank you so much, Shira Markoff, Prosperity New Policy Fellow. Thanks for stopping by today. And Funding Our Future is an alliance of organizations dedicated to making a secure retirement possible for all Americans. Alexis.
All right, Karina, coming up, where did all of that COVID stimulus money from the government go? Here's a clue, not always to the people who needed it most. That's up next. It turns out the government's $800 billion Paycheck Protection Program did a lot to protect wealthy Americans during the COVID recession at the expense of ordinary workers. Joining us now is Yahoo Finance senior columnist Rick Newman with more. Rick, I know you wrote a story about this, and this is not just you saying it. This is based on research from nearly a dozen economists at MIT.
Right. This is led by MIT economist David Otter. And he and his team looked at where did the money go from the Paycheck Protection Program. That was almost $800 billion in loans that went out in 3 tranches, 2 of those in 2020, right after the COVID pandemic hit, and then another one in 2021. So they found that some of that did make its way to workers as intended and did help keep people employed. But they also found that a big chunk of that money, around $366 billion, ended up helping out the top 20% of earners. And the reason for that is those are the people who own the businesses and those are the shareholders in those businesses. So just as a quick reminder, the PPP was meant for smaller businesses, those who had fewer than 500 workers, and it was supposed to give low interest loans. Many of those are going to be forgiven to businesses as long as they use the money to keep people on the payroll and keep people employed. And it just so happens that when you funnel money to businesses, it has to go to the business and the business owners first. And it ended up being a big windfall for business owners. That's not inherently bad. It doesn't mean they all went out and bought yachts or beach houses with it, but it means that a lot of that money just did not filter down to workers, ordinary workers, which was the intent of the program. So I think this type of research will be used in the future when we have another downturn and Congress has to figure out what's the best way to get the best bang for the buck for taxpayer dollars. I think we'll probably see modifications to this type of program if we see another PPP at all.
Well, Rick, this is Karina. So, Democrats want more pandemic relief. McConnell just came out and said, let's account for all of the money that's still, the billions that are still in the pipeline. So how likely are we to see any more stimulus at this point?
Well, it can't be very likely, Karina. I mean, first of all, Democrats cannot get their act together in Congress. They seem to be running in every direction, trying to get a voting rights law passed, get Build Back Better resuscitated. That is Biden's program, which they, basically died. They have to do a funding bill to keep the government running. They have a Supreme Court nominee they have to get through. And by the way, Democrats no longer have a one-seat majority because the senator from New Mexico, Senator Lujan, just had a stroke, and he won't be on the Senate floor to vote. So Democrats don't even have that slim majority they used to have for at least until he comes back. So I don't think we're going to see much additional stimulus. And if we do see anything at all, it's going to be very, very targeted to the industries and businesses still hurting the most, which is mostly restaurants and other service sector businesses that just cannot get back on their feet because we keep having new COVID surges.
All right, Rick Newman, thanks for breaking it down for us. Appreciate it.
Hi, guys.
Okay, thank you. And we have much more market news ahead as we get you closer to the closing bell and those Meta earnings and an interview with the architect of his own real estate empire, Ryan Serhant. Stay with us.
Private jobs plunge in January as the Omicron variant puts a big dent in the labor force. What does it really tell us about the health of the job market and what the White House is saying about Friday's all-important monthly unemployment report? CNN boss Jeff Zucker resigns suddenly from the network, stunning the media world. What brought Zucker's 9-year tenure to an abrupt end? And who will take his spot as CNN's parent company, Warner Media, gets ready to close its mega merger with Discovery? And newly minted cryptocurrency millionaires and billionaires are showing a love for real estate. The star of Bravo's $1 million listing, Ryan Serhant, is here with an inside look at just what these crypto kings are buying in the luxury market. Hello, everyone, and welcome back to Yahoo Finance Live. It is 2 p.m. Eastern here on the East Coast. I'm Alexis Christoforous along with Karina Mitchell. Taking a look at the market, stocks having some modest gains here as investors wait for earnings after the bell from Meta and Spotify, among others. Of course, those disappointing payroll figures from ADP, perhaps putting a bit of a lid on today's gains. But Google has certainly popped the lid off earnings. Parent company Alphabet absolutely crushing it after yesterday's closing bell. Jared Blickery here with a closer look. And Jared, I know it is the #2 top trending ticker on our site.
Yes, and King Google, just king of the search. Look at that, up 8%. That is a huge move for a stock that is nearly $2 trillion. Let me put our market cap view on. You can see 1.98 trillion, so just climbing right back into that space. You can see Apple just a bit shy of 3 trillion. But let's go back to the charts here. I want to chart the year's price action because Alphabet has really exploded. It was one of the year's top performers last year, and you can see we've climbed right back up to these highs after kind of a nasty shakeout that saw a lot of the mega caps flailing. Also, a lot of focus on that 20-to-1 stock split. That would bring the price right back down to about $150. And investors will remember several years ago when Apple, or before Apple just joined the Dow, that it made a stock split that brought its price back down to earth. Also, even if that doesn't happen, it's going to make it accessible for investors, and there's lots of excitement over that. I do have some comments from the street, and here's BMO Capital Markets. They rate the stock an outperform, and they have raised their price target to $3,300 from $3,200. You can see that's $320 above the current price. They're saying while investors continue to worry about margin contraction in 2022, Google seems to be benefiting as search, quote, crushes it again. The read through to Meta platforms, and as you said, Alexis, they're reporting after the bell today. The top line is positive, and it's also a mixed signal for Amazon margins. We're going to be tracking those this week as well. Also want to take a note from Morgan Stanley. They rate the stock an overweight, and they have raised their price target to $34.50 from $34.30. They're saying bullish signs include the EBIT beat, though operating cash flow missed because of taxes. Retail and e-commerce innovation keeps on delivering value for advertisers, with search revenue beating NOAC's estimates by 3%. The stock split indicates Google is becoming more shareholder friendly, putting more pressure on Amazon, guys.
And Jared, PayPal going the complete opposite direction of Alphabet, dropping the most on record after being downgraded.
This is a nasty report for PayPal. Let me just put our percentage returns here. 25% in one day. This is a huge stock. This is a $153 billion stock. So let's take a look at the price action, because on a steep decline like this, you want to see where they've fallen back down to. So let's put a 3-year chart up, and you can see back down to 2020 levels that we last saw at the beginning of the pandemic recovery. And you take a look what's happened over the last year. A lot of payment companies, they kind of topped out in the middle of 2021. Well, PayPal as well. You can see it's been shaved in half over the last year. And let me get to some of the street commentary. First, I want to start out with BTIG. They say that they cut the rating to neutral from buy, and that's after fiscal 2022 guidance fell well short of expectations. Of note was guidance for net new active users of 15 to 20 million, which would be down from 48.9 million fiscal year 2021 and well below expectations of year-over-year increase. And I believe they had to cut something like 4.5 million accounts because they had a bunch of bots that were taking advantage of a rewards program. So not as much growth as previously estimated, and investors are taking their medicine today, guys.
You better believe it. That is true. All right, want to get to our Yahoo Finance Plus investment idea of the day. A bullish call on ExxonMobil. I know they had pretty spectacular earnings earlier in the week, and perhaps no big surprise because it's just been following the price of oil higher.
These companies are finally minting money again. They said they're going to increase their operations in the Permian next year or this year by about 50%. So that's an incredible increase. I do have some comments from Argus Research. That's where this Yahoo Finance Plus note comes from. And by the way, this stock is up to multi-year highs. So let's read what Argus has to say. Their long-term price target is $92, and they're upgrading it to buy. They say, we expect Exxon to benefit from strong energy market fundamentals, as well as from its improving balance sheet. Of course, that's based on the price of oil remaining high, reduced capital spending, and higher free cash flow. We also see the potential for dividend hikes, share repurchases, and further debt repayments this year. Energy companies return a lot of their cash to their shareholders. Also saying that Exxon is taking more steps to address climate change, continues to target net zero greenhouse gas emissions by 2050. That's a long ways away. Management also said it would reach its 2025 emissions reduction targets ahead of schedule by the end of 2022. They go on to say they're going to up their price target. I'm not going to get into the details here. I just want to chart what's happened with Exxon, which is tied to oil over the last year. Really exploded since mid-December here, but up 75% over that time period. Pretty impressive for an oil company that had really been left for dead not too long ago.
Yeah, impressive chart indeed. All right, thanks for bringing that to us, Jared Blickery. Want to stick with the markets now and bring in Art Hogan, National's chief market strategist. Hi, Art, always good to see you. I want to start with this, I'm going to call it stunner of an ADP payroll report. Companies cutting over 300,000 jobs last month as Omicron really slammed the labor force. Why isn't the market reacting more aggressively to this report, do you think?
Well, I'm pretty sure the White House gave us a sneak peek at just how bad the Omicron variant and the seasonality around December were going to adversely affect the jobs numbers this week. So remember, we'll get the non-farm payroll number at the end of the week, and the White House beat the Christmas rush and got out and reminded everybody that especially the week that we're measuring was the peak of case discovery for the latest variant. So that obviously had some effects on the numbers. I think what's important here, clearly we need to look at the trend, right? And the 3-month trend versus any point in time, because there's a lot of volatility around these numbers. And clearly the ADP number last month was 2x what we thought what the estimates were. So, it's one of those things where we're just going to have to get used to the short but shallow economic damage that we saw because of the latest variant. This is one piece of that. We also saw that in some of the retail sales coming out of the December month as well. So clearly Omicron had an effect. The good news is most of that is likely behind us. We've clearly peaked in new case discovery. So the months of January and the first quarter likely get sequentially better, especially around labor inputs.
I know economists are expecting non-farm payrolls to have expanded by about 150,000. I think that would be the weakest since the end of 2020. What are you expecting there, Art?
Yeah, we're not too far askew from that estimate. We're at 163,000, but again, we all of the estimates that we've seen over the course of the last 6 months have been pretty far off of the mark, and most of the misses that we've seen have been in the upward revisions that we've seen on a 2 and 3 month basis. So if you actually include the upward revisions that we've seen just in the third quarter and the first 2 months of the fourth quarter, that adds another 175,000 jobs that were created. So I just think that it's difficult to count the number of jobs created in any given month. We've always had big revisions, but this is the biggest delta between the initial report and the final revision that we've seen going back for years, probably as long as the data has been kept. So again, we don't really want to point to any one point in time and say this is a new trend. I would argue that the difficulties that employers had with creating new jobs. And remember, if you were out sick with or going through your 5 or 10 day quarantine with the Omicron variant, you weren't counted as a job. That came off of the payrolls. So I think there's going to be a short-term blip. I think once we start getting the January and February numbers, we'll be back to that resumption of creating somewhere between 200 and 400,000 jobs a month.
Yeah, definitely is going to skew the numbers for sure. Want to get your tech though on big tech, your take rather on big tech, because it really had a rough start to the year. But so far this earnings season, the news has been pretty good from those mega caps, right? We had a pretty spectacular earnings from Google's parent Alphabet and Apple. We are going to hear from Facebook's parent Meta after the bell today. Amazon out tomorrow. What's your feeling on the sector overall right now?
Well, we certainly have seen a lot of multiple contraction. I think that goes without saying when we think about how much that space has come in from its all-time highs, and this goes all the way back to the first week of December. So it's not just a 2022 event. We've seen, for a variety of reasons, we've seen multiple compression and growth, and most of that predicated on yields rising. And clearly from the beginning of December, the yield on the 10-year was at or about 134. It got as high as 188. We kind of settled into a 1 3/4 range now over the last couple of weeks. But that multiple compression to get back to net present value on some of these fast-growing technology companies clearly came at us very rapidly. So therefore, I think you have situations like Alphabet coming in with a blockbuster report, not trading at or near its all-time high at the time. So I think the earnings season will be more favorable for some of these names to come out. I think that includes Apple and certainly includes Alphabet today. And when we look out at Microsoft's report and the ones that are coming up like Facebook, I would certainly say they're coming in at a much better place to have a more conventional reaction function to what the news is.
All right, and finally, I know that your target for the S&P 500 is 5,300. That would be roughly a 13% gain. That's a pretty bullish outlook. What do you think is going to get us there, Art?
Earnings. I think we're going to see earnings growth above mean earnings growth for 2022 for the S&P 500. The consensus right now sits at about $225. I'm up at $240. I think we'll start to see revisions higher for earnings estimates as we work our way through this earnings season and into the first half of this year. So if we just used a simple multiple, the average multiple that we traded at for the last 3 years on those earnings, that gets you to 5,300. Not suggesting that happens in a straight line, but I certainly think that we're going to have above mean GDP growth in 2022. I think we're going to have above mean earnings growth. Typically the first year of a rate hike cycle, you're able to accomplish about half of what you did the year before. We had a 26% return on the S&P last year. So, suspect that it's not that much of a reach to think that we can have high single digits or low double digit returns in the S&P.
All right. Clearly, you see the glass is half full, Art Hogan, National's chief market strategist. Always good to see you. Thanks so much. On the other side of the break, the biopharma startup with a promising new COVID-19 treatment. We're going to be joined by the CEO of Sorrento Therapeutics next. The biopharma company Sorrento Therapeutics says its COVID-19 treatment Covishield shows significant progress in neutralizing Omicron and Omicron variants. Covishield was discovered by scientists at the Icahn School of Medicine at Mount Sinai and further developed by Sorrento. Joining us now to discuss is Henry Ji. He is Sorrento Therapeutics chairman, CEO, and president. We're also joined by our health reporter, Anjali Kemlani. Henry, good to see you again on the show. First off, just in layman's terms for us, tell us what Covishield does and how far away are we from it actually coming to market?
Yes, thank you very much, Alexis, for inviting me. And the Covishield is a neutralizing antibody that binds to the spike protein of the virus, and that basically blocks the virus get into the cell. And we have two different forms. One is IV injection, one is intranasal, which requires very tiny quantity of this antibody. For example, if you do IV injection, you need hundreds of milligrams to grams. We only need 5 milligrams also. So you can imagine 100 to 100,000 fold of doses you're using our Covishield with the neutralizing antibody.
Henry, I wonder about looking at it from the marketing perspective. Just first of all, Covishield also is a shared name with a vaccine available internationally. Do you have any plans to rebrand or rename this right now?
So we actually have multiple names, backup names in place already for this, and our folks knows how to do marketing because my marketing chief formerly works for Pfizer, Eli Lilly. He actually the one named Viagra, so we have multiple good names in places.
Lovely. But let's look at also, of course, what you have in terms of the timeline for this. Obviously, you mentioned that it is effective against Omicron. And we know that though Omicron is on its way down, at least for now, we are expecting that there will be other variants in the future. Can you map out a timeline of how you expect and when you expect this to be widely available and what you're planning to do in the event that we find new variants?
Yes. So firstly, we said in our press release that we're going to file within a month. So we're actually so happy we filed yesterday, IND filing. So hopefully it gets into human proof concept in the next couple of months or so. Then we're going to be able to do very large clinical trial in a few thousand patients, try to get the EUA application submitted to FDA here in the United States and the Coffee Press in the Mexico and the UK as well. And we believe that our antibody is very unique. It binds to a pocket, we believe, not susceptible to the mutation of the virus. It's very conserved regions. We believe that will be avoiding any future variants and that the impact to a different type of neutralizing antibody. And meanwhile, the company is working on some of the radical strategy that could be has nothing to do with the virus mutation. And we're using that as a combination with a neutralizing antibody that will be able to address any type of variants coming up. And we're very close to get that in place as well as a combination for the Covishield.
Got it. What about the long haul study? I know that you're taking charge of in Brazil. Where does that stand right now, and what do you hope to achieve in looking at this?
Yeah, so we have stem cell, which is mesenchymal stromal cells. Right now, it's already finished the very large clinical trials. In the middle of very big trials in the Brazil. And we believe that they're going to help to restore the tissue repair, and that will get over some of the lingering effect from a long COVID syndrome, such as the migraines and some of the shortness of the breath. So we have that one ongoing right now in Brazil.
And Henry, I know that aside from COVID, really when the company was started, you were looking at cancer treatments. And I know today President Biden is announcing the relaunch of the Cancer Moonshot program that was started during the Obama administration. What does that mean in particular for your company and for the treatments that you're working on?
Yeah, so we're actually having a compound called abivertinib, which already finished pivotal trials in the non-small cell lung cancer that has very good overall response and the overall survival. So we are going to be apply it to the FDA for pre-NDA meetings. If they get the FDA consent, we may be able to either get the drugs approved or do a bridging study to get the drugs approved very quickly as a tool for the non-small cell lung cancer. And the same drug can be used for lymphomas and prostate cancer, and as well as some of the other cancer tumors.
So, and Henry, I just wanted to get your thoughts on what's happening, not just with your company's stock, but sort of with the sector right now, because we saw a rough start to the year for a lot of the small and mid-cap biopharma companies, Sorrento Therapeutics included. I was taking a look at the Spider S&P Biotech ETF, and you see by that chart there, it's trading near a 52-week low at the moment. What is Wall Street missing, perhaps, with the sector, but more specifically with your company? Are they maybe concerned that Sorrento is more of a pure COVID play? And do you need to start changing that messaging?
Not really. We always messaging as cancer, as well as non-opium pain management. Our compound actually progressively moving to a much mature stage. We have the phase 3 with the cancer drugs in place, and we have non-opium pain management, which is a big emphasis by the Biden administration for non-opium pain management. We have that phase 3 already done with the data, amazing data. We released it. So we're gonna do a requesting for breakthrough status from the FDA and submit the NDA to the FDA. We believe we're gonna be much mature now. And if you look at the merger acquisition activity in the space, this year it's very light. However, the big pharma has a lot of cash on hand, and they need a mature compound, which a company like us gets to a mature stage. You're gonna get a lot of interest from the big pharma, either do a license agreement or do some of the asset acquisition, which we believe Sorrento has plenty of the assets in place.
All right, Henry G., Sorrento Therapeutics Chairman, CEO, and President, thanks so much for being with us today. Karina?
Stunning news from CNN. Jeff Zucker announced his resignation effective immediately. What's behind it and what's it mean amid the Warner Media spinoff? Stay with us. Welcome back to Yahoo Finance. CNN Worldwide President Jeff Zucker, the influential news executive who reshaped the cable network, abruptly announced his resignation and said he's stepping down effective immediately. With more, let's bring in our Yahoo Finance's Alexandra Canal. Ali, this is all tied to a deeper probe as part of a question into the Chris Cuomo scandal.
That's right, Karina. CNN has really dealt with quite a few controversies in recent months. Now we have Jeff Zucker resigning as a president of CNN and chairman of Warner Media's news and sports division. He wrote in a memo that he failed to disclose a consensual relationship that came up during an internal investigation into the conduct of Chris Cuomo. Cuomo was a former primetime anchor at CNN who was fired back in December over his involvement in aiding his brother, former New York Governor Andrew Cuomo, during his sexual harassment scandal that ultimately led to his resignation last summer. The memo that Zucker released reads in part, quote, "As part of the investigation into Chris Cuomo's tenure at CNN, I was asked about a consensual relationship with my closest colleague, someone I have worked with for more than 20 years. I acknowledge the relationship evolved in recent years. I was required to disclose it when it began, but I didn't. I was wrong. As a result, I am resigning today." Now, the relationship in question is one Zucker had with Allison Gullis. She is executive vice president and chief marketing officer at CNN. She also once served as communications director to Andrew Cuomo. So a few ties there with the Cuomo brothers. She will be keeping her job at this time, but she was also potentially rumored as a very possible successor to Zucker. Zucker had been at CNN for 9 years. He was heavily involved with the creation of CNN Plus, the streaming service that the company will be launching this spring. The scandal also comes at a time when Warner Media is about to be spun off, merged with Discovery. Zucker was very chummy with David Zaslav, the CEO at Discovery. In fact, Zucker called him the best friend that anyone could ever want. So there was a big expectation there that Zucker was going to take on a more expanded role after that merger. So this definitely throws a lot of things into question at a time when CNN is clearly going through a ton of changes at this point.
Yeah, really pivotal time for them. I know they've got their streaming service in their back pocket waiting to launch that as well. So, I mean, look, the leadership there was taken off guard. They're scrambling to find a replacement. Any word on who will get the top spot there? And do you think they're going to look outside the organization, Ali?
So Jason Kyler, the head of Warner Media, just announced that CNN will have not one, not two, but 3 interim co-heads. That will be Michael Bass, Amy Entelis, and Ken Joutz, while a search for a permanent leader to succeed Zucker is still ongoing. Kyler said that these 3 interim co-heads are expected to lead, quote, "through the close of the pending transaction with Discovery." As you were saying, clearly this was a bombshell announcement. CNN's Brian Stelter saying that the network was stunned by the news. So I don't even think a potential permanent replacement is even on the radar right now. I think it could be a possibility that they'll look outside of the organization. But I think right now things are just a little bit messy. They're just trying to scramble, get someone in there at the moment. And clearly they think 3 people need to be there to do the job. So I am curious to see who they'll eventually choose for that permanent role. But right now, I don't think they're even close to making that decision.
Right. Now, they definitely need some time to digest all of this. I mentioned that streaming service. I know that it was supposed to launch in January. It sounds like it's going to be more like the spring of this year now. Have you heard anything at all, Ali?
Yeah, it is expected to launch officially around the spring. Of course, that's going to be entering a very competitive market as we have Netflix, Hulu, HBO Max, Paramount Plus. So we'll see how CNN does with that. I know they are recruiting a lot of their top anchors to be involved in some of the programming there, have also hired a lot of new faces. So, right now, if you're at CNN, if you're working there, your mind is sort of spinning, right? I mean, there's just so much news that has happened and so much change that has happened at the organization. I'm sure we're still going to get more information about this internal investigation into Chris Cuomo. Clearly we have Zucker stepping down. Could there be more people, more executives that are going to make announcements coming up? It's just something to keep an eye on. And Zucker was one of the most influential people in the media business. So it's something that, especially in our industry, we're paying paying very close attention to.
Yep, absolutely. Alexandra Canal, thank you so much. A lot of colleagues blindsided by this one. We'll leave it there. More to come, I'm sure. All right, we are going to take a quick break. On the other side of it, a check on the energy sector and how crude settled after OPEC Plus stuck to its output target. Stay with us. Welcome back to Yahoo Finance. I want to turn your attention to the oil sector, and OPEC Plus sticks to its targeted rise of 400,000 barrels a day. Here with more on that and how crude settled, let's bring in Yahoo Finance's Jared Blickery. And Jared, this move was expected.
Yes, it was. They've been increasing, this is OPEC Plus now, they've been increasing their production by 400,000 barrels per month since about mid last year. They finally got the UAE on board, and this plan is set to go into effect for many more months here. So we're going to be tracking all of this. Not a lot was expected to change out of this announcement, so we're not really seeing the price of crude oil change that much either. You can see it settled at about $88.16 or 26 cents, just a few cents off from yesterday. But I like to show these longer term charts. Definitely an uptrend right there, up 32% over the last 2 months. And let's check out the energy sector, which has been on fire this year, but maybe not so much today. Exxon, which recently reported earnings, we've been talking about those since yesterday. That stock is down about 0.5% today. Not seeing a lot of big movers here. Let me just check out the price of Chevron here, because it recently reached record highs, and you can see it is up over 17% over the past 2 months. And as we head into the rest of the week, not a lot else on the calendar in terms of energy. I will throw out there too, we got a surprise drop in the U.S. in inventories by about 1.8 million barrels. The expectation was for the opposite, an addition of about that same amount. So there are a lot of market participants who are concerned about there being a structural deficit in supply in the oil market. And what happened today with OPEC Plus increasing that production as scheduled, still leading to some rising fears about the price of crude oil going even higher. That has WTI knocking on the door of $90 per barrel, and Brent's already there.
Okay, Jared Lickery, thank you so much for that. We will leave it there. It is now time for the ETF report brought to you by Invesco QQQ. Many investors are bracing for a more volatile stock market this year, but investment in specific sector ETFs could provide some opportunities. Here with more on that, let's bring in Reggie Brown, principal at GTS. Reggie, thanks so much for being here. So I have to start talking about tech because January was just a horrific month for that sector, but February so far seems to be looking up. The month is early, but Alphabet came out with some stellar earnings. Apple also record numbers as well. So is it too volatile to start looking perhaps at jumping into the tech sector, or is this actually a good time to sort of maybe come up with some, good deals? And if so, which particular areas should we be looking at, in your opinion?
Sure. Well, what we're seeing, some investors have actually stepped in and starting to buy tech based on historical levels. These are interesting levels based on some of the fundamentals of underlying companies. We're seeing a lot of action in the technology sector ETF XLK, where the top holdings is Apple, Microsoft, and NVIDIA. And then we're seeing a lot of interest in software ETFs. So one, for example, is iShares IGV, where again, the top holdings there is Microsoft, Salesforce, Adobe, and Intuit. So I think there's a lot of opportunity, and we're seeing investors placing bets that on a fundamental basis that the January sell-off is a good place to start stepping in. And those ETFs I mentioned previously, are good examples to get broad-based exposure from a sector basis.
And so, what should investors be evaluating before deciding on investing in sector ETFs, particularly amid all of this volatility, right? What's your advice, perhaps as far as duration and how often to reassess this year as far as rotation strategies as well?
Well, as rates go, as Fed funds go to 2%, the market is priced in 7 hikes of 25 basis points each. So that gets us somewhere in the boundary of 175 to 2% in the Fed funds rate. Higher rates generally are not great for growth stocks. They absorb a lot of capital. But literally, I think investors should be looking at just individual companies and taking sector bets based on long-term growth opportunities. I think there's some fantastic buys out there. We're not going to stop buying Apple products. And that's representative of just the globalization opportunity in technology and the change in the economy based on technology. So investors should look at the big picture here and not necessarily react to short-term movements. I agree, January was somewhat abrupt, but we've also had a long run in the marketplace.
And then, Reggie, what about energy ETFs? Because they've been a big play, but amid all of this heightened volatility and, geopolitical tensions, do you think they're a good investment right now?
Well, they've had a great run. Your analyst just talked about, the price of crude. I think, a lot of points to what happens in Russia around Ukraine, and if President Putin does cut off supply to Europe or starts playing around with that. So a lot of analysts start to point around to $150 for a barrel of crude. Personally, I think some of the areas to invest in using ETFs is the Invesco DB Oil Fund. It's a futures-based ETF that tracks the price of crude using futures. That's had a terrific run. And then if you look at sector ETFs, PXE, which is another Invesco Energy Explorer Driller ETF, where the top holdings there is EOG, Occidental, and Phillips Petroleum 66. And analysts are increasing their buy ratings on underlying fundamentals of these companies. So I think it's a good opportunity to step in and go for the ride. If geopolitical forces do dictate oil is going to go to $150 a barrel, and then of course the output from Saudi Arabia.
And then, Reggie, also, before we let you go, also you suggest some ETFs for rate increase environment as well that may be good plays as well. One of them, BLKN.
Yeah, in a rising rate environment, you want to be in rate adjusted products. And there are 3 that I'm very familiar with. I launched BKLN for the senior loan ETFs a number of years ago. That's great for a rising marketplace. And then also, we're seeing a lot of action in the 3 and 7 year duration Treasury ETF, IEI from iShares. So these are great products for a rising rate environment. And another one, a smaller ETF, is the Pacer floating rate ETF, and that ticker is FLRT. And as you do sector rotation and you want to preserve cash and you want to get conservative, having a short duration or a rate adjusted ETF makes sense. And these are all tradable, and the capacity of these ETFs are quite large, easy to absorb large amounts of capital inflow in one day.
Okay, well, record inflows into ETFs last year, so we'll have to see if that momentum continues. Thank you so much for your time today, Reggie Brown, Principal at GTS. Alexis.
All right, on the other side of the break, how crypto millionaires and billionaires are fueling the real estate market. Welcome back to Yahoo Finance Live, everybody. Newly minted cryptocurrency millionaires and billionaires are driving the luxury real estate market right now. Here to fill us in is Ryan Serhant, CEO and founder of the Serhant Real Estate Firm. You also may know him as the star of Bravo's $1 Million Listing. Ryan, it's great to have you here on the show. So I am curious what you are seeing. I mean, how much of your business is made up of these so-called crypto kings? And also, I hope you brought along some examples of what they're buying up right now.
I would say a very noticeable dent in our business. It's not going to be set off this year as a massive percentage, but it's enough so that we've really started to take account of the number of people who are either offering with a various form of cryptocurrency, wanting to purchase things wallet to wallet, if only to do it that way, because anyone who is in cryptocurrency to the millions of dollars really believes in how crypto is going to change the future. And so therefore they want to prove that they can do anything with cryptocurrency instead of US dollars, for example. And it will become more and more and more so as banks decide to lend against crypto. Like you saw, there's a company in Florida, I believe it's Milo. There's a company, Genesis, that's lending against NFTs now. And these aren't just fads; these are starting to take hold. And banks want to make money, right? They're incentivized to make a profit. And if more and more people are coming to them to use cryptocurrency to invest in anything, including real estate, banks will take notice and they'll start to allow it and they will start to keep it on their books. And that's what you're going to start seeing over the next couple of years. So it's been very, very active this year, very top of mind.
And then, Ryan, what sort of strategies are you seeing that brokers are using to sort of get up to speed and to be able to bring in people who are interested in using their crypto to finance buying real estate?
Well, I think, I believe only it's 90% of Americans are aware of cryptocurrency, but only about 15 or 16% say they've actually invested, traded, or used it, which is up from 48% and 1%, right? Respectively, just 6-7 years ago. There are 15,000 tokens and 484 global exchanges. But the two main currencies are still Bitcoin and Ethereum, which contain about 40% and 21% of the total market cap, respectively. And which means, though, that there is a growing effort towards using cryptocurrency, not just as a place to invest, which is what it's been for the last decade, but as a place to actually transact. And for us in the real estate space, I'm not just as excited to sell someone a home using Bitcoin or doing a wallet to wallet transaction, or maybe selling an apartment for more money or a home for more money to somebody overseas because it's easier to do than doing a conventional purchase. I'm excited about disrupting an industry that really hasn't changed in the last 100 years. We still sign contracts the same way today for a home that you did in 1950. Sure, now you do it maybe on DocuSign, or you're going to do it on your phone, but it's still the same. There's no protections. There's no saying that there's no forgery or any type of security. It is a photo of a piece of paper with no record attached to it. If you drop the term NFT and just think about a title or deed, okay, and a contract of sale as a non-fungible, quote unquote, token or a non-fungible contract, which you're going to start to see. So an NFC, then you put that out onto the blockchain, which is a massive cloud-based ledger where anyone can write to it and everything is recorded. That seems like a much safer place for me to transact a multi-million-dollar purchase. And that will come after the banks adapt and adopt crypto as a viable purchasing tool and solution. I mean, you're already seeing it. There was a penthouse in Miami at Arte Surfside that sold with full cryptocurrency for $28 million. I sold the penthouse there at that same building for $33 million. People who are have this type of money are spending it, even at smaller dollar price points. It's an exciting time.
Well, I mean, that's a lot of money to be putting down on a place. I know that Brian Armstrong, who's the CEO of Coinbase, spent $133 million on a Bel Air estate. But I'm curious if people like Brian Armstrong, right, the big names in crypto, are ultimately making these purchases in their crypto of choice, or are they still doing it in the US dollar?
Well, Brian is worth $10 billion in US dollars because he created a company called Coinbase that went public and has done incredibly well and is the provider for all currency exchange, right, in crypto. And so I doubt that he bought that using cryptocurrency. Some of the major crypto founders that we're working with, helping them buy property all over the world, they're still using US dollars, in part because they want to maintain that kind of privacy, and they just have it. If you have $1 billion in Bitcoin, you can kind of do whatever you want. What I'm actually seeing, though, a lot of is not the billionaires, right? It's not the billionaires looking to buy something in Bitcoin. It's the person who has a regular job, a W-2 9-to-5, who 5 years ago, a friend told them about cryptocurrency. They put, $25,000, $50,000 as a bet on Bitcoin. And today that's worth a lot more money. Now that person though, because their job doesn't allow them to qualify for an incredible loan, let's say at JP Morgan or at Wells Fargo, but they have amazing assets with crypto, now has to go to either a crypto lending firm, okay, like Milo, right, the crypto mortgage company that's based out of Miami that's doing well, or they're liquidating and they're paying the tax on it. Right. So, you're not paying tax on the cash that's sitting in your bank as long as you've already paid the income tax, right? Or as long as you've already paid the capital gain tax. And so those questions are coming up for a lot of these people and saying, hey, I can't use my regular ordinary income and my W-2 tax return to afford a $2 million apartment or a $3.3 million house, but I have that in Bitcoin because I believed in it for a long time and I've invested in it. What do I do? Do I have to cash it out, pay the tax, and then go buy something? That's not fun. How do I get around that? How do I do this in an intelligent way and maybe use the currency and pay the tax to actually buy, right? Without having to pay a mortgage recording tax. In New York City, for example, there's a nearly 2% tax on the mortgage amount. New York City taxes you for your right to get a loan. So if you are going to get $1 million mortgage, you are now paying, nearly $20,000 to the city to say, thank you for allowing me to get a mortgage in New York City. If you have that already in crypto, why would you want to pay that additional tax? So it's about being tax efficient and basically just being financially efficient, and moving the process forward. Like, how long are we going to do things the same exact way? We're not.
Ryan, you're definitely an innovator, and so many people look up to you and admire you. You really built, an empire in the space of just about a decade. I want to talk about more broadly what the market is looking like. You opened your namesake brokerage back in 2020 during the peak of COVID. Why was that the right time to do it? And how did you know that the luxury market would bounce back? And has it bounced back? Is it pre-pandemic levels, specifically in the luxury space?
It definitely was not the right time. The city was on fire. Everyone had left. But, I say that kind of, tongue in cheek because it was the right time for us. The last thing I wanted to do was start a real estate firm in a city where it would be an obvious choice to do so. Like today, the market's high. $30 billion in residential transactions were done in 2021, the most ever spent on real estate in New York City history. So if I started a firm today, then obviously, of course you did, right? When markets are high, everyone is doing everything. I chose that time because it was a once in a lifetime opportunity to go against the grain in every single way possible. And I'm a marketer at the end of the day. Because I was the only person doing it, and because I was one of the only people out there talking significantly about the success of New York and how quickly it was going to come back and how it wasn't going to be an L shape or a U shape. It was going to be a straight V shape recovery. And everyone said, man, I don't know. Florida's great. Wyoming is good. We were able to make a lot of noise for the company and the brand. And I had the biggest year of our entire career last year, in part because of that. And I work with, great people. I have a great team. I have great publicists. I have great staff and great agents around us. Even Brooklyn last year, if we're talking about New York, did $16.6 billion in transactions. Long Island City did $1.6 billion in transactions in 2021. There's massive optimism for major market real estate transactions and for the entire nation. I mean, the United States as a whole and the planet right now, but the United States as a whole, the average days on market for a home is 22. And that's long in a lot of markets. And so it's a great time to be a seller of real estate. It's a tough time, but also I think still a good time to be a buyer because interest rates are still low. The Fed has the Fed has said that they will do an uptick, which isn't directly correlated to mortgage interest rates, but they will have a residual effect. And you still have opportunity. Pricing as a whole hasn't recovered to 2015 levels, which was the top of the last peak as we track it. So even if things are tough out there and you're a buyer, you can still find a great house, pay less per month for it, and get what you want.
All right, Ryan Serhant, we can go on and on, but thanks so much for your unique perspective, CEO and founder there of Serhant Real Estate Firm. Thanks so much for your time. Karina?
All right, and we will leave it there, but on the other side, we'll get you a quick check of the markets. Stay with us. Welcome back to Yahoo Finance. I want to get you a quick check of the major benchmarks before we send you over to our colleagues. So looking at the three majors, all in the green right now. The Dow up by 210 points. The S&P on its fourth straight day of a winning streak, up 38 points. The Nasdaq having a great day today as well, up 56 points, thanks in part to that Alphabet beat on earnings and its 20-to-1 stock split. All right, that will do it for myself and Alexis Christoforous, but we will have much more Yahoo Finance Live after a quick break. We'll send you over to our colleagues as they count you down to the closing bell and those Meta earnings coming up.
Earnings season revs up as Alphabet pulled the Nasdaq higher to begin the trading session. We'll see if it ends higher. And that was on its blowout earnings delivered on Tuesday. The beat on expectations also coupled with the announcement of a 20-to-1 stock split from the parent company of Google and YouTube, among other names as well popular in your home. Hoping to follow in Alphabet's earnings success are the parent company of Facebook, Meta Platforms, Spotify, and Qualcomm, all reporting after the close today. We'll break those down for you. Plus, as the pandemic nears its third year in March, new variants have posed a heightened threat to reopening plans as the U.S. reaches levels unseen in infections and mortality, even after 64% of the population has been fully vaccinated. Former White House health policy advisor Dr. Zeke Emanuel joins us shortly with his view on where we go from here. And the NFL faces yet another critical moment stemming from race relations. Miami Dolphins former head coach Brian Flores filed a racial discrimination lawsuit naming the NFL and saying in part the NFL remains rife with racism, particularly when it comes to the hiring and retention of black head coaches, coordinators, and general managers. The NFL called the claims meritless and intends to play defense. This all comes less than 2 weeks before the Super Bowl. We have more on these stories throughout today's show. You're watching Yahoo Finance Live. Today is Wednesday, February 2nd, 2022, and I'm Brad Smith.
And I'm Emily McCormick. Stocks are trading in the green this afternoon. The S&P 500 is aiming for a fourth straight session of gains, but we shall see if this holds into the close. But taking a look at the market action here, we have the Dow Jones Industrial Average up about 0.5 percentage point or nearly 200 points with about an hour to go in today's session. The S&P 500 up about 0.8% and the Nasdaq Composite up about 0.3% as we await the continuation of big tech earnings this afternoon with Meta Facebook reporting after the close. But for more on the trading we're seeing today, we have Yahoo Finance's own Jared Blickery standing by on our interactive screen. Jared, break this down for us.
That's right. It's increasingly looking good for the bulls. And I just want to draw everybody's attention to all this green, not the Russell 2000, but specifically the S&P 500. This is a 1 month chart. And guess what? See, 1, 2, 3, 4. We are in the midst of a 4-day rally, pretty close to our session highs here. Be nice to see a close around these levels or even higher, because as I've been saying, this is the ideal area for shorts. But the fact that we got an hour to go, not selling off, if we're able to close here, looking increasingly likely that we're going to be able to breach this resistance level and get to all-time highs. But we don't want to get ahead of ourselves, so let's take a look inside the market. Inside the market, there we go. Alphabet up 8%, and as you noted, Emily, Meta earnings after the bell. We're going to have to see what FB does. It's up 1% right now. Microsoft also up 1%. But the loser here in the mega caps is Tesla. That's down 2.5%. The EV space not doing that well. I'm going to sort by performance, and you can learn a lot by looking at the losers today. PayPal quickly becoming pay enemy. Yes, I stole that from Twitter. Down 25%, worst day ever. Lucid Motors, an EV play, that's down 7.5%. We got some software, some communication services names like Okta, Netflix, and also the Chinese stocks having a rough go of it today. Let's check out the sector action. Communication services, which houses Alphabet and Meta, not surprisingly, is the leader today. That's up 2%. But as I've been saying throughout the day, the rest of the sector action here is a little bit defensive. Real estate, healthcare, utilities, staples, those are defensive sectors. So a little bit of caution there. The only thing in the red is not computer discretionary, consumer discretionary. And let's check out those Chinese stocks real quick. And we can see a lot of red on this space. Alibaba down 3%, NIO, also an EV play, down 4%, and the list goes on here. But I do want to check out what's going on also in the innovation funds. We see a lot of red in the space here. We see Shopify down 9%. The Square, I always forget this guy's name there. The new block, the old Square, is down 10% as well. And I want to check out one more space before we head on down to our next guest, and that is going to be Bitcoin. Bitcoin down 2% over the trailing 24 hours. Ether not doing much, down 2% as well, guys.
And for all of these major themes, for more on all of these major themes that Jared Blickery has laid out, and thanks so much, Jared, by the way. Let's bring in John Mayer. John Mayer, the musician, would say we're coming down to the wire here. John Mayer, Global X ETF's Chief Investment Officer. We'll see what he has to say. John, thanks for taking the time here with us today as we get closer towards the end of today's trading session. You know, as we're going to get some of those other companies reporting earnings, some of them Jared laid out, a few of them we teased earlier on as we kicked off the show. What particularly are you going to be watching for to see if, for the companies that have reported thus far, and namely Google in the tech space, if there is a rising tide for tech, or if there is more of kind of these individualized kind of respective plays that are in place right now?
Sure, Brad. I think there's always an interest in tech, first of all. The big question is how to navigate in this current environment. We have been talking about quality and fundamentals, and those companies that have been able to navigate these supply chain problems have been able to beat earnings and provide strong guidance going forward. Those are the companies that are beneficiaries, and the market is rewarding. Those companies that show are having issues navigating inflation, are just meeting earnings are slightly below, and their guidance isn't as good, are getting punished. By example, PayPal, for example, today certainly has been punished, but they only missed by a penny. So the market is really focusing on quality and fundamentals and the future, because the market is the future, never the past.
John, this is Emily here. Thanks so much for taking the time to join us. I'm wondering, do you think this is going to continue being a value-led market, as we saw value really outperforming in January, really over the past couple of months now? But do you think that's going to continue given the current macro backdrop that we've been seeing?
I think there is certainly going to be a push and pull between growth and value. But again, I think the real important aspect is focusing on how to navigate through the supply chain issues, how to focus on those companies that are going to be a beneficiary of higher inflation. We're in a period of time where we know that interest rates are going higher. Those companies that can withstand higher interest rates, funding costs are going to be higher, are going to benefit in this current environment. Cyclical certainly could be a beneficiary. With the economies reopening in terms of leisure and entertainment, those areas, as Omicron fades, those areas are certainly going to, I believe, will benefit.
John, you're saying the market is always the future, never the past, but considering the rate hike environment that we find ourselves in, how far forward do you believe the markets are looking as best as possible right now?
Well, if you think about what we believe in terms of where the Fed's going, so we believe that in March, the Fed's going to increase 25 basis points. And I believe that they're going to increase every single meeting for the rest of the year. That's 7 meetings, and at least 4 the following year. So that brings the Fed funds rate to close to 2.75 to 3%, still pretty historically low. Again, those companies that can handle higher interest rates don't need as much access to capital markets are going to do better going forward, and those companies are more reliant, and where their earnings could be pressured by higher interest servicing costs.
Looking at the economic data, this morning, ADP reported a surprise drop in private sector payrolls for the first time since December 2020. Is there any magnitude of softness or a miss in the Friday jobs report that you think would give the Fed pause for a March rate hike or subsequent rate hikes?
Yeah, I mean, I think these numbers are going to be related to Omicron and how it came on so fast. I think the numbers will improve after that, but I don't think there's anything that could put the Fed off from increasing rates at this point. They are so far behind the curve in fighting inflation that they really have no choice but to continue start raising rates and continue on that path. I would think there would have to be a very, very large event, and it's not going to be a miss on employment numbers. So, yeah, that's kind of my view there.
All right, John Mayer, who is the Global X ETF's Chief Investment Officer, joining us today. John, thanks for the time. We appreciate it as we edge closer to the market close, everyone. Coming up on the other side of this short break, though, former White House Health Policy Advisor Dr. Zeke Emanuel joins us shortly with the steps that he believes the U.S. should take to combat the novel coronavirus pandemic. That is next.
Welcome back. As we head into the third year of the pandemic, the U.S. is trailing other wealthy nations in containing COVID-related infections and deaths. A new report from the New York Times shows that U.S. COVID deaths per capita are the highest among peer high-income countries, and vaccinations have continued to lag. Our next guest joins us to discuss this and more. Dr. Ezekiel Emanuel is University of Pennsylvania Vice Provost of Global Initiatives, as well as former White House Health Policy Advisor. Dr. Emanuel, thank you so much for joining us this afternoon. As I was mentioning, the U.S. has certainly been trailing its peers in its pandemic response. What do you think were the crucial missteps that got us to the point that we're at now?
Well, I think a large part of it can be attributed to the misinformation and the political polarization that hasn't allowed the country to get behind a unified approach. You know, when President Biden took over in January, he had a very good strategic plan, and they executed on the strategic plan. It was heavily focused on getting people vaccinated, which is critical to increasing the population immunity and ability to fight the virus. Because of misinformation, because of all sorts of lies that have been propagated out there, like it causes infertility or serious side effects. They're implanting chips in people's brains. I mean, crazy stuff. We've plateaued at about 60% of the population vaccinated. That's not good enough. And if there's one thing that could help, it would be that. It's not the only thing we need to do, but it's certainly a major problem, and has caused a major misstep.
And so the Supreme Court already pushed back against mandates against private or for private businesses, which stemmed from the White House trying to make those advancements. And so what is the next potential step that can be made on the mandate front to get to 70 or 80% of a vaccination rate in the US?
Well, I think there are probably three places you can really look. One is you can mandate certain employers that have high-risk situations objectively, food processor plants, other high-risk environments like long-term care facilities, correctional facilities. I think that the Supreme Court is going to have to accept as critical and a targeted mandate. Second, there's travel, airplane travel, train travel. Those are interstate commerce. Interstate commerce is something the federal government has a legitimate power over. And the third, I think, is children in schools, where assistance and help with lots of things to schools can be linked to getting children, staff, and teachers vaccinated. So I think those are probably the three areas I would look at for expanding the numbers. In addition, getting boosters to the vulnerable, immunocompromised people, people over 65, those are very important as well.
You mentioned that vaccines and getting the vaccination rate up is just one part of the response that needs to be bolstered in the U.S. What else do you think needs to be done now here in the U.S., especially on the testing and masking fronts?
Well, first of all, I would say probably my second leading area is therapeutics. We have one therapy that's pretty effective and easy to administer. That's the Paxlovid drug, antiviral drug from Pfizer. It's in short supply, and one drug is not good because viruses will naturally mutate to neutralize that drug. So we need a multi-drug cocktail, and I think we need the equivalent of warp speed to develop that multi-drug cocktail. We have some other drugs. There's intravenous remdesivir, there's this monoclonal antibody, but we don't have lots of them, and they're hard to give. And we also need to better connect people who test positive to get those drugs. At the moment, that is not a smooth process, and it's not available to all Americans. So that's probably my second top priority. And I think it's also very, very important to have tests that are ubiquitous and cheap, under $3 a throw, down from what we're paying now, about $12.50 per test. And I think that's also a vital thing to do by getting more tests approved in the country, increasing the number, probably having the federal government negotiate prices down, and making those tests readily available almost everywhere. The other thing I think that is sort of would be behind the scenes, not create a lot of discomfort, is improving the indoor air quality to reduce transmission. We know that a lot of the transmission is on aerosols, those small particles in the air in indoor settings where people are close. Air currents take the aerosols all around the room. Improving the quality, whether by HEPA filters or by improving the air filtration filters that are in the air conditioning and heating systems, absolutely critical. Doesn't require a person to do anything to change their risk, but can dramatically reduce the risk of transmission, as well as other illnesses, other viruses, but also particulate matter in the air, like things that cause asthma.
Right. Doctor, if I remember correctly, the WHO had cast some doubt on remdesivir, and it really comes after they had done more long-term studies. And so how important is the improvement of long-term data reporting on everything from COVID side effects all the way to some of the very response mechanisms that we've started to put in place?
You are absolutely right. That is a very perceptive comment. And I would say it's not just things like long-term implications on remdesivir. We need better data on long COVID. We don't know its frequency. Numbers are all over the map. We have some recent data that suggests that, in fact, if you get a vaccine, you do better. And the question is, if you get a vaccine soon after you get infected, does that help? A recent study actually out today or yesterday suggests that's very important. We need to also look at how long those side effects last. Do they go away? What proportion of people go away? We don't have that kind of long-term data. And it's a little surprising we don't have it, because we've known about long COVID for, call it a year and a half a year into COVID. We knew people were having persistent symptoms. We should have started big studies right then and there. And by a year later, 15 months later, we should have those kind of data.
Doctor, you have a recent op-ed in the New York Times discussing China's zero COVID policy. And in that, you write, to use your words, its pursuit of zero COVID will prove to be a huge mistake. The policy has left it wholly unprepared for what will become endemic COVID. Can you explain more of what you mean by this and how this could carry implications for the rest of the world?
We're not getting rid of COVID. It's going to be around. How bad it is, we don't know. But we do know that people who don't have an immune response to COVID, so people who are unvaccinated or haven't been infected, they are at much higher risk of getting serious and severe consequences, being hospitalized and dying. And the Chinese, because their vaccines really don't work, and because there hasn't been hardly any COVID in the country, do not have a very good population level immunity. And therefore, when Omicron spreads, it's much more dangerous, more sick people. And I think that's a real problem. To date, the way the Chinese have handled this is by just locking down tens of millions of people for weeks at a time. But when you have something as contagious and spreads as easily as Omicron, that is going to be like a whack-a-mole problem. Eventually, they're going to have to open up. Now, they don't want to do that quickly. They don't want to do that quickly because of the Winter Olympics, and they're going to great lengths to prevent people from spreading it who are in the Olympic bubble. And they don't want to do it ahead of the October Communist Party meeting when Xi is supposed to be elevated for a third term. And I think these are their considerations. They're going to need a new vaccine if they're going to try to recognize endemic COVID, or they're going to end up sealing themselves off from the rest of the world and having these very severe Chinese-style lockdowns, which are nothing like the lockdowns in the United States, that will be quite profound and quite damaging.
Doctor, we appreciate your insights on all of these topics. Dr. Ezekiel Emanuel is University of Pennsylvania Vice Provost of Global Initiatives, as well as former White House Health Policy Advisor. The parent company of the restaurant brand Chili's reported quarterly earnings that topped Wall Street's estimates, even amid continued inflation and labor concerns. We'll have a discussion with the CEO and president of Brinker International for more after this short break.
Brinker International, the parent company of Chili's and Maggiano's, reported its most recent quarterly results, and they saw its shares move higher on those results by about 9.2% here intraday during the session as investors snack on those earnings. Standing by is Yahoo Finance's Brian Sazzi, along with Brinker CEO and President Wyman Roberts. Brian, I'll toss it on over to you.
All right, thanks so much, Brad. Wyman, good to see you as always here. Look, your stock price is higher in response to your earnings. We have not seen this type of reaction to other restaurant earnings thus far. I'm looking right at you, Starbucks. Why do you think the market likes your report and maybe not some others?
Yeah, thanks for having me. I think we had a good quarter, and I think there was a lot of speculation as to, what was happening within the restaurant space over the holidays, especially with the Delta spike and kind of how the holidays were going to play out. And we had a very good quarter relative to expectations and relative to kind of our history. So we were excited to see as Delta kind of mitigated itself in the quarter and we got into the holidays with less COVID headwinds, how well all of our brands performed, both Maggiano's, Chili's, and our virtual brands, It's Just Wings and Maggiano's Italian Classic. So everything worked fairly well for us coming through the holidays, and as we kind of deal with this latest Omicron spike, we're optimistic about how quickly we're kind of moving through the biggest part of that. So that was probably the headline news.
How was traffic in January?
January is, we're not, it's kind of third quarter. We're not giving a lot of detail. We know that the industry, through industry numbers, this latest spike in COVID has had an impact. And the good news is it's kind of working its way out of the system much faster than the previous COVID spike. So as widespread as the Omicron variant is, it's having less of an impact in terms of duration, at least right now. And so that's got us optimistic that we're seeing things return kind of to where they were pre-Omicron at a faster rate than you would have seen with some of the other spikes.
Wyman, this is Emily here. Based on what you'd mentioned during the earnings call earlier, with your latest price increases, you noted that your menu prices are now up over 4%. How much more do you anticipate you'll have to raise prices going forward to offset ongoing, if they will be ongoing, costs to the company?
Yeah, Emily, we don't know exactly where the inflationary pressures are going to be. We have a commitment to maintain our business model and our margins. The thing that's kind of lost in our business a little bit is the fact that with COVID and the shift to more takeout and delivery, we lose some dining room traffic, and our dining room traffic is so much more profitable with regard to the average check levels with the alcohol sales and some of the other higher menu items that they eat. So as COVID moves through, it's not so much about, we're going to need to price a little bit more. It's just we get the benefit of getting those dine-in guests back in. And that's what we saw in December. And that really helps us a lot to kind of deal with some of the inflationary pressures we're seeing on the cost side. So we're not really thinking we have to price a whole lot more, although we'll continue to watch these costs as they continue to kind of fluctuate through the system. And we'll price if necessary, but we're thinking we might have enough price in the system, at least in the short term, to carry us.
We always hear from some of the food and beverage services space and hospitality sector more broadly, how much menu innovation plays into their ability to attract new customers, perhaps. I wonder to what sense you kind of look into the roadmap and have to think about that across some of your portfolio brands and what that is also going to do to prices, both for the consumer and for the company operating in an operating manner.
Yeah, I don't think innovation today is quite as important across the menu. I think consumers right now are really looking for consistency with all the supply chain issues and everything that's out there. They're looking for great value, of which we have some of the strongest value propositions in the industry, and consistency of delivery. And those are the things that we're focused on now. Now, we've brought a lot of innovation into our business with regard to the use of technology. We just rolled out a brand new service model using handheld technology in all of our restaurants. We've rolled out a new curbside system to better deal with the increase in takeout and delivery to make sure our guest experiences are better. Those are the kind of things I think consumers are more interested in right now, is just to make sure everything's working well for them and ensuring that their meals are on time and at a great value.
Well, I was talking to a couple of my contacts in the industry, and they're putting out applications for jobs, and only 2 or 3 people are signing up for these jobs, just given the tight labor market. Are you having any success attracting the workers you need over at Brinker?
Yeah, and I think that's one of the good news stories we shared today is with all the pressure that we've had really through the summer and into the winter with labor challenges, it's starting to mitigate. We're actually seeing, I was in restaurants just last week, and managers were sharing stories with me about the same thing, Ryan. They put an application out, they'd get 2 or 3 responses, and now they're getting 10 or more. And so we are starting to see the ability to staff our restaurants become much better. We're actually have more team members per restaurant today than we had pre-COVID. So we're really now focusing on training and retaining those hourly team members as well as our management staff.
And if you noticed, Wyman, I'm right in Times Square in New York City here at the Nasdaq, but I hear now, and correct me if I'm wrong, are you in Manhattan with a Chili's?
We are. You can now get your Chili's and your It's Just Wings in Manhattan. So we've opened a ghost kitchen. We're about a month in. We're very encouraged by that. We're going to continue to look at new ways to bring the brands to kind of more dense urban, probably smaller footprint centric models. And we're excited. We're excited about what we're seeing in our first urban kitchen in Manhattan. We've got a couple of new prototypes on the boards that will open in some college towns here in the not too distant future.
Wyman Roberts, who is the Brinker International CEO and President, and Yahoo Finance's own Brian Sozzi. joining here on the Afternoon Fun. Great to have you both here with us today, and great conversation as well. And coming up on the other side of this short break, Emily and I put two names on your radar that we're tracking heading into the close. Plus, Palantir is looking to the electric vehicle space for its next growth opportunity. What you need to know about their latest partnership on the other side.
Welcome back. It's time now for our 2 and 2. Two stocks Brad is watching and two stocks I'm watching during today's session. Now let's first take a look at shares of Capri, the parent company of brands including Versace, Jimmy Choo, and Michael Kors. Now this company just reported earnings results this morning that topped estimates, and plus its outlook was also rosier than expected. And as we can see, those shares are currently up about 8% with less than 30 minutes to go in today's session. But for the third quarter, revenue was up 24% to reach $1.6 billion. Michael Kors sales specifically were the biggest contributor, rising 20% to $1.2 billion. But revenue growth rates at Versace and Jimmy Choo were much higher at 29% and 47% over last year, respectively. Now, Capri also raised its forecast for the full year, citing a continued recovery from the pandemic. And it now sees full year sales coming in at about $5.6 billion, whereas it saw $5.4 billion previously. Switching gears here, there are also shares of Match Group that I'm watching. Now, this is the company that owns a portfolio of dating apps, including Tinder, OkCupid, and Hinge. Those shares are also up today, even after the company posted results yesterday that largely missed estimates across most major metrics. Now, the company swung to an adjusted loss of 60 cents per share, whereas Wall Street was looking for earnings of 60 cents a share for the latest quarter. And revenue of $806 million rose 24% over last year, but still missed the $819 million that consensus analysts were looking for. Now, the company said that renewed COVID impacts in key markets, including Japan, have been weighing on results, and Omicron had also started to reduce mobility in many markets starting in early December. But nevertheless, some analysts on Wall Street have struck an upbeat tone on Match Group's future, and JP Morgan analysts led by Corey Carpenter wrote in a recent note, quote, overall, Match results were impacted by FX and Omicron largely as expected, but we thought commentary around Tinder engagement, Hinge momentum, and Hyperconnect stabilization reflect healthy underlying trends. And as we can see, that stock is still up about 6% this afternoon. Brad?
All right, so two companies that I'm keeping an eye on. First and foremost, got to talk about PayPal and the no good, very bad day that they are having. Take a look at shares right now. You're seeing them down by 24, nearly 25%. They are on course for their worst trading day. And you think about this company and the subsidiaries that they own in Venmo, of course. On the earnings call, they did show, and this went in tandem with the bad outlook that they reported after the close in their earnings results yesterday. On the call, though, they said that they're redirecting their spend towards high-value customer acquisition and engagement channels. And over the next 12 months, as these less engaged customers naturally roll off, they're looking for material reductions in quarterly net adds. And so this, again, could end as the worst trading day ever for the company, and we'll see exactly where shares settle at 4 p.m. Also, I want to check in on shares of GILD, Gilead Sciences, of course, one of the very popular names earlier on in the pandemic for the treatment remdesivir that they had been able to bring to market and get authorization for as a way to combat the more severe symptoms if a patient was hospitalized due to COVID-19. However, in this most recent earnings report, their fourth quarter 2022 revenue of $7.2 billion, that actually reflected a decrease of 2% compared to the same period in 2020. And that is due to decreased demand for Veklury, formerly known as remdesivir, and particularly offset by some pricing dynamics as well that they had seen. And so those Veklury sales, previously remdesivir, as I noted, those sales were down 30% in this most recent quarter. Keep a close eye going into the closing cross of GILD, but those shares down here on the day. And so those are the two companies that I'm tracking here on the day. Emily, we'll see exactly where the dust settles here.
Brad, Palantir and the mobility data firm Wejo are deepening their relationship in the electric vehicle space. Today, Wejo unveiled the availability of the electric vehicle infrastructure operating system through the Palantir Foundry. And here to discuss this latest iteration of the partnership between these two companies is Richard Barlow, CEO of Wejo, and Shyam Sankar, Chief Operating Officer of Palantir. Yahoo Finance's own Pras Subramanian is also stopping by for this discussion. Thank you all for being here. Richard, I'll start with you on this. Tell us who you're targeting to have use this EV infrastructure operating system and what kinds of problems this could actually solve.
So we're targeting network operators, we're targeting retailers, utilities providers, and energy companies, and a whole host of other organizations, including government, who need to understand where to install EV infrastructure. In 2019, 29% of all CO2 emissions came from vehicles, and EVs are now being introduced, not as fast as they should be, to reduce those emissions. We've now built with Palantir an operating system where a whole suite of agencies, of network operators and utility providers can now establish exactly where to install infrastructure.
Apologies, I'm muted. My bad. Shyam, this is Pras here. What exactly is the data problem that exists with EV charging and infrastructure, and how does Palantir's Foundry product help with that?
Well, thank you for having me. So that's a great question. You're dealing with enormous multi-trillion scale data sets that depict where the demand for EV charging is not only today, but where is it going to be in the future based on the empirical real world usage of vehicles out there. Plus you have the incredible infrastructure overlay. Like, where can I even put infrastructure based on the grid, based on the dynamics? What will the cost of it be? You know, how do you really pioneer the intersection of those things? One of which is corporate proprietary data with Wejo's unique data asset on the vehicles to drive this sort of decision making.
So Richard, I'm curious how this product and this combination, this OS, if you will, can actually alleviate this deep problem that we have in this country with the lack of charge plugs across, a number of localities and states.
Well, one of the things we want to break is this myth around range anxiety. There's this view that EVs at the moment don't have enough kilowatts. That's not true. We understand we've collected over 13.2 trillion data points. We've collected over 500 billion miles of data from vehicles driving around, including over 300,000 EVs. We know how vehicles are being driven day in, day out, and the typical journeys are sub 50 miles per day per vehicle. So there doesn't need to be a fundamental change of fuel companies with hundreds of charging points on site. what there needs to be is a more intelligent approach. So, for example, with our OS, we can now work with energy companies, we can work with consumers of vehicles so that if they plug the vehicle in overnight, not all vehicles at the same time in the same area are charging at the same time. That put a huge pressure on the infrastructure, on the grid. Whereas actually, by having a live OS, we can say 10 p.m. to 11 p.m., this group of vehicles are charging. 11 p.m. to 1 a.m., this group of vehicles. And then there's enough charge on all the vehicles for them then to do the day's journey required, the following day's journey is required, rather than unnecessarily filling up a vehicle's complete battery life.
Shyam, from a partnership like this for Palantir, what kind of revenue opportunity could that even create in the future?
Well, what we love about working with Richard and the team at Wejo is just their ambition, the speed at which they've been able to move by building applications on top of Foundry. They announced Neural Edge, which is cutting-edge AI technology that leverages what we've built together to run on every potential car out there last month. Just this month, you now see this entirely new product being birthed. We think that the revenue opportunity here is quite large. What AWS was to developers last decade, Foundry really will be to developers this decade.
Hey, Shyam, quick follow-up here. Do you think that this product is actually more for governments than it is for private enterprise like OEMs and charge companies, because of the fact that there's such a huge opportunity to use public land? Here in New York, they're going to open a huge space in Brooklyn just for public charging for a lot of people to use their EVs there. So what do you think about that? Is that what the opportunity is?
I think it's going to be multi-stakeholder and really at the intersection. Richard talked about utilities. That's an obvious and big one, and it's really kind of their primary charge. But large corporations, energy companies who are transitioning from oil and gas to renewables have a big play to make here. A lot of their gasoline infrastructure, gas station infrastructure needs a new purpose. And at the intersection of that will be public lands, public funding, the equitable priorities that governments have in order to make sure this infrastructure is available to all.
Richard, in terms of data privacy, do electric vehicle and EV infrastructure customers actually have to opt in to provide this data, or is this something that Wejo and Palantir have automatic access to now through this operating system?
No, not at all. The 11.9 million vehicles we have live on platform, we have individual consents. We actually have visibility over 50 million vehicles, and the 11.9 million vehicles is where we have clear consent from the driver who said they'd like to share the battery data of their vehicle or their location to identify a parking space. We're very much around what we call data for good, a very clear, transparent approach with drivers, with owners of vehicles that they have given consent for their data to be shared in return for something such as having charging on demand for their vehicle or identifying this parking space.
Hey, Richard, one last quick question. From what the data is showing you guys at Wejo, where are some of the best parts of a municipality or city to place these charge points?
At home. At home is the best place. People are doing less than 50 miles a day of journeys. Yes, sure, that they should be demanding cities. The fueling stations should be investing in infrastructure. But actually, in terms of what the grid should be doing, the grid should be focusing on how they can educate home users, people when they're at home, about when they should be charging their EV up. So they don't just plug their EV in and leave it. There needs to be more of an on-demand approach, which Palantir and Wejo's OS can do by informing the grid about when an EV should be charged or not charged.
All right, we will leave it there for now. Richard Barlow is Wejo CEO. Shyam Sankar is Palantir Chief Operating Officer, and our own Pras Subramanian. Thank you all so much for joining us this afternoon. Coming up, Bitcoin prices are hovering around the $37,000 level. But what's it going to take for the cryptocurrency prices to break out? We'll discuss on the other side of this break.
After bouncing from its year-to-date lows, Bitcoin has nudged into negative territory over the past 5 days, but still sitting above 37,000. This as some states consider accepting cryptocurrency for tax payments. To help break down the recent price action in major coins, plus the regulatory landscape, Dominic Dantes, CoinDesk market analyst, joins us now. Dominic, great to have you here with us today. Help us first and foremost try to figure out if we are going to be range bound in this particular $37,000, $38,000 range, or if you think that we're due for a breakout, given that we struck that $33,000 level last week.
Definitely in a range for now. Volatility has been very, very low. Trading volumes have also been very low, and I know we're heading into the Lunar New Year, so that's taken away some trading activity out of the norm. And we're consolidating here for a while. Indicators on the technical side have reached the most oversold that they've gotten since March of 2020, very similar to equity. So what we're seeing now is a relief rally or a bounce. That bounce has stalled over the past 24 hours. So it looks like buyers are still on the sidelines. There's still some uncertainty regarding the future price direction. There's not a lot of signals out there, although greed or fear has gotten very extreme. So what you really see right now, you're waiting for like a short squeeze of sorts. If price rises unexpectedly, short positions might be forced to liquidate, and that could cause a price jump. However, there's a lot of resistance on the chart, and longer term momentum indicators are still pointing negative. So upside could be limited around the 40 to 45K resistance level, which gives you a little bit of room for a bounce. February tends to be seasonally strong, but overall, over long term, the trend has definitely weakened.
Dominic, this is Emily here. One of the things that you pointed out as well is that some altcoins are starting to outperform, including Ethereum and Solana. I'm wondering, is the rise of some of these tokens coming at the expense of Bitcoin? And in other words, is there competition and sort of this flow that we're seeing between Bitcoin investors who might otherwise have gone to Bitcoin now going to altcoins instead?
A little bit of that. Bitcoin tends to be seen as a safe haven within the crypto world. So when times of risk off, traders tend to flock towards Bitcoin and abandon some of the altcoins, which are more beta or higher risky or more riskier in the crypto space. So you are seeing some of that. And then another indicator that we look at is a Bitcoin dominance ratio. It's just a measure of Bitcoin's total market cap relative to the total crypto market cap. And that's kind of hovering back around the 2018 lows. So it kind of shows some opportunities for altcoins to outperform in the short term. But over the longer term, if you see that Bitcoin dominance ratio pick up from those lows, that can definitely be a sign of fear in terms of flows back towards a safe haven, that being Bitcoin. So we're watching that very closely.
In terms of acceptance in cryptocurrency, it sounds like some Western states are going to be moving forward with plans to accept crypto for taxes. This, of course, not the first time that we've heard about this. Ohio, one of those first case instances where this had really been discussed and moved forward for businesses, at least. So why, again, would a state government accept in this case, a volatile cryptocurrency in the way that we've been discussing Bitcoin and some of the other altcoins here?
Yeah, you'll have to ask the state legislators. They're responding to their voters and lobbyists and figuring out what can, spur activity. You have to ask why, in terms of, do we need it? Efficiency of payments via taxes can be done in other electronic forms. I don't necessarily think you need a cryptocurrency for that. And you just got to ask yourself, what are the circumstances around that? It's state by state level. In terms of the grander sense, I know that there's been a lot of lobbying work regarding recognizing crypto as a legal tender on the state level, which gets into a big, tricky scenario when it comes to legislation and the law behind that. States cannot issue legal tender or recognize it. That's the power of the Congress. So there's some constitutional barriers around that states will have to figure out. It's definitely not a game changer. It's something I think that has to do with lobbying efforts, and the states are probably trying to respond to that. And in terms of efficiency, there's multiple other mechanisms that you can use. So I don't necessarily think that breaks any barriers within the crypto world yet.
I'm also wondering, do you think we're getting to a point where we're seeing diminishing returns in how much of a bump we actually see in the prices of Bitcoin whenever we get that incremental headline of adoption? Like, for example, Brad was just asking about some Western states considering taking digital currencies for taxes. Of course, there have been more companies that are now accepting Bitcoin as forms of payments, and we aren't necessarily seeing that same meteoric rise in Bitcoin prices in response to some of this news.
Yeah, the market hasn't reacted at all to that, I don't think. The biggest one was El Salvador last year, and you know that there was a lot of rumors about that heading into June, which was around the bottom of the crypto kind of sell-off that we had last year. And that kind of saved Bitcoin a little bit around July into October when they officially recognized it. And then you kind of saw the sell-off right after that. So it's kind of like buy the news or buy the rumor, sell the fact situation. And this one on a state-by-state level, we haven't seen any significant market reaction to that. But overall, crypto is very volatile. It doesn't compete with the US dollar. It is something more of a speculative asset in its early stage. And there's been some efforts to try to legitimize it into the traditional world, and those efforts have since stalled. So right now it's a purely market-driven, purely sentiment-driven asset class, and I think the markets are following that accordingly.
Dominic Dantes, who is the CoinDesk market analyst, joining us here today. Dominic, appreciate the time, the insights, and the breakdown on all of these moving parts, especially around the cryptocurrency landscape. And everyone, coming up, the closing bell is just minutes away from here, which means earnings on deck for the Facebook parent company, Meta Platforms. You've got Spotify and Qualcomm, all of those reporting after the market closed. Stay tuned.
Welcome back. We are minutes away from the closing bell and another set of quarterly earnings results, and we'll get to those, but first we want to get over to Yahoo Finance's Jared Blickery for another look at today's market action. Jared.
That's right. We got a nice rally underway. I just want to take a look at the S&P 500, which is now above 1%. Let's take a look at the two-day view, and you can see we are at session highs right now. I was looking at the VIX a little bit earlier, and I just want to say almost below 20. So getting to that 19 handle, kind of a big psychological number there. Let me just check out a 3-month chart so we can see this huge spike that we just are recovering from right now. And volatility is definitely on the decline here. Let's take a look at some of the names we're watching today. And also after the bell, Alphabet still holding on to gains of over 7.5%. Meta Platforms up over 1.33%. We're going to be getting those earnings to you after the bell, along with Spotify and a couple others, I believe. And let's just take another look at the sector action as we head to the bell. Communication services, which houses both Alphabet and Facebook, that is a leader. That's up 2%, followed by real estate, utilities, healthcare, and staples. So a lot of defensiveness there, but I think investors will take those gains.
Yahoo Finance's Jared Blickery, thank you so much, and we'll check back in with you for earnings in a bit. We'll take you to the closing bell and beyond up next. Stick with us. Welcome back to Yahoo Finance Live. We're moments away from the closing bell, and here to help us make sense of today's market action is our panel for the afternoon. We have Robert Schein, Blank Schein Wealth Management Chief Investment Officer, and Terry Sawchuk, Sawchuk Wealth Founder. But before we turn to you both, we do want to get one last look at the markets as we approach that closing bell. And as a reminder, we are also awaiting earnings results out from Meta, the artist formerly known as Facebook, as well as Spotify and Qualcomm. So a lot to be keeping an eye on as we have the closing bell.
And there you had a look at the New York Stock Exchange closing bell, where it looked like Madison Square Garden was ringing the closing bell today. Taking a look at the U.S. markets here, Dow Jones Industrial Average, that closes up by about 0.6%, 223 points added on there. The S&P 500, you're seeing that also close in positive territory by about 43-ish points there, 0.9% in gains. And rounding out the trifecta, or the hat trick on the day, 71 points in the green is the Nasdaq Composite. Tech-heavy average closes higher by about 0.5%. And as Emily had introduced our market panel, we want to get back to Robert and Terry. And Robert, first let's go to you, because when you think about what we've seen over these past few sessions to begin the week, have we been able to set in a bottom, and more likely going on over the course of these earnings reports that we're set to get from this point forward? How will that continue some of the momentum that we've seen in recent sessions?
Yeah, last week or so, extremely volatile. We're seeing earnings potentially could be bailing us out. Right now, you have S&P and the Dow above their 200-day moving averages, closing in on their 50 days, but the Nasdaq is we still need it to close above the 200-day from a technical perspective. That being said, if you look at earnings reports last night, or even what we're going to get after the bell today, big tech are cash flow machines. So that's also a great opportunity right now to choose your spots right now for the market.
Terry, I want to get your thoughts on this as well. What do you think about where we're headed after the volatile January that we saw last month, and how vulnerable are stocks right now for a further pullback?
Oh, I don't think we've seen the bottom yet. I think we probably need at least to go back and retest the lows. And then we'll see what happens there. They may hold, they may not. If you look at, we work with an algorithm with an outside firm. It went negative, and I think the trend is down. And when you look at the bigger macro picture, this looks more like a bear trap relief rally to me than it does a bottom by any stretch.
And so with that in mind, we're going to be hearing from the Fed as we move on throughout the rest of this year. In March, all eyes are on that meeting. What are your expectations going into that meeting, especially considering the headwind risks that are posed, Terry, by the Fed, and not just how often they will raise interest rates going forward, but what the size of those rate hikes might look like?
Yeah, I don't think there's any chance we're getting a 50 basis point rate hike. That's not in the cards. I think the bigger chance, I think the Fed's going to back off of all this at some point. I think they're under, some political pressure right now to look like they're fighting inflation, so they're doing what they're supposed to do there. But when you look at $5 gasoline, when you look at the drop in petrochemical sales, you just look at the big macro picture, the lack of fiscal stimulus. Their bigger issue, in my opinion, their bigger policy mistake would be to drive us into a recession. And I think that's more likely to be an issue than inflation as we get a little further out.
Robert, in terms of the economic data, we got a major disappointment in terms of the ADP private payrolls report. About 301,000 private payrolls shed in the month of January. Should we be expecting a negative payrolls print on the jobs report that we're getting out on Friday from the BLS?
Well, the payroll number is definitely concerning, but I don't think it's going to stop the Fed from tightening starting in March. They're going to look through the data. They're well behind the curve. And so they're going to be more data dependent going forward in their messaging. This Friday could show us, again, just noise. And it's just showing that the Omicron virus has hit just about every business that I know and every across the United States. So I think it's this one data point where if you look at the bigger picture and longer term, the trend is still our friend as in terms of employment. I don't know of a business owner right now that's not looking for employees to work. So we're got a thriving, growing economy. I think the Fed's going to see that cash is in hands of consumers. Corporate profits are still there. 2/3 of the S&P right now have reported and have said, there's inflation concerns, wage inflation, and supply chains constraints. But I think that could moderate. But the Federal Reserve will turn data dependent, and I don't think they're going to be as aggressive this year as they once stated. And that's what January really volatility has come from.
Terry, thinking through the inflationary hedge that Bitcoin was talked about as previously, it seems that it's kind of shed perhaps that sentiment around it at this point in time. But I wonder, as a wealth manager and as someone who is looking across where there might be buying opportunities, are any of your clients asking about that at this point? And what are you advising on the front of Bitcoin and cryptocurrency more broadly, especially considering the talks of a central bank digital currency?
Yeah, so look, Bitcoin, there was a lot of talk around it being, an inflation hedge and a place to go if monetary policy gets out of control. It's really traded like a risk asset. And so we need to see a lot more money printing before I think that narrative takes on. Now, I think ultimately we need something like Bitcoin because to be honest, the thought of a digital bank, a central bank digital currency scares the hell out of me. And so I definitely would like to have something like Bitcoin available if and when we get to that point. So I don't think by any stretch Bitcoin is dead yet, but it is acting like a risk asset. So it's going to trade more correlated to what the stock market's doing until the world gets to a place where they're really worried that the dollar breaks down and gets devalued seriously. And we're not anywhere near that right now.
Robert, are you seeing opportunities outside of the U.S. and specifically U.S. large cap stocks right now? And if so, where are you looking specifically?
Well, we actually do like large cap, but we also look in the U.S. right now, specifically over, let's say, outside the U.S. And, I think we're seeing a lot of, the price change does not ultimately change the fundamentals. We're coming into, we like sectors like oil. We like sectors like financials, right? We have rising interest rates. Financials will be strong as a result. But oil, you look at what OPEC Plus did today. They're going to increase, the output in March, but at the same time, it could be too little too late because we are still reopening around the world. We haven't gotten corporate travel back yet. We haven't gotten everyone back out of their houses, if you will. Everyone's at home at Zoom. And so once you're back in the office and you have that travel back again, that's going to actually play into our thesis, which is oil is going to be strong this year. That's sort of the sector that's a global play. And that's why we like oil.
Stand by, Robert and Terry, for a hot second as we've got some earnings that are coming in after the bell. First and foremost, we got to get to Qualcomm. Shares are moving lower here in after hours trading by about 1.92% for that. Let's bring in Inez Foray, who has been keeping close tabs on this price movement as well as what the company had to announce. Inez, I want to bring you in and get your reaction here.
Yeah, that's right, Brad. It's a beat on the top and the bottom line for Qualcomm with its first quarter fiscal 22 results coming in with adjusted earnings per share at $3.23. That was a beat because the street was expecting $3 a share. Its revenue came in at $10.7 billion. The estimate was for $10.44 billion. Its second quarter revenue outlook will come in at anywhere between that $10.2 billion and $11 billion. The street was expecting $9.5 billion. Meanwhile, the CEO, Cristiano Amon, saying our record quarterly results reflect the strong demand for our products and technologies. He did say in an interview that that demand from China handset makers is strong, that he wishes he had more supply to meet demand, and that Qualcomm got strong demand from Android phone makers. Remember that this company is sort of a snapshot when it comes to demand for mobile, but it also has a strategy of it trying to depend less on mobile, the strategy to expand into automotive, into networking, personal computing. And the supply chain issues, mentioning supply chain issues, saying that the CEO saying that chip supply is improving, and that is something that investors want to hear. The company had said that supply chain issues should ease up in the second half of 2022, and investors want to hear management reaffirming that. Brad?
And that's for thanks so much for the breakdown. Oh yeah, I'll toss it on over to you, Emily.
All right, well, let's head back over to our panel. And Robert, when you hear results like this, Inez breaking down that Qualcomm is saying that supply chain issues are starting to ease, how long do you think companies, S&P 500 components in aggregate, are going to be grappling with some of these concerns on the supply side that we've been talking about for months now?
Well, look, we haven't had an earnings report that hasn't pointed to an issue, right? Inflation, supply chain constraints. If I'm a CEO right now, I'm definitely going to play into that. But the fundamentals are still there. If you look at the earnings from last night, if you look at these, it's good to hear that the supply chain constraints are working their way through, especially in the chip sector, because it's much needed and actually driving the demand for the future. But if you look at these reports right now, I'm not going to ignore, you can't ignore, once we get past the earnings season, is the buybacks, right? So we had record buybacks last year. It's part of our thesis right now, why we believe, not to say we're out of the woods just yet. We could have a retest later this year, maybe midsummer, right before, the midterms right now. That's our thesis. We can never predict where the market's going to go. But right now, I think we're going to get past earnings season, and then the buybacks will put a support in the market because corporations are flush with cash. But if you're a corporate CEO and CFO, you're going to basically give it the worst case scenario. Why wouldn't you? Because year-over-year comps might not be any better going forward.
We'll see if that's the case for Spotify. Their earnings just crossed, and we're taking a look at shares here in after hours trading here. Gentlemen, stand by. The shares for Spotify moving lower for that. Let me bring in Ali Kanal, who's standing by with the results. Ali.
Brad, it's a bloodbath on Wall Street right now when it comes to Spotify earnings. After hours, the stock is down nearly 22% after the company reported fourth quarter earnings. But one metric that investors really zoning in on is that monthly active user number for the first quarter of 2022. Spotify says they expect 418 million versus the estimate of 422 million. Now, Spotify did beat on the top line with total revenue coming in at $3.025 billion, an increase of 24% year over year and 8% quarter over quarter. Premium revenue also up over 22%. The company also reported an adjusted loss per share of 23 cents versus an expected loss of 44 cents. So a smaller loss than expected there too, but really that monthly active user miss for guidance in Q1 is spooking investors. Perhaps investors think that subscriber growth will slow due to that controversy surrounding the platform. Joe Rogan, Neil Young, of course, Young removed his music from Spotify in protest of COVID-19 vaccine misinformation, specifically citing Rogan's podcast. Other big name artists, including Joni Mitchell, most recently David Crosby, Stephen Stills, have stood in solidarity with Young, also removing their catalogs. Now, overall, investors, analysts, they thought that this would have a minimal impact to Spotify's bottom line, especially since Spotify is clearly the #1 leader in this space, capturing 31% of total US music subscribers with more room to run in the market. Now, in response to the backlash, Spotify did release its platform policies public for the first time, in addition to adding a content advisory to any podcast episode about COVID-19, although the platform did reiterate that it will, quote, not take on the position of a content censor. Quickly glancing through this earnings report, I don't see any mention of this backlash or the controversy. However, I guarantee you that it will come up in the earnings call later this afternoon. But again, taking a look at shares, they're down right now a little over 18%.
All right, Yahoo Finance's Alexandra Canal on Spotify results. Thank you so much for that breakdown. And let's head back over to the panel. And Terry, I want to ask you about the earnings picture that we've been seeing so far for the fourth quarter. Now, as of Friday, the estimated earnings growth rate for the S&P 500 was tracking at about 24% year on year, which, if realized, would be the fourth straight quarter of earnings growth above 20%. But is this going to be enough to underpin stocks' continued rise going forward?
Nope. I don't think so. I just think, again, if you look at the macro backdrop, I mean, the one thing that people just aren't getting their heads around is we had an enormous amount of fiscal stimulus last year. We had record equity inflows. It was the largest of any year in the last 10 years. Where's that money going to come from? You know, I know there's some cash on the sidelines, but we're just discounting the fact that we gave out $40,000 of unemployment benefits to college kids. We gave out paycheck protection plans. We gave all this money out, and these kids, they bought Tesla, and they bought crypto, and they bought GameStop and AMC, and they drove. A lot of it was retail, and so we pushed prices higher, tech obviously, and I struggle with the macro picture. And again, if you look at $5 a gallon gasoline, that's an economy killer. I mean, not, partially anyway. So when you look at the big picture, it's going to be really difficult for corporations to beat year over year comparisons. with the massive lack of stimulus coming into 2022. I think it's going to be a rough year for stocks. It doesn't mean we're going to fall apart. It just means that I just don't see a lot of growth in that space. I think this is a year where you have to manage your risk. Don't stick your neck out. Don't catch a falling knife, and then wait for valuations to come back. And they will. They always do.
Going base jumping along with Spotify is shares of Facebook here in after hours trading as we're keeping an eye on Meta platforms. And for that, let's bring in Jared Blickery. Jared, we're watching shares, keeping tabs on them. Let us know what we need to know about this report.
Facebook is getting shellacked. You want to go base jumping here? I hope you have a parachute if you are an investor. Revenue for the fourth quarter, just about the only number that beat, and it's a very small one, 33.67 billion, and the estimate was for lower at 33.43 billion. But when you go to the monthly active users, 2.91 billion, the estimate was for more, 2.95 billion. The daily active users, 1.93 billion. Estimate was for 1.95 billion. They missed on EPS, coming in at $3.67. The estimate was for higher at $3.84. Operating margin, 37%. That was a miss. Estimate higher, 38.7%. And some commentary here. They're saying that growth is negatively impacted on Apple iOS changes. That's that advertising change that Apple made during the quarter. Meta Platforms, their reality labs that had an operating loss of $3.3 billion. Also, another note here, the first quarter is going to be impacted by headwinds to impression as well as price growth. And they also see themselves trading under the FB ticker until the first half of 2022. Sometime in the first half of this year, they're going to change it to Meta. So they're going to get that META. I don't know how much they paid for it, but probably a pretty penny. Also, they see revenue for the first quarter, $27 to $29 billion. Guess what? The street expected $30.25 billion. So this stock, let me just pull up a chart here on the Wi-Fi Interactive. I think it's down about 60 points. So let's just say it's around $260 or so. It's way down here. So the lowest prices we have seen since March of last year. Just an absolute disaster, this earnings statement by Facebook, guys.
Wow, we're going to keep a close eye on shares of Meta Platforms as well here. Jared Blickery standing by in the studio for those results. We appreciate it, Jared, Yahoo Finance's own. And as well, we want to thank our market panel too. Robert Shine, who's the Blank Shine Wealth Management Chief Investment Officer, as well as Terry Sawchuk, who is the Sawchuk Wealth Founder. Thank you so much for joining us here to break down the markets here on the day. Everyone stick around as we've got much more on Meta Platforms after this short break. Welcome back to Yahoo Finance Live, everyone. We're keeping close tabs on shares of Meta Platforms, the parent company of Facebook and Instagram and WhatsApp, and taking a look at those shares, they are down by 20% in after-hours trading on their most recent earnings report just released after the market closed. And for more on this, we want to bring in Angelo Zeno, who's going to help us break this down. Angelo is the CFRA Research Equity Analyst, Senior Research Equity Analyst. Thanks for joining us here on the day, Angelo. First and foremost, want to get what stands out to you from this report's modest move higher on the percentage increase for monthly active users and daily active users. But what is the street latching onto?
Yeah, I mean, listen, as far as the quarter is concerned, right, and as far as monthly active users, I mean, it was definitely, and daily active users, it was a little bit lighter than we had anticipated, but not egregious in nature. And, I think overall, as far as the quarter was concerned, Q4, that is, in terms of the revenue side of things, I think all of that is perfectly fine. I think that the bigger issue, of course, and the complete surprise and why the stock is down, all has to do with what's going on in terms of the guidance.
And speaking of that guidance, Angelo, I'm taking a look at Facebook Meta's earnings statement here, and it said that it expects growth to be negatively impacted by three main factors. The first of those being Apple's iOS changes, the second being macroeconomic challenges for its advertisers like cost inflation and supply chain disruptions, and the third being currency exchange rates. Now, is it possible to break out which of these is actually causing the most concern here for Facebook in this current quarter guidance?
Yeah, listen, I think as far as what the biggest impact is here, listen, we just had Alphabet report, right? And for the most part, in terms of what the results were, in terms of what the guidance was, listen, the ad spend environment, at least for Alphabet, looks like it's pretty good. So as far as kind of, what's causing the light results in the guidance here, clearly there's a shift in terms of the ad spend dollars. And it looks like it's shifting away to an extent from Meta, and it's shifting more so into an Alphabet. Now, does that have more to do with the iOS changes? I'm sure that has a lot to do with it as well. May also have to do with the slowing kind of environment that you're seeing from Meta overall in terms of their active user base, maybe engagement levels not up to par of where it should be. So I think there's a host of factors, but ultimately, I don't think it's as much as the macro factors out there, or at least I don't think that's what's spooking investors out there in terms of this name at the moment. I think it has everything to do with the Apple changes as well as what's happening specifically to Meta at this time.
How much is driven by the investments, the strategic, if you will, expenses that they're going to see in this near term as they try to get to the point where even 80% of their advertising or their revenue is coming in from advertising? As of right now, it's 32.6 billion out of the 33.6 billion that we saw in the most recent quarter, as compared to Google's roughly 81% of the revenue coming in for advertising. And so if they want to compete on perhaps that family of different products beyond just the family of apps that they do have, what is that going to look like on an expense front and on the capital expenditure front?
Yeah, listen, I think when you kind of look at the guidance here for 2022, and they provided us a sneak peek back in, after the Q3 results. And listen, in terms of the CapEx side of things, we're looking at potentially about 30 billion in CapEx spend, which would essentially be a 50% plus increase in CapEx year over year. You're talking about an OpEx environment out there where OpEx is going up 30% or so on a year-over-year basis. So they're spending significantly while the top line is decelerating significantly, right? Usually what that translates to is potentially negative earnings growth, on at least from the prior year. So, again, it's going to be a very expensive kind of transition that the company is looking to embark on in terms of looking to cater to maybe a younger universe out there in terms of individuals, as well as kind of getting this kind of whole metaverse concept out there. So it's going to take time. It's going to be extremely expensive. It's going to be a multi-year process. And again, you can kind of see how investors are taking it right now.
Well, and speaking of how investors are taking it, at almost a 23% drop in the after-hours session, we should note that this is currently the worst post-earnings drop ever that we've seen for Meta Facebook. But how much, Angelo, do you think that competition from the likes of TikTok and other social media platforms like Snap are playing into these results on the user side?
Yep. So listen, I think the competitive landscape has definitely gotten a lot more fierce, especially over the last year. And again, you've got a much older kind of Facebook install base out there, and now you're talking about them having to compete with all these other players out there. So definitely problematic for them. I think there's a lot of issues there that they're going to have to work with. Again, it's going to be a hefty process. It's going to be extremely expensive for them to kind of navigate through this. And listen, it's what investors hate more so than anything is to have to wait for kind of those returns to pay off. And at this point in time, you're potentially kind of looking at more of a 2024, 2025 environment where they kind of need to get where they need to.
Does anything about this earnings report change your price targets, your own expectations for how Facebook will do in the near future?
Yeah, so listen, as far as our expectations kind of going at least into this report, I mean, our view was they could kind of sustain a mid-teens top line growth pace in 2022. That's clearly looks like it's not going to happen, at least in the first half of the year. So the estimates are going to likely have to get ratcheted down in terms of where the street expectations are at the moment. So as far as that's concerned, listen, that's going to have an impact on how we view the stock. We currently do have a hold recommendation on the name relative to a strong buy in terms of Alphabet. We continue to tell investors that's really the way you want to play the ad space right now. And clearly, based on these results, we're kind of happy about that. So listen, I think, does it change our perception of the name? Yes. I mean, we're definitely a lot less optimistic that they're going to be able to kind of keep some of those targets that we had anticipated over the next 2 years.
Angelo Zeno, CFRA Research Senior Equity Analyst, joining us here today to break down Meta Platforms. Again, Facebook shares or Meta shares moving lower in after-hours trading, worst post-earnings drop ever for the company. We'll continue to track that going forward as well. On the other side, we've got even more earnings breakdown. We're going to be taking a closer look at Qualcomm. That too, moving lower in after-hours trading by about 3.5%. Stick around.
Qualcomm just reported earnings results that topped estimates for its fiscal first quarter. Adjusted earnings of $3.23 a share on revenue of $10.7 billion were each ahead of consensus expectations. But the stock is down in late trading, as you can see on the board there. Daniel Newman, Futurum Research Principal Analyst, is here to break this down for us. And Daniel, at first glance, this report and guidance from Qualcomm looked pretty good and were ahead on most major metrics. Why do you think we're seeing this drop in the stock right now?
I think as excited as the market was following Alphabet's results yesterday, we are seeing a bit of a negative because of what happened to Meta. And so you saw everything felt really positive. You had a huge beat from Alphabet and AMD yesterday. And then you also saw Qualcomm's stock shoot up throughout the day today. So it's giving back some of its gains. But I think the market had largely anticipated this was going to be a good result, which it was.
$10.7 billion in revenue. Going forward from here, where is the strength in their opportunity to continue to see revenue growth going forward?
Well, this represents record revenue. The company also showed record earnings, and it showed record EBT, which means its margin was expanding as well. So it's really firing on all cylinders. Over the past few quarters, I've been pretty bullish about the company's diversification strategy. It became the leader in its RF front-end business. It has now hit a $1.5 billion per quarter IoT business. Its automotive pipeline is now jettisoned up to something like $13 billion, with pretty significant wins announced this quarter with BMW, GM, Renault. So they're not just a handset company anymore, but they've also been able to shed some of the fear that investors have had about its ties to Apple. Its growth is coming more from Android, which saw 60% growth in its handsets against a 42% overall growth. So the fact that the company's been able to diversify so successfully, and plus it still has a really high margin licensing business, there's a lot to be excited about. And one last thing to note is it is now the largest fabless chip maker by revenue, and it trades at something like a 17 times forward PE versus NVIDIA, which is somewhere around 48 as of right now, and AMD at 32. So there's a lot of positives for investors that are tracking this and its growth because it's diversified.
Well, Qualcomm, as you mentioned, is getting more diversified. But in terms of where the revenue is actually coming from, $6 billion still did come from handsets. You mentioned some of those automotive deals, but that was just about $256 million in revenue for this latest quarter. When do you think we'll start to see some of these other more burgeoning sources of revenue really start to pick up here for Qualcomm?
Yeah, so you see the handset business is representing just a little bit more than half of the revenue right now. And over the past several quarters, you've actually seen that gap close significantly. If you go back and look 1 or even 2 years ago, that percentage was significantly higher. So under CEO Cristiano Amon, which I actually had a chance to talk to right as these earnings hit, he has been very, very excited and passionate about the growth that is coming from these adjacencies. So if you track it on a quarter-by-quarter basis and a year-over-year basis, they were able to create more than, I think it was 3 different billion-dollar revenue streams now with the handsets, IoT business, and the RF front-end business, and plus the automotive business, which is a longer tail. But with this digital chassis technology and all of these partners, it is a $13 billion pipeline, and that is longer tail, to your point. But if you're looking to answer the earlier question, where does that growth continue to come from? That's where you've got to start to say it's pretty optimistic, especially when it's trading in this range of forward earnings versus some of the other fabless companies.
The current guidance for the upcoming quarter, $10.2 to $11 billion on the revenue front. And so when you think about the growth prospects, I suppose, and what you've heard from the company thus far, is this type of guidance appealing to you at this point, considering what you were just laying out in the run rate that many of those sub-businesses are already achieving, and many of them trying to compound on top of?
Well, what we're seeing here is continued momentum. It appears that the dealing with the supply chain constraints hasn't been a significant problem. Of course, there's still headwinds, but they've taken on working with multiple fabs, expanded to beyond TSM, to also working more closely with Samsung. So you've got that working in their favor. The demand for mobile devices isn't going anywhere anytime soon. So you kind of look at the overall landscape. This raise was 10.2 to 11 versus 9.6 is what the street is seeing. So the companies, they're putting it out there that they're expecting to grow. And right now, with some of the headwinds, macroeconomic, inflation, interest rates, and the overall sort of negative sentiment towards growth, it shows a lot of confidence to raise right now when it may have been safer to kind of hold back a little bit and see how things are going to develop.
All right, we will leave it there for now. Daniel Newman is Futurum Research Principal Analyst, and we thank you so much for that insight on Qualcomm. Well, let's get another check of shares of Meta Platforms, the company formerly known as Facebook, trading under the ticker FB. Those shares are still trading lower by more than 21% in the after-hours session, and that's after the company gave guidance, first quarter revenue guidance that missed consensus estimates. A number of other major metrics were also short of what Wall Street analysts had been projecting, and as a result, again, seeing that hit to share prices in the after-hours session. But we have much more Yahoo Finance Live up after this short break. Stick with us.
Welcome back, everyone. The NFL faces yet another critical moment stemming from race relations. Miami Dolphins former head coach Brian Flores filed a racial discrimination lawsuit naming the NFL and saying, in part, the NFL remains rife with racism, particularly when it comes to the hiring and retention of black head coaches, coordinators, and general managers. The NFL called the claims meritless and intends to play defense here. This all comes less than 2 weeks before the Super Bowl. Joining us now to help us break this down is Darren Heitner, Heitner Legal founder, and we also have Yahoo Finance's own Josh Schaefer. Darren, let's start with you on this. We've got evidence of text messages, the allegations that have come forward in this particular filing. What stuck out to you the most? And in making this case, what will Flores need to prove?
Well, first of all, thank you for having me. What sticks out the most is that there's obviously a problem. The problem is that the Rooney Rule was put into place years ago to try to ameliorate the issue of not enough minority coaches being put in place. As we sit here today, only one black head coach is coaching in the NFL, and Brian Flores was the second, and perhaps still will be the second if, in fact, he has an opportunity to coach with a team in the future. But that's on the back burner now with him filing this lawsuit, which is based on racial discrimination. And he's filed this suit not only on his own behalf, but on a class of other similarly situated plaintiffs. It'll be interesting to see if other coaches decide to join this lawsuit. And ultimately, he's suing the NFL, the Denver Broncos, the Miami Dolphins, and the New York Giants, saying that each organization acted in a way that discriminated against him. My reading of the roughly 60-page complaint it leads me to believe that, yes, there are absolutely problems, but I wonder if these claims will stick, particularly against the Dolphins and the Broncos. He claims that the owner of the Dolphins, Stephen Ross, told him, I'll pay you $100,000 per game that you lose. I also want to set up a meeting between you and a quarterback on another team on a yacht. While those are issues and need to be confronted, is it necessarily racial discrimination with regard to those specific facts? The same with the Denver Broncos. Brian Flores is upset that individuals, including John Elway, were roughly an hour late to an interview, per his allegations, and came in, quote unquote, disheveled. He didn't end up getting that job. But again, it's going to be a very tough burden for him to prove that either the Dolphins or the Broncos committed some sort of there was some racial backlash based on the fact that he didn't end up getting the job with the Broncos and that he was ultimately terminated by the Dolphins.
Yeah, Darren, I wanted to zero in on the other team here too as well, the New York Giants. And I believe we have the text messages we can pull up that are allegedly from Bill Belichick to Brian Flores. So the situation here was essentially Brian Flores had not interviewed yet with the New York Giants, and Bill Belichick sent a text message, allegedly, according to what we're showing on the screen, to the wrong Brian. He thought he was congratulating Brian Dable on getting the job, who would eventually get the job, but this was before Brian Flores had ever interviewed. Obviously, that would be a problem if the Giants were just interviewing Brian Flores to check a box for the Rooney Rule. I was curious if you think, how important would it be to get Bill Belichick's testimony if this case were to go to trial? Is that pretty much essential to proving this for Brian Flores and his defense?
Well, I think that the text messages truly do speak for themselves. And I do wonder whether this case will ever get past a motion to dismiss and enter the discovery phase where potentially Bill Belichick would be deposed. I think what it shows first and foremost is what you mentioned, that the Rooney Rule has really become a type of check the box platform. That essentially what happened there is the Bills probably found who they wanted in Brian Dable, but because the Rooney Rule exists, the Bills still needed to interview 2 minority coach candidates and have one of those interviews in person. And so we know what the problem is. The problem is there are not enough minority head coaches, assistant coaches, people in the front office. The issue also is that while the Rooney Rule was put in place to solve that problem, it's just not doing that, because that's a perfect situation where Bill Belichick apparently heard Brian Dable has it in the bag, and yet the Bills still felt compelled that they had to interview Brian Flores based on the Rooney Rule. The Bills should have probably interviewed him earlier on, and really someone that has the experience of Brian Flores absolutely should be coaching the league. The question is, why isn't he currently? And now it's perhaps more unlikely than likely that he will be coaching based on the timing of this lawsuit. I was a bit surprised by that. Why not just wait until after your additional interviews and see if you actually get a job? Now I think he's going to be hard pressed.
Given that this is a class action lawsuit, how important is it that others join in this class action as it moves forward?
Well, so it's filed to be a class action lawsuit, but it still needs to be certified as such. And I do think that there will be issues in order to actually get a federal judge. And realize this case is now pending in the Southern District of New York, federal court. The NFL's and really the Giants, even though they play their games in New Jersey, it's their home field. They have home field advantage. I think a judge is going to look at this case and say, you know what? Brian Flores maybe has causes of action, claims that can survive a motion to dismiss, but this isn't really right for class certification because the facts are so specific and unique to Brian Flores' specific situation. Thus, if there are other coaches that want to bring forth claims of racial discrimination, go right ahead, file your own claims and file your own complaints. But I think it's unlikely that this class does get certified because of the fact that every circumstance, it's a case-by-case issue, and not every coach has the same exact facts as Brian Flores has asserted in his complaint.
Darren, given your experience covering sports law, do you think if this case doesn't go to trial, if it's settled outside of court, do you think it has the same impact, or do you think we need this to kind of carry out and be something that actually sees its day in court for it to have an impact on the NFL and kind of evoke change?
Yeah, typically the greatest impact in litigation comes at the very infancy of the litigation. And then at the very end, if there is a trial and ultimately a decision made by a judge or a jury. I think certainly we felt a tremendous impact in the past 24 hours since it was revealed that this complaint was filed. And we've seen Brian Flores with his lawyers basically go to various media outlets to explain his side of the story. I don't think that's going to end anytime soon. I think it's important. It brings to light a very important discussion that needs to be had, which is what can we do to fix this problem? There is seriously a problem with the Rooney Rule in itself. There needs to be solutions. And really, if you look at Brian Flores' complaint, he's not only seeking monetary damages, which are very typical in a civil action, he's also asking for declaratory relief from the court to basically input different portions, or I guess supplement the Rooney Rule to add a funding committee dedicated to finding Black investors to potentially be owners of teams, to ensure diversity of decision-making in the process of hiring coaches and hiring general managers, et cetera. I don't think that a court will really involve itself there, but again, it's a discussion that needs to be had. And I think in the court of public opinion, this could cause change for the NFL.
And a big time in that court of public opinion, just less than 2 weeks out from the Super Bowl. Darren Heitner, legal founder, and our own Yahoo Finance's own Josh Schaefer joining us here for the discussion. Thanks so much. And on the other side of this short break, we've got a $1 million interview. Nobody paid for it. It's just Ryan Serhant on the other side.
Earlier in the show, we talked about potentially paying for taxes in crypto, but what about buying a house in crypto? Ryan Serhant, the CEO and founder of Serhant Real Estate Agency and star of Bravo's $1 Million Listing New York, spoke with Yahoo Finance about crypto and the real estate market. Let's take a listen.
There is a growing effort towards using cryptocurrency, not just as a place to invest, which is what it's been for the last decade, but as a place to actually transact. And for us in the real estate space, I'm not just as excited to sell someone a home using Bitcoin or doing a wallet to wallet transaction, or maybe selling an apartment for more money or a home for more money to somebody overseas because it's easier to do than doing a conventional purchase. I'm excited about disrupting an industry that really hasn't changed in the last 100 years. We still sign contracts the same way today for a home that you did in 1950. Sure, now you do it maybe on DocuSign or you're going to do it on your phone, but it's still the same. There's no protections. There's no saying that there's no forgery or any type of security. It is a photo of a piece of paper with no record attached to it. If you drop the term NFT and just think about a title or deed, okay, and a contract of sale as a non-fungible, quote unquote, token or a non-fungible contract, which you're going to start to see. So an NFC, then you put that out onto the blockchain, which is a massive cloud-based ledger where anyone can write to it and everything is recorded. That seems like a much safer place for me to transact a multi-million-dollar purchase. And that will come after the banks adapt and adopt crypto as a viable purchasing tool and solution. I mean, you're already seeing it. There was a penthouse in Miami at Arte Surfside that sold with full cryptocurrency for $28 million. I sold the penthouse there at that same building for $33 million. People who are have this type of money are spending it, even at smaller dollar price points. It's an exciting time.
Well, I mean, that's a lot of money to be putting down on a place. I know that Brian Armstrong, who's the CEO of Coinbase, spent $133 million on a Bel Air estate. But I'm curious if people like Brian Armstrong, right, the big names in crypto, are ultimately making these purchases in their crypto of choice, or are they still doing it in the US dollar?
Well, Brian is worth $10 billion in US dollars because he created a company called Coinbase that went public and has done incredibly well and is the provider for all currency exchange, right, in crypto. And so I doubt that he bought that using cryptocurrency. Some of the major crypto founders that we're working with, helping them buy property all over the world, they're still using US dollars, in part because they want to maintain that kind of privacy, and they just have it. If you have $1 billion in Bitcoin, you can kind of do whatever you want. What I'm actually seeing, though, a lot of is not the billionaires, right? It's not the billionaires looking to buy something in Bitcoin. It's the person who has a regular job, a W-2 9 to 5, who 5 years ago, a friend told them about cryptocurrency. They put, $25,000, $50,000 as a bet on Bitcoin. And today that's worth a lot more money. Now that person, though, because their job doesn't allow them to qualify for an incredible loan, let's say at JP Morgan or at Wells Fargo, but they have amazing assets with crypto, now has to go to either a crypto lending firm, okay, like Milo, right, the crypto mortgage company that's based out of Miami that's doing well, or they're liquidating and they're paying the tax on it. Right. So, you're not paying tax on the cash that's sitting in your bank as long as you've already paid the income tax, right? Or as long as you've already paid the capital gain tax. And so those questions are coming up for a lot of these people and saying, hey, I can't use my regular ordinary income and my W-2 tax return to afford a $2 million apartment or a $3.3 million house, but I have that in Bitcoin because I believed in it for a long time and I've invested in it. What do? Do I have to cash it out, pay the tax, and then go buy something? That's not fun. How do I get around that? How do I do this in an intelligent way and maybe use the currency and pay the tax to actually buy, right, without having to pay a mortgage recording tax? In New York City, for example, there's a nearly 2% tax on the mortgage amount. New York City taxes you for your right to get a loan. So if you are going to get $1 million mortgage, you're now paying, nearly $20,000 to the city to say, thank you for allowing me to get a mortgage in New York City. If you have that already in crypto, why would you want to pay that additional tax? So it's about being tax efficient and basically just being financially efficient, and moving the process forward. Like, how long are we going to do things the same exact way? We're not.
Welcome back to Yahoo Finance Live, everyone. Taking a quick look as we wrap up today's show again at Facebook, as well as, well, we should say Meta Platforms, the parent company of Facebook. They are moving lower here by about 21.5%. This their worst reaction to an earnings report. We're also keeping close tabs on another major company that just reported earnings this afternoon. As we've been diving in on all of the earnings results, we want to get you another look at Spotify. That's moving lower by about 15% on those earnings calls kicking off momentarily. Emily, let me toss things on over to you.
Well, Brad, as you mentioned, Meta Platforms, seeing those shares down and seeing a number of other ad-driven internet tech companies seeing their shares lower in after-hours trading as well. Snap being one of them, though that stock down about 17%, and Pinterest. So again, another ad-driven internet company falling in sympathy with Meta Platforms. Amazon shares also moving lower in the after-hours, and that company also reports earnings tomorrow afternoon. Brad.
All right, that does it for us here today. We will check back in with you at tomorrow's market close with more of those earnings results. Thanks for tuning in.